start. Okay, thank you. Welcome to everyone in the room. I'm Alex Badas. I head up the Global Employment and Incentives team at Linklaters. Have a lot of the team here that I hope you'll get to meet in the break. And I wanted to welcome everyone who's here with us virtually as well. So we have a hybrid conference today, including some of our speakers who will be joining us virtually as well. So welcome to you as well. Before we start, I have been told to do some housekeeping. So fire exits over there, obviously, very simple, and here and here, well, not there, just there. If you want Wi-Fi, it's there. There's also some interactive feedback you can give on the app. Apparently you can rate the speakers, which I've just been told about. Yeah, a delegate questionnaire as well, which we would really appreciate you filling in. The other thing I have to say at the beginning of this conference is just to remind you all about competition issues. What we're talking about today, obviously, will cover some quite sensitive topics, I'm sure, including around the bonus cap. So we should just be talking about it, I guess, from our perspective of what the regulators expect and our interpretation of the rules, rather than anything about what your firm is doing. And if we have to, we'll obviously kind of try and bring things to order, but I'm sure everyone knows by now what the drill is. So I thought I would just remind us, and probably most important for the next session, which will be exploring some of that. But just to set the scene before we dive in to each of the sessions, I think we're at a real inflection point at the moment for London as a financial centre. It's, the government's trying to find its way through making Brexit a success and showing that there are some wins for this country as a result of Brexit. And so, of course, we've just seen that the bonus cap has been removed, and that's meant to bring lots of flexibility to firms. And that's all very well, but I know all of you in this room are struggling with the implementation of that, because it's not easy, because you're operating in a global world with employees all over the place and having to manage these changes, looking at employment terms and actually what it means for your employees and employee relations and so on, and expectations of all your stakeholders, shareholders, employees, regulators, and others. So it's all very well having these big bang statements, but actually when you come to implement them, we know it's challenging. So that's one of the key points that we'll certainly discuss today. Another one is, again, the UK government trying to show that London is a good place to list and doesn't want to lose business to New York and other financial centres. And so it's basically saying now, okay, you know what, you can come here and you can pay people US salaries, and we will compete for global talent. And that's such a change to the messaging we've had over the last few years, which has all been about fairness and thinking about employees and ensuring some parity and treatment between the people at the top and everybody else. And so companies, again, are having to navigate that. You want to be competitive, you want to bring in the best talent, but you also need to manage all of those other interests that still remain. So I think those 2 points are kind of worth thinking about in the background. And then the sort of third and final theme we've seen a lot of is a huge amount of non-financial misconduct. And I don't think it's because people are just behaving worse than ever. I think behavior is probably at the same level it's always been, but I think there's just a huge expectation now that companies do something about it. And so in the last few months, we've seen some really high-profile clawback cases, not in the financial sector, actually. We've seen them at places like BP and Endeavour, and we've also seen other situations in the US, where people who've committed some kind of misconduct end up with huge impact on their remuneration, which we never saw before. And I remember talking to clients over the years about, have you seen clawback in practice? And we'd say, no, it's not something that actually happens in reality, but it's there just in case. And now we've seen, 25 million, 30 million being taken away from some of these executives. So it is a reality now, and it is focusing people's minds, and the regulators obviously see that too. So whilst we haven't seen so many clawback cases in the kind of financial services space, I think there's certainly a focus from the regulator on non-financial misconduct and how firms deal with that, and a number of you will have received questionnaires about that recently, and we'll go on to talk about that in one of the sessions in a moment. The last thing I wanted to touch on was pay transparency. So EU pay transparency rules coming in, obviously just in the European Union, but they will have far-reaching consequences globally because you all operate in global firms where your employees will see what additional information the EU employees are given and want some of that. So if it's about giving salary ranges or bonus opportunity ranges, you will suddenly find yourselves under pressure to be sharing more information than ever. And I think that will have a seismic impact because we are risking litigation coming through under that directive. They've set it up so that it has teeth and it will mean consequences if firms are not sort of dealing with their gender pay gaps. So we've got a session on that coming up as well. And then we're covering other topics like intergenerational reward and how Remcos should navigate through all of this. So I won't steal anyone's thunder. I just wanted to give you a little flavour of kind of what's to come. And I hope you enjoy all the sessions. Please do ask questions. There's lots of time for questions in each of the sessions, and it will be really interactive and fun if people participate. So with that in mind, I will hand over to our first panel, chaired by Iqbal, and I will let Iqbal introduce everybody. But it's all about the first topic I mentioned, which is driving competitiveness of London as a leading financial centre. And Iqbal is a partner in the financial services practice at Deloitte. So thank you very much.
Thanks, Alex. Nice to see you all. So I am Iqbal. I'm one of the partners in the Deloitte Reward practice. And we have the lovely topic of talking about will the removal of the bonus cap and will the changes or the capital market reforms aid the UK status as a go-to place in financial services? I'm joined today by Stuart Woodward from Citi. We've got Jonathan Parr from SMBC and Tristan Aberdeen from Brooks Macdonald. You would have thought I would have done that in order, but I had it written down in a different way on my piece. I'm going to let everyone introduce themselves and then we'll go straight into questions. We would like to make the session as interactive as possible, so if you have any questions whilst we're speaking, feel free to put your hand up. If not, we'll save 15 minutes at the end and come out with questions. Stuart.
Thank you. Good morning, everyone. Some familiar faces. Good to see you all. So Stuart, I'm at Citi. I have a seemingly impossibly long job title at the moment, which is Head of Product and International Regulatory Compensation. I'll boil that down into two things. It kind of gives you some context as to where I'm looking at this from. So I look after compensation for all of our front office globally. So that's the banking side, the wealth side, the market side. So I see a number of different elements to competitiveness, be they our peer competitors or even internally, actually, talent and mobility. The other half of my job title is the regulatory piece. That's where I cut my teeth. I grew up in the UK regulatory environment, working predominantly for Deloitte and then for Lloyds Banking Group, and learned all about the UK side of things. So I sit very firmly with that as my kind of anchor point for my career to date, adding all the other elements into it. The international piece is interesting here because we look at regulatory compliance and all of our activities for a compensation perspective across the field. So we're not just thinking about the UK, we're not just thinking about Europe, we're thinking about Brazil and Argentina and Taiwan and Korea and all of these places which actually are becoming increasingly highly regulated. And I think when you sort of put that hat on and that lens, you realise actually the UK is not such a bad place to be.
It's a big statement.
Thanks, Iqbal. I'm Tristan Aberdeen. I'm Head of Reward for Brooks Macdonald Group PLC. My remit is largely we're UK and Channel Islands focused as a business. We're solo regulated, so some of the aspects of the bonus cap aren't directly applicable to our business, but we compete for some talent within the market. So it's of interest to us in terms of those changes on there. And we're also obviously listed, so some of the capital markets reforms are important to our business. We are alternative investment market listed. We're a named business which should be there to provide light touch regulations, an easy entry point for small growing businesses to get access to capital and investment there. And we're definitely seeing some change in that space. That efficiency is something that's really relevant to our business.
Last but not least,
morning everyone, Jonathan Parr. And again, some familiar faces. I think I sat here about 10, 15 years ago, I was chatting with Verve. We're talking about how we're putting the bonus cap in, and here I am. Life comes full circle. A few more grey hairs, and we're talking about what we do next. What I'm in my current role, working for SMBC, not HSBC, but a sort of a similar comparison. We're one of Japan's mega banks with a retail platform a corporate and investment banking and markets platform with the Nico business. And I look after our European business, covering the regions here, Middle East and Africa.
Perfect. Well, I'm going to dive in and ask an easy question to start with and go with, do you think the removal of the bonus cap will have a demonstrable impact on pay within banks in the UK and therefore aid competitiveness globally? I'm going to start with Jonathan and then I'm going to go to Stuart straight after.
Sure. Well, I guess it's a long time since I was here. It's even further back since my economics degree, much of which I've forgotten. But the whole principle of removing structures that inhibit the free market, the agency, the choice, I think has to have, and I understand why the government's approached this in a way of saying it will create more flexibility to get a competitive landscape. As I think about my sort of practitioner view, and I'll be controversial and sort of stimulate a debate and questions, because I think we do want to bring those out. The bonus cap's relevant for just a small group of people. Most of the people are under 20% bonus, let alone 200% bonus. So it is at the margin, and the print headlines far outweigh the impact. That said, there are pockets where it's really important and really relevant, and as I think about the journey that I've seen organisations go on, it's been to almost stop doing certain parts of their business because of the regulations. Now, part of those are capital, but also part of those are going to be the flexibility. If you've got volatility in earnings, you're going to have volatility in pay, and if you can't get the volatility in pay, it will prevent certain businesses, getting off the ground from an inside, a banking platform. So it will start to have an impact, but I think it's going to be sort of likely at the margins. But I would argue as well that you create a few more of these roles, they're supported by 20, 40, 100 other roles. So there is an appetite to say, look, we start to do this, it starts to make an impact. But I think it's at the margin. And I'll apply a sort of global lens as well to that and say that at the moment, well, organisations don't have to have those roles in London. They've chosen to have them somewhere else where the regulations are different. So yes, it makes things better, but why move? And we've got other regulations, we've got other deferrals which are still going to be in effect, which still be a negative. We've got tax rates which don't compete with certain other locations. So I think, as you look at this, it's not a panacea, but it certainly is, I think, a step in the right direction.
Maybe I'll just draw on one word you use, which is volatility, actually, because I think to me that's where all of this falls. It's you're managing two different sides of the coin. You're managing the individuals who are most likely at the moment on a lower performance-related pay component because of the cap. I think that's one piece. And as a result of that, people are comfortable with their cash flow. That's a very difficult thing to remove. So that's one side of it. And then the competing interest is the volatility in terms of your firm's ability to manage cost. And fundamentally, I think that's where most of us are probably thinking about the changes and how we anchor those back. How quickly do we need to reduce a fixed cost base? And if we don't need to, and we don't want to annoy people in the process, then probably there's less impetus to do this. So volatility is probably one of the key things. I mean, the other thing is, as you say, it's such a small population, but it has that bleed into the broader sort of ethos of pay. And, we think of the 2-to-1 cap as applying to all MRTs, but you only need to look at the stats when it was introduced, and the average MRT ratio fell from 1.5 to 0.7. So nowhere near 2-to-1 to start with. So actually, it really doesn't impact. Now, high earners is where, of course, it comes into play. And I think that's where the sort of the levelling up globally has already happened. So this is not just a UK situation. This is a re-levelling on a global basis. You can compete, because you say you can put the role in New York or you can put the role in London. Well, pricing, you're probably going to end up fairly similar from a TCOM perspective. Cash flow may be different and your fixed component may be different. But in my experience, the New York side of that equation has gone up and we've sort of kept level. So very, very challenging to implement.
And I guess a follow-on question from that is, a lot of the debate is centred on whether actually, whilst the rules will be changed, whether people will make demonstrable change in practice, because people are quite comfortable on the level of fix that they have, and moving them to a variable structure is a big statement for people. It impacts their cash flow, impacts their cost of living. Do you think that do you think simply removing the cap will mean that people will accept the change? Do you think it will be forced by organisations? Or do you think actually it will take 4 or 5 years to get to the place, or you have to wait for a generation to go before we really see a change in what the rules are trying to achieve? I'll go use Stuart first and I'll come back.
Okay. I don't think it's 4 to 5 years. I think it's much longer than that, actually. I think it's 15 to 20, probably, in reality. So, no, look, I think if you're going to do it, you have to force it. And therefore, you have to make a difficult decision, which is how fast do you want to force it and how hard do you want to force it. Just waiting and seeing it will, in my view, cause problems with internal mobility, because why would you want to change a role, which is typically the trigger for an RBA-type allowance to change? Why would you want to change role if you know you're going to lose your cash flow? And I think that will be our biggest sticking point for that course of action. Now, some people may choose to do that, but then it causes all manner of problems. How do you recruit? Are you recruiting on the same platform, or are you recruiting on a different platform? How do you have internal pay equity? So all of these things are a balance.
Jonathan, come to you, and Tristan, actually will come to you on this one. Jonathan, do you have a contrary view, or is it?
No, I think, I said, inflation's our friend here. So that, really, we're just managing and monitoring the situation, saying, well, what do I want as an organisation? What do I want the pay mix to be? Alex mentioned things about the transparency. Well, I want to have a conversation. I think employees are demanding more a conversation. Say, well, look, here's my pay mix, here's my salary, here's the range that sits in, here's the bonus I can expect. And they're not going to move for demonstrably less fixed pay, much as they would move for, you'd have to do, and I don't think we'd want to do as an industry, really kind of say, well, leave a pound on the table but get the opportunity of 2 or 3. They're the sort of trade-offs that maybe got us into the trouble that we're in. So I do see it being something that will evolve over time. I'm not looking forward to the complexity of my job, though, because what's going to happen is, well, where's your market data on salaries? And it's like, well, this person for a US headquartered firm is looking like this, and then this from a European headquarters firm has a completely different pay mix. So what is the market? How do you compare against? And that's going to be sort of very complex. But I do think it's not a just wait and see. We have to choose that position because we have to choose to be transparent, or we don't have a choice about whether we're going to be transparent going forward.
Tristan, did you have a view?
Yeah, my view's more from the solo regulated side of the market, where we compete for talent. But for us, the removal of the bonus cap is something that's front and centre for us. I think what we're solving for is really change the products in market, the macro inflation environment. I think with this last calendar year end, a lot of firms' blushes on the investment of asset management side were saved a little bit through the rise in markets, and firms also had an opportunity to take incentives and interest turns. So I think firms are probably unusually profitable, or incentive funding was unusually strong for that time of year. Now a lot of those pieces are being moved off the table, so I think firms are increasing in the absence of a strong ability to grow revenues over the next kind of 18 months, and where do we look? And we do look at the cost base, the operating efficiency. We look at our own cost income ratios as a business and see what we can afford going forward, but also looking at our products at the same time and move away from bespoke, actively managed products through to model portfolio and passive type products. Those are probably things we're focusing on, how we reshape our workforce, our talent proposition around those, rather than changing pay quantum, really.
Very fair. I guess a question that has been playing on my mind is, when you think about the change, and if we think about this as either intergenerational change, and we'll talk about intergenerational reward later, or you think about whether it's going to be a sticker plaster change to how this is all going to go in practice, how do you actually manage it within a globally complex business? So if you think of Citi, for example, you have the US angle, you have your Latin America angle, you have the wider global angle, then you have the UK in its island, and then you have the rest of Europe. How do you actually navigate the removal of the cap within the UK context, Europe, and then the rest of your global operations?
So I think it depends what your starting position is, actually. if you've tried to operate on a global platform previously and then had, to use your island analogy, these sort of islands that float off the side of your global structure, where you've had to do something differently, in some regards your starting position is one where you're there already. You're just going to take things away. So you're going to put the islands back into your mainland. That's not necessarily where everyone's coming at this from. And I think that's one of the biggest challenges. But generally speaking, in most large organizations where you are competing for internal talent and where you can choose to have your healthcare banker in London or New York, you're going to have some kind of stable approach to compensation, a philosophy that runs throughout all your compensation. And if that philosophy is that, by and large, you want a variable performance-related component to drive total compensation, then the people who are in those roles have already subscribed to that. Now, they may have got used to higher levels of fixed compensation, but as long as they know fundamentally the compensation principles that you're going for, you've got this sort of anchor back to that as your ability to make change. But this isn't happening in isolation, in my view. You've got pockets of the world which are already doing things. Equal pay is driving massive change, particularly in South America at the moment, where we're seeing levelling up of salaries, and that's driving a different fixed ratio pay mix. So I think you've just got to look at it across the piece, and that's the complexity right here. If you're operating in 100 countries, you're looking at 100 different versions of the same truth, and you're trying to get back to one sort of single view. But as I say, if you can anchor it back in your philosophy, I think that's probably the best starting place.
Okay. And Jonathan, do you have a view from the other side of the island?
I think I'm going to agree with Stuart. They're the conversations I like having. You know, so you spoke about the two sides of your role, and I have the two sides in my role. I really enjoy the conversation about, well, look, what's our value proposition? What are we trying to drive? How do we incentivise good performance? And that's both in its financial and non-financial and its conduct lenses. So how do we do that? What's the right outperformance premium that we're going to put around that? I don't really like the how do we comply with all the regulations, and I'm sorry to all of the lawyers and the advisors who I enjoy talking to, but I don't really enjoy those topics because they're not driving value. You know, no one says, that deferral plan was so well written, I'm going to stay with SMBC. Okay. But so I think you really start from that approach of saying, look, what's the right value proposition? And then you sort of approach it that way. And then if you need to put an RBA in place to get T-comp at the market, you do that. If you can take them away and bring them into that, the island, I think that's a really good, nice analogy, then maybe we look to do that. But this is one piece of a global jigsaw that's changed. Yeah. We're going to be, trying to fit all the other pieces around it for some time to come.
Very fair. I guess when you take a step back on it, the bonus cap is only one part of the rules that the UK instilled. And when you talk to firms around, there's an unwinding of the bonus cap, what does that mean? You often get the pushback of the UK is not competitive for a whole bunch of other reasons, which are the rules that the UK has adopted, which go beyond Europe and are very different to the US. I guess the question that I have, not leading through your own firms, is do you think there is a place for the UK just to take a step back now and say what else do we want to do with the rules that will aid competitiveness? Or do you think the rest of it is kind of a foregone conclusion and we have to operate within the realms of where we are? And Tristan, I'll go with you first. And then
Yes, I think there's been a lot in the financial press specifically around pay competitivity of particularly the executive segments. I think coming out of COVID, executives, the salaries reduced for executives for a long period of time. Around about kind of 2 years ago, met with group of FTSE 50 Raw Fresh said, the time for that has got to stop now. We need to invest back in our talent. Lots of talk of giving remuneration committees bloody noses and saying, actually, we need to prioritise the talent and make sure we offer competitive outcomes, competitive opportunities and competitive outcomes for kind of executives more in the UK. So I think although we're talking about, some of the capital markets reforms today, which are more about streamlining listing arrangements and for those individuals there, a lot of the conversation is about talent and pay and some of the discrepancies. I think if you look at 2022, average earnings for CEO roles in S&P 500 versus your FTSE 100, broadly 14 million in T-comp for over in the US and just under 4 million, I think, in the UK there, so 350% upside if you're executive in the US business there. A lot of the US side is share-based remuneration, admittedly there, and reflective of that growth in the equity. But it does create an unlevel playing field. We're seeing Rupert Soames from Smith & Nephew, you're seeing the CEO of the London Stock Exchange Group, Peter Harrison at Schroders, talking a lot about making sure that we do back our talent effectively, and we offer a lot of opportunities. Obviously, with the internationalisation of London as a listing, a lot of our firms will have a relatively small proportion of both their headcount and source a small portion of their overall revenues from the UK territory. So, and their executives are actually domiciled either in the US and they're competing in a talent market locally, but our listing rules will, and the way proxies will review the remuneration report for those businesses will be against UK standards. So I think what you're seeing now is a lot of firms lobbying to benchmark against a more global executive benchmark, effectively, particularly the US indexes on there.
I think that's really fair. I'm going to hold the debate on the capital performance part for a second and go into because the question was around the banking rules themselves and whether there's more that could be done around that part. But I'll come back to the capital reforms piece because I think there's a really fair point there. Within the rules of the bank, within the deferral rules and all the other malus and clawback rules, I guess the question is there more that can be done there that will actually aid investments in the UK rather than bonus capital? I'll go to Stuart first and I'll come back.
So I don't know is the simple answer, because I think what we've done over the years is we've probably layered regulation on regulation on regulation, and that's fine because it's probably got us to a position where we all know how it works, and it was working quite well until the bonus cap changes just before Christmas, and then everyone was sort of thrown off course. But then we delivered year end, most of us who had a December 31 year end, and then we've sort of forgotten about it, and we've come through the other side, and now we're all refocused. These are hygiene factors at the end of the day. Whether you work in the UK or somewhere else, if you're working on a T-comp model and it's roughly speaking the same, it's some factors that you need to consider as an individual around cost of living in the UK, your cash flow in the UK because of the various features we're talking about, your spending power, your future investment abilities, your capital gains tax, your inheritance tax, all those things that internationally mobile people tend to be more worried about those things than what's the pound that they're going to end up in their bank account at the end of the month. So to me, these are hygiene factors. The challenges actually probably exist more in SMCR, I think, and the unattractiveness potentially to non-UK folks coming to the UK who are into a new regime. That said, and it's the point I've made a couple of times now, we're not unique. You've got the Bear regime in Australia, you've got Ireland with PKF, I think it's called, isn't it? You've got all very similar structures which are coming into play. So again, there's a levelling out. But it feels to me like that I spend more time talking to people about the impact of being in SMCR than I do of, as you say, whether the deferral rules are written correctly or not. So no, I'm not sure. I'm not sure it's as big an impact maybe as we think.
And Jonathan, what have you?
I think the one thing I'd reflect on is, because I think there is layer upon layer upon layer of all of these regulations. Do they work collectively? And so are they more than the sum of the parts, or is there an opportunity to sort of stand back and say, look, do we have and I'm not just talking about the pay regulations, but everything else that's involved. But does this provide investor confidence in the industry? And I think some of the things like the deferral and the malus and the clawback, they're actually, and I think I kind of agreed with the regulator here, saying, look, we battle against the bonus cap because we think we've got a better solution that actually provides what we want, which is a stable, strong financial services sector. But I do, the one thing I'd maybe add on all of these rules is, what I see increasingly is just a quality dialogue with the regulator about your issues, and actually that's something that you say, well, here's what we're doing, can I comply or explain, rather than have you tick these boxes. And that to me is maybe, a movement. That's hard to do, it's difficult, maybe it's wishful thinking, but we move away from the prescription into, much more of you determine what's right for you. You manage that relationship with the regulator. That would be a nice direction to move in.
Interesting, and I assume that part does require the kind of grown-up conversation between both parties, right? Like it needs the firms to be grown up, but also implement it in a grown-up manner in reality. The last question I had on the bonus cap, and I'll throw it to the audience if there's any more questions on the bonus cap, was, is there a risk that if we do go to the point where we unwind the bonus cap and we move to higher levels of variable pay, that we move back to an environment where there's excessive risk in the system and we end up back to where the rules were introduced at the beginning? I'll go Tristan first and then I'll go out to John.
Yeah, I think speaking perspective from a solo regulated business where the bonus cap was never applicable, and the kind of pay governance that John was talking about, if you were a large business with balance sheet assets over a certain value, you had the payout process rules in terms of the split of pay and deferred instruments, types of things there, but no actual cap. There was a huge degree of variation in the philosophy behind incentives particularly. I think that exists to this day. So I think with the bonus cap coming in and just having that absolute standard of there's a cap there, say the multiples end up maybe 0.7, not near there. I think some of the areas of separated business haven't really changed that at all. I think, the whole principle of things, mitigating conflicts of interest, ensuring having a balance between non-financial and financial inputs into incentive outcomes. I think some firms are still operating for lip service towards that. If I'm really honest, there's a limited conduct gateway, but it really is, you still eat what you kill. Certainly, I think the culture in some firms, it varies from firm to firm, hasn't moved on because they haven't had something like the bonus cap in there. It's been very, very quantitatively driven in terms of investment outcomes. I think we start to see a few things that are happening now in terms of, you've seen SJP in the news, they've put a provision for them, 26 million, because they can't find their annual suitability reviews, which is, it's a kind of network business of financial advisors, but fundamentally you can't demonstrate why you recommended that product and why it was suitable to that client for there. And they're saying, hang on, this isn't a price time volume play for you to get a big incentive. This is about your customer outcomes. So the evolution of consumer duty and the regulators being much more focused on that going forward, I think will change things, but it's not necessarily around the cap. I think it'll be around that feedback loop from consumer duty and making sure that actually we can't short circuit a quick kind of incentive fix basically anymore. And I think the culture will have to change as well.
I'll be sort of brief on this because I think we've said before, if you think about everything that was in place beforehand and everything that's been put in place since then, and there's just more control in the system, I think. And so fundamentally, and I don't think it's necessarily the regulatory, the comp control. I think it's things like, you said, consumer protection, it's ring fencing, it's capital adequacy. It's those controls that also exist that create a level of security. So I'm sort of comfortable that we won't have the kind of prop trading desk in the way that we had before, because it just won't sort of fit with what we're looking to do. Those businesses still exist, but they exist outside of the regulations. They're away from those businesses that we call risk and conflict to the broader banking licenses that we hold. So I think that to me is the assurance that I'd give, that we can take some of these things away, because actually we've got a number of safety nets.
It's probably also just worth remembering we're not removing the cap, we're setting a different ratio.
Yeah.
And that ratio in itself is a risk-based ratio. So we're, to your point, Jonathan, we're looking at our own businesses and we're saying, what risk are we willing to take? So it's a different model, admittedly, but it's still a risk-based decision.
Yeah, I think it's interesting just in that one, obviously MiFID per investment firms set their own ratios as well. I think in the consultation with the MiFID Remuneration Code, it was proposed that would be a disclosable ratio, and one of the changes in consultation to the finalisation of the rules was that would no longer be published, at which point I think a number of firms have rapidly changed the ratio from there. I think top of the head, numbers between 20 to 50 to 1 were not unusual for business there, and those weren't normal operating cycle, variable pay outcomes, they would have been associated with so much consolidation in the sector of firms expect to be boards, maybe earn-outs for management incentive plans, those types of things. That's their factory. You can't have a standard ratio in normal times, an exceptional ratio, you only get to do one. Same with the risk piece as well, you only have one for your risk folks as well, so it's an all-in, and if you can set it yourself. Certainly, I think Remuneration Committee said, let's not constrain ourselves.
Yeah, I think that's really fair, because I think if you look at, if banking goes from 2 to 1 and goes to 100 to 1, then we've introduced risk in the system ourselves. The firms have said that we're willing to take that risk into the sheet. And MiFID-proof firms have definitely ended in that, have some of them gone to that space. Whereas actually if the firm says, well, our risk tolerance is here, then you almost cap risk by saying, well, hold on, tolerance stands over here. Are there any questions on the bonus cap itself before we go into questions around the capital reforms? This is always the part when no one puts their hand up and you're sitting here looking around. I'm going to take that as a no. Oh no, we do have a question.
Yeah, a good one. And you had touched on this earlier. It's around the payments. Sorry. Thank you so much. So talking about pay mix, it always felt to me that the bonus cap is only one part of the competitiveness issue. And you did kind of touch on this earlier, but if as a thought exercise, you kind of take it back and say, what if we take fixed pay back to a similar level as it was before this all came in? Probably not possible, but you could take it back a little way. You've still got, in the UK and in Europe, much sort of lower thresholds at which your deferrals kick in. So you're going to end up with a much higher effective deferral on total compensation, and particularly, I think, with the upfront shares piece. So just interested in some thoughts on that side of things.
I'm going to go first because I can't actually answer any questions, because I have to throw all the questions to you. But I think I think it's more of a stand-back principle that has to be taken. To Stuart's point earlier, I think there's hygiene that sits within all the rules that we have. So you have deferral, you have the payment in instruments, you have Madison clawback, which lasts for 10 years. But the UK took a stand that it wanted to go beyond everyone at the beginning, and there must have been a logic train that followed that through. But I think if we're now going to review the bonus cap, and it is all about looking at the UK as a leading financial services centre, then it's taking a step back on those rules, it's taking a stand back on SMCR. I don't think we're going to get to tax. I wish we could, but we're never going to get to, well, we're going to look at the tax regime. But I think the bit piece meal approach of we're just going to look at this one thing and that's our silver bullet, I think is the mistake that we're making. Whereas what we want the regulators to do is say, how can we take a step back holistically, even if it's comply or explain? I think comply or explain would probably a step further than what they're going to be willing to accept. But if we take a step back properly, then we might end up in a better place. Whereas I think the small changes are the changes that are harder to force a change on competitiveness. But I'm going to throw it out. Jonathan, I'll go with you first.
I love solving that kind of problem, you know, and it's about, for me, saying, going back to this EVP, it's like, how can I get someone to come from, you know, country A to this country and move them around the world? How can I sort of make them want to take a job that's covered in the regulations versus not covered in the regulations? So you're trying to, as Stuart said before, remove the friction that exists with, you know, if I design any comp plan, as soon as there's a line or a cliff, there's friction. And so, you know, that's my sort of practitioner view on this. So I still think that we'll look at these things in the round. We'll look at higher deferrals for longer. We'll look at, you know, the other requirements of SMCR and say, actually, that makes you not want to do that job. So how do you tip the balance? And is it about continued use of, you know, higher fixed pay or higher allowances because you're looking at cash flow? And then you can have a conversation with someone about how, yes, their pay is different, but, you know, they've got the same sort of treatment here as they would get elsewhere. And then you just said, you know, how much do we solve for? Do we solve for the tax issues that are external? Do we solve for some of these other nuances? But I think that we can't, you know, it's a really blunt tool in the first place, and removing it is only part of the solution if it was indeed the problem. So you just continue to kind of reevaluate that kind of balancing factors to say, look, your package on a, you know, sort of, you know, time value of money, risk value of money basis is the same here as here as here. And that's, I think, where we kind of add value to sort of work our way to kind of make it engaging for employees.
Sure, is there anything you want to add on that?
No, I think you covered all the points, to be honest.
Perfect. Any other questions? No? Okay, perfect. We're going to go into so now going from one piecemeal change to a second piecemeal change, which is more about the corporate governance change. So it's how do you make the UK as a financial markets more appealing rather than just financial services more appealing as a whole? And so there's been lots and lots of debate around, well, is the UK just not a competitive place to come for executive directors? Right? Has it managed to lose its appeal and we're losing listings to other parts of the world? And I guess my first question, and Tristan, I'm going to go to you first, is do you think that the current environment in UK capital markets is broken and needs fixing, or actually are we making a mountain out of a molehill on this one?
Sorry, I think I spoke to this a little bit in my early question there. As mentioned, there's been a huge amount of focus on executive, the competitiveness or not of executive pay in the UK, how that's changed over the last few years particularly. I think when executive pay levels changed significantly as London became a real international market for executives, and we saw those rise. Things stabilised during COVID, and then since COVID, we've seen that war for talent at the executive level, particularly those kind of transatlantic moves of high quality talent over there, and executives in listed firms in the UK that have a very, very global footprint, maybe being based in a market outside the UK. So you've got a listing, you've got a listing in the UK, but actually your talent sits in other markets, and the reference points that they're looking at for their pay and how well they get paid are very different from what we're expecting in the UK. So, as mentioned before, you've got Jude Hoggett at the London Stock Exchange, you've got Pete Harrison, you've got Rupert Soames, all individuals that are talking about this subject to say we need to put more opportunity back on the table and be competitive there. So I think some of the reforms are not necessarily pay in nature when you look at the reforms that are about efficiency, streamlining, make it easier to list, those types of things there. I think Europe are making some comparable reforms as well. So I think it is maybe about keeping pace. From a perspective where we are so regulated, we're a small business which is AIM listed, and we're becoming quite a rarefied animal in terms of where we are because of the opportunity for consolidation, particularly private equity coming in. And it will always be more difficult to raise capital in a listed entity. There's a lot of stakeholder considerations, the time frame for the process. If you're saying, actually, we've identified our strategy and firms, small mid-sized firms they're listed for that growth and that growth strategy, want to execute it. And potentially that is best served in a PE environment rather than a listed environment, which is a real struggle because where we're on AIM, that is what AIM is there to do as an index, remove the kind of bureaucracy and get access to capital and growth.
Okay. Sure, I'll come to you to hear an additional.
I mean, look, London is a leading financial centre. I don't think that's a point for discussion necessarily. You only have to go to the City or to the Wharf or any other part of the West End to see that firms want to be here. And there's a bunch of things that they then have to think about in terms of how they locate themselves here. Is this an attractive place to be an executive? Yes, I think it is. If you can take a job in a leading firm in a market which, is challenging, you're still in that role. The broader question is, and perhaps we draw the line after capital, because I think that's our biggest challenge at the moment that we face, which is firms are struggling to get UK capital into UK firms. It's global capital which is going into UK firms. And that fundamentally pivots the sort of investor proposition. But also, it's fueling all the other financial centres. The jobs that go with capital are not in the UK. If you're a global investor investing in the UK, you're based in Dubai or wherever else in the world you may be. And that's, I think, one of our biggest challenges. So freeing up capital, pensions reform, thinking about risk profiles, has to be the starting position to get more money, capital flowing back into the industry that we sit in.
Because I think that touches on an interesting part, which is, I think it goes to the early debate, which is it has to be wider than just executive pay when we're thinking about reform. If you were thinking about the reforms from the lens of executive pay, right? So I appreciate that is private markets more interesting? Are wider global markets more interesting? Could we make UK pension reforms? But if we think of the dynamic on executive pay within the UK, do you think there is a disconnect with the way that the UK has managed to get itself within the governance bind it might find itself in, if that's the way people see it? Do you think it works at the moment, or do you think we could do more to either look at other markets and say, what are they doing that is working for them? That's meaning that, say, the likes of Arm Holdings are going to go over to the US rather than come over to the UK. Is there more that we could do on executive pay alone to free up institutional investment coming into the UK? I'll go with you first, Tristan.
Yeah, I think a lot of it's around, who are your investors, what is their profile effectively, and how you manage executive pay planning from that basis. I think there is, in terms of the proxies that will advise investors more generally about voting for certain resolutions, particularly around executive pay, the annual remuneration reports, they will have quite a one-size-fits-all approach. If we're a small AIM listed business and we don't have to comply with all listing rules due to AIM, we operate on a comply or explain basis. But when that comes to proxies and reviewing essentially our performance and our business and whether they recommend the pay for executives, there's not much consideration or license kind of given for that. I think they operate the same tolerances. Last year's annual report, they made a mistake. They missed a salary increase, and which they believe made our executive pay a 7% increase on this year. They actually missed that. Okay. So it was a vote against because that was an excessive increase of 7%. Then that should be a red top, that report. And I think it's just that one size fits all in terms of we are competing for talent. There's a real balance between ensuring that investors get fair value as well. And I think when we're looking at some of the opportunities in the US, the socioeconomics of the US are very different from the UK and Europe. And I think it's getting that balance right in terms of what opportunities, how much change we make for that. 'Cause I don't think it will be identical to the opportunities when yes, not appropriate.
Jonathan, do you have a view on it?
Yeah, I've less exposure to this area, but there's some sort of interesting stories to tell. And for me, it's almost, I did some work for ING, so it's all, I'm conscious to Alex's point, this is all in the public domain. But, it's trying to manage the stakeholders around any kind of proposal. And look, if someone came to me and said, look, I'm trying to hire a PA, I'd say, right, well, okay, well, you're looking at the London market for this set of skills. And I think what we have to do is manage the stakeholders when we're looking at executive pay and saying, well, I'm trying to hire somebody who has the ability to manage a global company and they could be anywhere. So the same principles don't apply. You don't just need to look at who's in this location. You need to look more broadly. You need to open up that talent pool. But a salutary tale, and I could see an ING sort of colleague, although we didn't quite cross over, but we're connected. In the time that I was there, the CEO was, I think he was paid about, sort of 2 million euros, which is not a lot for a CEO. And his pay hadn't moved for several years. And, you compare him to all of the other bank CEOs, and there was a request and a proposition put forward to increase his pay from 2 million. All very sensible, but we didn't kind of manage all of the stakeholders, and the public outcry from saying, this is what's going to happen, led that to be debated in Parliament. And so, as I said, I'm not sharing anything that is not completely public, but it's that management of stakeholders and saying, to the proxy community that I'm not involved in, but I think it's really saying, look, if we want to get the right talent, we are going to have to think about the pool within which we're looking for that talent, and then have forward-thinking conversations. And sometimes the stakeholders are just too big and broad, and that was an example of public opinion is one that you have to move. But I do think it's that process, and it looks like from my outside view looking in that is a process that's happening. There is a challenging to say we maybe have been a little bit too narrow, and we need to think a bit more globally, and that has to be a positive.
And I think that part's really interesting when you think of, because the UK we often say that our world is uncompetitive in what we're doing on executive pay, but when you broaden it out to Europe actually is in a relatively similar place around what their views are on executive pay. Sure, I'm going to come to you because there's a leading question on that one, which is if you sit on the other side where you see the US angle on executive pay. So the UK and Europe seems to got itself in a place where any increase in pay could be deemed excessive, and then you have either the public outcry or it goes all the way up to Parliament as an outcry. In the US, it seems to be very different tolerance on executive pay. And do you think having seen both sides of the coin, do you think the UK is a million miles off what they do in the US, and is the US a better model, and they think that we could learn from there? Or do you think actually there's a bridge somewhere in between where we need to get to?
I think it's somewhere in between. I mean, look, the numbers for the US banks are out now, so you know what they are, and there are many, many multiples of that 2 million you talked about. So, look, they clearly in the US you can do things differently, and I suspect more in APAC and LATAM as well. You've got different markets. Do I think it's the right model? No, because when you look at some of the numbers, they're astronomical, right? You know, these are totally different to the rest of the world. So the court of public opinion, I think, is really what anchors us back to a lot of what we do, which is kind of protecting the firm's reputation as much as the individuals who are part of those organizations. I think the US is probably better at roadshows. You know, going out and talking to shareholders and engaging with shareholders and engaging with, to a lesser degree, the proxies, but, you know, really having a better dialogue and explaining the value add. And in that sense, I think it is better. My experience, and I take myself back to a prior role, is very much that engaging in the UK is a sort of, you know, everyone's out on the same procession. And so if you happen to be the last of the banks or the last of the big FTSE 100s that ends up pitching up to the Investment Association or whoever else you're meeting, you're probably not going to get, you know, the best response. And that's not to say anything other than the fact that, you know, they've done it 100 times over. Whereas, again, in the US, there's much more of a big bang, and it's much more linked and anchored back to the investor proposition. So you don't just go with the chair of the Remco, the chairman, and, you know, your head of compensation or reward. You go with a whole suite of senior individuals who can tell the business story and really explain it. I think that's fundamentally different.
Yeah, I think that touches on a really interesting part, because I think in the UK in particular, whenever you go into a consultation on changes to executive pay, you're often going into the corporate governance part of the firm, and then you're having a conversation around whether it's the right thing or not the right thing to do. Whereas in the US, the fund managers lead the conversation. There's more of a connection between the two. And whether that will be some of the UK changes to be seen, but I think that is part of the difference in the dynamic between the two markets, which allows a very different proposition in where we get to. My final question on capital reforms, because I'm conscious of time, where we get to, but is a lot of the debate on capital reforms on the governance environment has focused on the largest listed companies in the UK around, is it all about globally mobile people? But I think there's another side to the coin, and Brooks McDonald might fall into that camp, which is on the smaller end, there isn't a focus on, well, actually, do we need to make the markets more competitive there? And do you think there's more that we could do in actually saying it's not just about the big globals, it's also about some of the smaller firms?
No, I think it's right. You know, I say, you know, we're AIM-listed, and the purpose of that is to remove some of the barriers for smaller firms. That hasn't necessarily been successful. You know, we're going through a stage of a lot of consolidation in wealth generally, mid-sized discretionary fund managers in particular. You know, start of the month, Holland Street Capital, private equity firm, announced, subject to regulatory approval, the purchase of Mattielli Woods, which is a 15 billion kind of asset manager and financial advisor business there. I think they paid around about 30% over listed share price, or listed price for that business. So, I think that was kind of disappointing in a way, because that wasn't a huge premium to pay for that business there. And I think there were concerns really about, you know, if you've got a market cap of maybe 200 to 400 million as a business there, and your share price is relatively high, you often have liquidity issues. Shareholders saying, you know, how do I get in out? You know, and so there's quite a lot of barriers there, and your confidence in raising capital is probably where those individuals say, no, actually, private equity offers us a much more certain route. And again, it's that speed to strategy realization. I think a lot of firms saying, you know, we're a mid-sized player, we need to develop that proposition. You know, that's that scale in the product where we are, and that's more quickly achieved under private equity than it is under a lot more of the complexity in the processes and the extended timelines that occur on a listed basis. So, and that's quite a difficult proposition to manage, yeah.
Very fair. I'm going to open up to see if there's any questions on the capital reforms side. Right, Alex is looking at me telling me that I need to get off the stage, so I can only thank my panellists for joining us, and thanks for listening to us. Thank you very much.
Thank you.
Thank you all. It's a really interesting debate. So Lucy Alexandra, and I hope we have Nick Curry as well. We're going to shift gears now and talk about non-financial misconduct. Oh, I better put this down. Sorry. So, we've got this session and then we'll break for a coffee break about 11 o'clock. So I'm very pleased to introduce you to a number of experts in this area, and I'll let you, maybe Lucy, do you want to introduce yourself first of all?
Sure. So I think Stuart may be giving you a run for your money on your job title length, but I lead the reward partnering team at UBS, so advising all of the business divisions and functions. I've been at UBS now for 9 years, quite a year over the last 12 months or so, with the acquisition of Credit Suisse. So very happy to be here and contribute to the panel today.
Thanks, Lucy. And Alexandra?
Thanks, Lucy. Hello, I'm Alex Martin. I'm Performance and Reward Director at Santander UK, and that's the retail and mainly commercial businesses of Santander in the UK. I've been here 8 years now, so
Brilliant. And Nick?
Hi, morning everyone. I'm Nick Keary. I'm a partner in the Financial Regulation Group at Linklaters. I spend a good amount of my time advising clients in relation to compliance with the SMCR, advising them in relation to conduct rule breaches, advising them in relation to governance, including advising them in relation to engagement with the regulators regarding their own remuneration and remuneration governance arrangements, particularly where there is questions coming from the regulator around the adequacy or sufficiency of the steps that firms have taken to adjust remuneration in response to incidents, whether financial or non-financial in nature, working closely with Alex. So.
Thanks very much. And Rachel, who's over there as well, from our team on the influence side. So yeah, we have seen, as I said at the beginning, more cases of non-financial misconduct than ever. And as I mentioned, I don't think it's because people are behaving worse than ever. I think it's because it's just something that is now expected to be dealt with. The regulators are focused on it, your stakeholders are focused on it, and people want to see consequences. And so what we've been involved in is a lot of investigations, getting to the heart of what happened, and then the accountability relating to it. And so what we wanted to talk through was the regulatory developments in this area. Obviously, the FCA is extremely focused on it, it's bringing out new rules, but also it wants data, it wants to understand actually what is happening inside firms in this area. How have you dealt with these issues in practice? And, are the rules working? Because we've all spoken about SMCR. We've had those rules for a long time now. And what is actually happening in firms, and are firms acting in a consistent way on this? So I thought it might be good if Nick started off by just telling us exactly what non-financial misconduct is and what it isn't. Where are the lines? There are things that we all do in our private life. Is that going to get us into trouble at regulated firms? So maybe if you could set the scene for us there.
Okay, I'll try and be as quick as I can in just setting the scene. So I suppose on one view, this is not new news, and there's various quotes from the regulators over the years that has said, non-financial misconduct is misconduct, plain and simple. We've had comments from the FCA going back to the Megan Butler days to the Women and Equalities Committee along those lines. And we've had cases where the regulators have taken action against individuals for non-financial misconduct. We've had, most famously perhaps, the former chair of the Co-op prohibited from the industry for his non-financial misconduct. We've had individuals prohibited from the industry. What's new and different, I think, is the degree of focus on this in the context of culture and governance more broadly, and specifically the FCA looking at the way in which firms deal with instances of non-financial misconduct as a lead indicator of potential cultural issues within the organisation, looking at it in the context of leadership and the role that senior managers themselves play in encouraging escalation, but also then promptly and properly dealing with those issues when they do arise. And what we've seen more recently, I think, is an attempt on the part of the regulator through the proposed changes, which I'll run through very briefly in a moment, a desire to bring more clarity about what is and isn't in scope, for example, from a conduct rule breach reporting perspective and in terms of referencing and fitness and propriety. Because I think there has been a bit of divergence of practice across the industry and a degree of variation and a degree of uncertainty. So let me set the scene with the latest reforms and what's proposed in that regard. So last September, the FCA and the PRA consulted on changes to their respective rules, partly around requiring firms to have D&I strategies, data gathering, collection, reporting. Won't spend time talking about all of that today. But on non-financial misconduct, what they have said is that for solo regulated firms, go back a second. Non-financial misconduct, they're making very clear, is relevant to assessing the fitness and propriety of anybody in working in financial services. So senior managers, board directors, certified persons, anyone that you need to make a fit and proper assessment in relation to non-financial misconduct needs to be part of the assessment of their fitness and propriety. What's new and different, and I don't think that bit is really a change. What's new and different, I think, is around the conduct rules. So the way the dual regulated, so the bank regime used to work, and still works, is that the conduct rules apply to the performance by somebody of their role for the firm, whether it's in relation to regulated business or unregulated, anything that they're doing on behalf of the firm is caught. For solo regulated firms, FCA-only regulated firms, there was a limitation that said the conduct rules only apply to their activities broadly where they relate to SMCR financial activities of the firm. So that's regulated business and a few ancillary activities, but it wouldn't cover sort of broader workplace behaviour of the type that typically is relevant when thinking about non-financial misconduct. And what the regulators have done, because of this uncertainty about how much of that workplace behaviour is in scope of even the dual regulated regime, and it's obviously not been in scope for the solo firms, is they're amending the rules. They're saying that for solo regulated firms, conduct towards colleagues, group affiliates, service providers, which has the purpose or effect of violating dignity, creating an intimidating, hostile, degrading, humiliating, or offensive environment, offensive, intimidating, or violent conduct, is unreasonable or oppressive, or humiliates, degrades, or injures. All of that is now caught for solo regulated firms. And for both dual and solo regulated firms, what they have now said is they've given greater guidance around when something is in the course of your employment. And so what they've talked about is some guidance around saying, did it happen on firm premises? Did it happen whilst you were working on firm business? Did it involve people that you were dealing with in the course of your job? Was it committed using work equipment? And then they give a whole long list of examples. And that creates new blurred lines, frankly. So they say, misconduct at a social event where it's been organised by the firm or by a client of the firm is in scope. Misconduct that's happened between colleagues but privately organised is out of scope. I think that creates a whole bunch of potential challenges and blurred boundaries, but let's come back to that a little bit later. Slightly unhelpfully, none of what they've proposed in the rules follows employment law definitions about what's in the course of employment, and they've come up with their own new funky definitions, and as a result, some difficulties at the boundary. And then what they then go on to say is that breaches of these non-financial misconduct of the type that I've run through will be a conduct rule breach if it is serious. They don't really define serious, but they say that you know, you take account of how repeated the behaviour was, what impact it had, seniority of the people, what their prior history was. And then they say it could be either an integrity matter for the individual or a lack of skill, care and diligence. And interestingly, maybe we can come on to this in the debate later, they say that if you're in a managerial role, your failure to manage and properly deal with the non-financial misconduct is also potentially a conduct rule breach. So failing to take reasonable steps to protect your staff against non-financial misconduct, failing to deal effectively with the complaints, or or abusing your role as a manager, all of that is caught potentially as a conduct rule breach. And one of the things I think will be quite interesting to see is the regulator not just dealing with REM consequences for those that are the perpetrators, if you like, of the misconduct, but actually expecting there to be REM consequences for those in managerial positions who allowed that culture to persist or didn't deal with it effectively. So,
and we've certainly seen malice being applied in those situations
exactly.
Under pressure from regulators.
Exactly right. So all of this is at the consultation stage. We don't yet have finalised rules. There's been a little bit of pushback from the Treasury Select Committee about certain aspects of the proposals, not really about this. But the theory behind all of this is to try and create a bit of more of a harmonised level playing field in terms of a shared understanding across the industry of how non-financial misconduct is relevant to the conduct rules, and therefore greater transparency in terms of breach reporting to the regulator, and greater transparency in terms of references, regulatory references that go to future employers, so that there is a greater visibility of these things. None of this proposes rule changes around the REM consequences of the misconduct, but we'll clearly come on to talk about how the regulator's expectations are evolving there. But to your point around data and gathering, one of the other things that the regulator has done recently is that they wrote to all broker-dealers, banks and insurers asking for data in relation to non-financial misconduct incidents over the last 3 years. Very heavy exercise for some firms to pull the data and respond to, not least because of the awkward way in which the data was requested and the way in which it needed to be collated and produced. But asking for breakdowns of the types of incidents, the consequences, what the consequences were for the person who was subjected to the conduct and the victim, as it were, as well as the perpetrators, including whether NDAs were used, whether settlement agreements were used, and what consequences there were. And there was a bit of a pushback from some quarters of the industry about the challenges of responding to that. And the regulator has just said, look, we want to build up a better picture of this. There's a lot of anecdotal evidence through the Sexism in the City inquiry, through other reporting, through whistleblowing. We want to have a much richer data set so that we understand where are the potential problems, and we can then monitor whether or not our interventions from a regulatory perspective are having the desired impact. So I suspect that survey won't be the last time that it's run. It will be rerun to figure out whether or not what they've done over the last few years is actually making a difference. So there will be more scrutiny and visibility over remuneration and reward decisions in relation to these incidents going forward. I'll stop there, and but hopefully that's a useful sort of overview of the kind of regulatory context.
No, it's really helpful, and I know obviously when you're making decisions about entering into settlement agreements or applying malice in practice, you're operating in the real world, you're weighing up all sorts of risks and reputational issues and everything. And settlement agreements do get entered into, and malice decisions don't always turn out exactly as you want. So I know that it's a very, very difficult area to navigate. So I wanted to turn to Lucy and Alex now and sort of understand, I guess, how you have taken conduct into account when setting remuneration, and how over the years since SMCR came in, I'm sure you've adapted your approaches. Maybe you could talk about how conduct is taken into account, what you encourage managers to do and how they demonstrate it, and which other functions are involved in that process. Maybe starting with Lucy.
Sure. I mean, I think I would say, firstly, I'd probably agree with you that it seems that the frequency or the level of interest, certainly from the regulators, is increased on this significantly. And I do think that firms put a lot of effort in to make sure that conduct is dealt with and is managed appropriately. I think one of the things that we do is have a sort of dual approach to performance management where we look at the what and the how. We have a behavior assessment as well as a performance sort of objective assessment. So we look at what people have contributed and have they achieved all of their, say, financial objectives as an example and risk objectives, but also we assess them on their behavior and what have they done from a collaboration perspective, what have they done from a risk culture perspective. And that was, for us, really key over the last 12 months in the merger situation with bringing the right culture together. And, you know, again, to your earlier comment, I'm not sharing anything that that Sergio hasn't spoken about publicly as well, but we really found that having that behavior lens and introducing that from the get-go with the transaction helped people to get from, you know, day one on the same foot from what are the expectations from us as a firm, from you as an employee, from a culture perspective, and therefore obviously from a conduct perspective. I think that we've obviously done a lot over the past years and since the introduction of SMCR looking at sort of, I'd say, penalising wrong conduct and, you know, how do we deal with incidents and disciplinary sanctions and, you know, I think leveraging some of the things that Nick has just gone through. And it certainly is the aspect I think that the regulators are the most interested in, and when we have discussions with the regulators, that certainly is, you know, the topic that they focus on. And, you know, thinking a little bit about, from a culture perspective, how do we tie in the good, if you like, into that equation. So I think thinking about managers or the roles of other functions, so we do ask that managers reflect conduct through those performance assessments, have open discussions with employees. If there are conduct issues, you know, could be as small as, you know, your employee consistently completes mandatory training a day late, or, you know, on a recurring basis, that's a theme, and so we want to have that documented and recorded and have that open discussion with the employee so that, you know, they're aware and understand that this is not the culture and the conduct standards that we expect, even on something that could be perceived as relatively minor compared to, you know, the sexism in the city inquiry as an example. So we do really make sure that there is transparency and that employees hear those messages from their managers and have that documented in, you know, performance assessments and so on. So I think that maybe I know Alex and had some similar
Yeah, but very similar,
views.
Lucy, in terms of being really clear around our culture expectations. We've laid out some very clear leadership expectations as well. So to your point, Nick, about how leaders are held to account, that's very clear from tone from the top around that one. And similarly, we have a very strong behavioural framework, which, again, like you, Lucy, is taken into account as part of performance management. I think possibly we've enhanced that behavioural framework and been really clear around our expectations around that as well. I think we've moved from a place where possibly the what was more important than the how, but certainly that has become far more rebalanced in recent years. We've got some regular conversations ongoing between line managers and individuals. That's become part of the cultural norm now, and I'm pleased to see that really happening in action and the more of a feedback culture there in place, so we catch any incidences early. We're really clear on what the expectation is around dealing with those instances and documenting them and evidencing them as well, which is really important. You asked as well, Alex, about the functions which are involved in the discussion. So we've got a real triumvirate of the HR team with the reward area as well as our compliance and our risk colleagues looking at this. And it's a continual assessment throughout the year. So we don't just get to the year end and go, well, we've got to look at this and we've got to document it and we've got to, but we've got a real rolling rhythm of having those reviews and making sure that we're looking at this collegiately and collaboratively across the year and sharing it with our remuneration committee colleagues as appropriate.
Thank you, because I was wondering also, from a performance adjustment perspective, I guess, as that interacts with the year-end process, how you ensure you're kind of consistently getting information about conduct issues, including non-financial misconduct. Sometimes it's just chance that it comes to light. So how do you ensure that things are actually escalated and make their way to the decision-making process?
So this has come on quite a long way in the last probably 5 years, where we've got an established rhythm of reporting now. An escalation within the firm and making sure that we've got the right people looking at these and reviewing them and then triaging them prior to then any remuneration decisions as a result of them, and making sure that the remuneration committee has that ultimate visibility of the cases which are forming part of the assessments and anything that's coming out of those cases for year-end decisioning. As I say, so we don't just have this flurry at year-end of what are we going to do with stuff. It's a regular triage along the way.
Is that the same with you, Lucy?
Yeah, I mean, we do obviously have a year-end sort of peak where we are checking and making sure that, you know, if there have been incidents, that those have been reflected. We also have regular input from control functions throughout the process, in particular for regulated employees, you know, MRTs, SMFs. We have a control function review for year end. So there's an additional, request for feedback from a different function. And that obviously requires for the control functions to be aware of who these employees are and what they're doing and how they're doing it, and kind of contribute to that debate. I think from a all year long process, we obviously look at conduct when we think about bonus pool accruals. We have, financial performance coming into that, but we also look at the non-financial elements and bring that into the discussions with the CEO and the CFO and consider whether adjustments need to be made throughout the year. Obviously, that, again, comes really to the forefront at the year end when you're actually allocating out your pool. And we also want to kind of document that we're not, using the money that we're going to reduce from Bob over here to top up this person over here, because clearly that's not what we're intending either. So I think we do a lot to try and document that and explain that and make sure that we are transparent with the regulators on what we're doing there as well.
Thank you. And I suppose flipping it on its head, how do you incentivize the right behaviours? Because I suppose we talked about the kind of the stick approach, but actually what works best from kind of the carrot approach for both of you?
Yeah, I think when Alex and I were discussing this preparing, we were sort of thinking that there's a minimum level of conduct that we just expect from people. And so, rewarding for good conduct feels almost, why would you do that, right? You're expecting that people behave in the right way. And we do have, as I said, a behavior component to our year-end performance evaluation. You can be rated sort of, excellent or exceeds from a behavior perspective. That might be you're a real culture carrier. You have, attended all of the whatever events that the firm has put on. You have done something extraordinary from a behavior perspective. You have mentored. You've done things that really we would want you to do above and beyond your kind of base level expectations. So we do obviously take that into account, and that can have a positive impact on pay at year end. And so that would be kind of one way that we look at it. But then we have sort of more regular, I think, feedback. We have an open feedback process all year long. So at any point in the year, an employee could, open up the HR system and give feedback about another employee. We gather those pieces of data, and that obviously comes into it. We also have platforms where we can, have employees share points with each other if they have, collaborated on a project. And so that sort of culture of recognizing the people that continually get seen in these things, I think, is also important, and bringing them visibility to those people. I think that's important.
I agree. Alex, did you
I'd echo what Lucy said. I think it's catching people doing the right things and celebrating it has been really, really important for us. So we've relaunched effectively some of our recognition awards in conjunction with our strategy, which is really celebrating people doing great things. And it's all linked to behavioural performance. It's kind of extolling the good and what we're at the best of our organisation, but it's also underlining the expectation as well. Granted, to some of the blurred lines and some of the areas you referenced, Nick, it's not that easy to catch, to delineate and tell people what they shouldn't be doing, but it's far easier to tell people what our expectations are and what way we want them to do and how we want them to behave. And recognise them for doing that as well. It's, clearly we're in a slightly different organisation to yours, Lucy, in terms of, we've got a strong retail bank, we've got a strong branch banking function, and that comes with some challenges as well. It's a very diverse mix of people that we're dealing with. So, but underlying that is our behavioural expectations. I referenced our leadership expectations as well. So we're trying to make sure we're really clear about the culture that we want, and recognising people, as I say, catching them doing things well is really, really important.
I think this point around rewarding good behaviour, it's been floating around for a while. The FCA has done for a long time in the banking community this 5 conduct questions programme around assessing the drivers of good conduct within organisations, what leaders are doing to incentivise the right behaviour. And the last one of those, the feedback report from the regulator did say, we encourage you all to think about kind of rewarding good behaviour. And I think various firms have, as you said, trialled kind of the reintroduction of recognition schemes or, celebration and recognition type stuff. But it is challenging, that balance between you've just done what we expected you to do in this situation versus you've gone above and beyond and you've actually helped the organisation, and we're going to specifically and explicitly recognise that. I had a question which was how widely, if at all, do you publish the negative consequences of poor conduct? Because one of the things that the regulators are quite interested in is like, do people know what the consequences are of poor behaviour?
Because we see it in the listed companies, but not
confidentiality and integrity of the employment processes generally means you don't say very much to other people about what's happened to a particular employee, but actually case studies and examples can sometimes be quite impactful, both in terms of like why did this happen, but also what the consequences were. Have you done that at all in terms of?
So we use instances in our mandatory training, for example. So there's some case studies which might be kind of based loosely in fact, which, there's some grains of truth in there. So there's lots of good, rich examples in there. We've also used various other comms articles, which again there's a message at the heart of it, which has been part of a case which we've used previously. So we're not naming names, we're not naming things that have happened, but we've been really clear about certain instances which might have breached. So competition law could be an example, mandatory training could be another one, those kinds of things which are grounded in previous cases, but to the untrained eye we're just reminding you about doing these kinds of things. So underlining what our expectation is again, but without the hard message and without the case in flashing lights.
What about you, Lucy?
I agree. I think that we tend to say very little about specific people. We would use the same. So if we had, policy breaches, we would look to whether we need to make changes to that policy, update the wording, etc., and then roll into the training or into the, hey, this policy's been updated. Here are some examples that you might want to think of, and we might use case study exactly. But yeah, for specific individuals, it's just at the moment a bit,
It's interesting, isn't it? I think also what's really powerful is when you see the highest paid people in an organisation actually being showed for doing the right thing and being great mentors and investing in their team, and that kind of thing is showcased, because otherwise it's assumed that, well, you know, a few non-financial rewards, that's not actually as valuable as someone who's paid the most. So I think actually showcasing those things is really helpful as well. I wanted to open up to the floor to see if anyone had any questions for the panel. Or online. I don't know if people online are able to. Oh, yes, there's one here.
Completely agree on the compensation decisions are... Sorry about that. Compensation decisions are obviously confidential, but I always think that advancement decisions are actually very public.
Yeah.
So I'm interested to hear how you think about factoring in positive conduct, but also potentially negative conduct into advancement decisions. And
would one of you like to take that? Go on, Lucy. You're
and lean back less quickly. I mean, so yes, absolutely, we take that into consideration, right? So again, we would, when thinking about promotion decisions, we look at past performance reviews, and that will include looking at both the objective and the behavior assessment that's been done. If there are any behavior concerns, that will definitely be part of the conversation. And we look at any incident as well as part of that process. So certainly if somebody has received any form of disciplinary sanction, that's likely to hold them back, even, lower severity, I would say, control issues or something like that may still be part of that conversation. Now, we have to consider things like Nick had mentioned, the seniority of the person. Were they doing it, unknowingly? Was there wrongful intention? All of those issues that come out when setting the sanction, I suppose. And so all of that kind of becomes part of the conversation. But you're right, it would definitely be part of the conversation from a promotion and advancement perspective, yes.
Yeah, and I think we would do the same in looking at things in the round, particularly. I can think of several promotion decisions where there's been individuals who've possibly had an error of judgment or things like that, and that's been thought through and well discussed as part of any promotion discussion. So I think we do look at it holistically rather than just as a view. We'd also look at potential coaching scenarios as well, where individuals would need that extra support with decisioning or things around that.
And I think on the positive as well, so thinking about the, recognizing over and beyond or sort of exceptional behavior and conduct, then that would come in as a positive, because when people think about advancement or promotions, they'll say, well, what about that person? Because they're consistently doing the things that we want people to be doing. So, yeah.
Brilliant. Thank you for your question. Any others? Oh, yes.
I have a question to the panel about dealing with misconduct. It's all reactive, right? It's if incident that happened. Could you share any insights or maybe something you've implemented from learnings from these incidents to prevent them happen? What have you explored to have more preventative measures, identifying sources of these? Could you identify patterns that perhaps cause these misconducts?
Yeah, I think that some of the, learnings and leveraging those in trainings would definitely be part of it. So if we see that, we have a team where, I don't know, somebody's done something at an event or somebody's posted something on social media that is, on a, in a building which is not allowed in a policy, then there could be situations where we would roll out more training. And I think that that's how we would try to make sure that people understand what we're expecting and what the policies are. I think that, that firms like ours and like all of yours, I'm sure, have hundreds of policies, and it's very easy for an employee to tick the box to say, yes, I affirm I've read all the policies, and obviously, have you actually read from start to finish every single policy that you've affirmed? Unlikely. So really, how do we get it in a format that we can really actually get people to understand what's included and what the content is? And I think that where we do see, if we have one issue that comes up, or if we have, in some cases, multiple issues on the same topic, we would definitely look to do more training or more, think of different ways in which we could tackle it, be it bringing in somebody from a senior management perspective to talk about, hey, this is what we do and this is what I expect my team to do, and therefore you should all think about it in this way. So I think just leveraging those opportunities.
Did you want to say something, Nick?
Okay, go ahead.
I would just agree in terms of we do put a thematic lens on our incidents, and some are isolated cases, some need, like you say, a policy review or further deep dive. But it's really hard to advocate for everything. And people are people, aren't they? You know, people behave in ways you just wouldn't expect and you can't advocate for. So we do look at it, you know, holistically as far as we possibly can and thematically as far as we possibly can. But you can't always capture everything, I think will be my steer.
Yeah. I think the only other things I'd add that I've seen more of a trend of that training being led by the leaders in the first line. So kind of having senior managers, desk heads, kind of take that training and own it themselves rather than HR or compliance or others taking the lead to try and own the message.
Is that led by the regulator expecting that, or?
I think partly, you know, first line needs to own the risks, but partly I think it's more effective. People will listen, frankly, if it's coming from their direct boss. Secondly, training and reinforcement of the expectations around escalation, because I think often the things that have developed are as a result of a failure to escalate or a failure to supervise, and if you'd caught it earlier, the incident wouldn't have been as bad as or as persistent as it ultimately turns out to be the case. So that kind of constant reinforcement around the ability to raise the flag, raise the hand, and escalate early. And then thirdly, some stuff around why good people do bad things, kind of, you know, because ultimately a lot of what the failures that have arisen here is not because of like genuine bad actors, but actually, you know, poor judgment by people in difficult situations, and actually trying to focus on, you know, why people can make the wrong call, not because of, you know, bad or dishonest or deliberate intent, but actually the stress of a situation or competing conflicting pressures, you know, to try and encourage that kind of risk-aware behaviour. And then the last thing that I think I would say on this whole topic around sort of trying to spot the issues early is, I think firms have invested a little bit more, I would say, in data and analytics around actually what are the early warning signs around a potential cultural issue before an incident has been escalated. So higher attrition rates in a particular area, higher noise, whether it's client complaints or compliance issues that might be a lead indicator of a problem from a cultural perspective that then says, right, actually we need to do a deeper dive here to kind of figure out whether or not, you know, the fact that 5 different people have been pulled up for use of WhatsApp or something in a particular area might be a symptom of a poor culture and an indicator of other poor behaviour. So it's that kind of picking up the lower level issues that might be the lead indicator of the kind of bigger problem to try and take that preventative action.
I think it's a really good thing to focus on, though, because actually it's the way firms review what's happened that actually has a big impact on the culture of the firm. We were looking a lot about how freezing decisions and then the malice process can put people immediately on the defence and actually not then look at what caused the problem. And as you say, it may not be any kind of bad act, it's simply the pressure of the moment and other things were going on. And if you create an atmosphere where people are immediately on the defensive, you're not going to get to the heart of what happened, and it's not going to be the right outcome for the firm. So I don't know if you want to talk a little bit about that, because we were looking quite deeply at that and trying to talk to the regulators about that as well, in terms of just trying to change the way these rules are impacting culture.
Yeah. I mean, you're the expert on this, but the REM rules on their face require you to think about performance adjustment, malice, clawback, not just where there's been, you know, bad conduct by the individual, but also, you know, failures to supervise, failure to escalate, you know, risk-based failings. And I think there's a real tension between, on the one hand, the desire to ensure that there is accountability, you know, people share in the downsides as well as the upside when the business is doing well, versus the risk of a kind of culture of fear and blame that you sometimes get because of a freezing decision that's made, which then puts them in this period of stasis where they don't know what the outcome is going to be, and they feel like compelled to defend themselves in a process rather than genuinely get to the root cause of the issue and help the organisation learn from the problem. And I think there's a bit of a disconnect between some of the kind of regulatory expectations around, you know, meaningful action for some of those risk-related failings in terms of personal consequences versus is that actually building a healthy culture within the organisation that encourages people to put their hand up and escalate. And I think it's probably not the right forum to have a philosophical debate about the REM rules, but we've made suggestions to Treasury and to the PRA and the FCA about potentially recalibrating some of those rules to kind of strike that balance in a fairer way, and whether you can, through a genuine introspective exercise around trying to figure out why something went wrong, you can actually get to a better outcome from a governance and culture perspective than simply slapping 10% adjustments on, you know, 5 different people. So yeah, more on that if you're interested. Come and talk to Alex or to me.
Thanks, Nick. Any other questions from anyone? Yes, please, Harpreet. Oh, you might have a microphone for the people online. That's all right.
Thank you. You mentioned social media and WhatsApp. Do you think employees understand their conduct expectations in that world, whether that's LinkedIn, whether that's expressing a view that they wouldn't in the workplace, or whether it's WhatsApp amongst colleagues, and how have you seen that played out?
I'm laughing at Rachel because we've seen a number of incidences in the investigations we've looked at, but I don't know if Lucy or Alex, you wanted to comment, or I can ask Rachel to comment. I don't know if I can say it in a room of people.
I think people are on a journey with those things, and not wanting to repeat what's already been said, but I think that is a potential identity. Sorry, can people hear me better now? I think it is a bit of a journey. There's obviously been a big change in terms of how people communicate with each other, and I think that was exacerbated by COVID, where all of a sudden people's work lives and home lives were a lot more joined together. And that has then coincided with the regulatory expectations around, well, actually, we care more about what people are doing in those bits around the edges. And I think it is probably an education piece to staff to make it very clear to them when things are going to be something that their employer cares about. And the regulatory changes are going to mean that some firms are going to need to move the line as to where they see acceptable conduct or not. But I think it's also for firms to think, regardless of what the regulator is saying, what do I expect of my employees, and making that clear to them so that they know where they should or shouldn't be drawing the line.
Thank you very much.
And I actually did have a question as well. So you're talking about you sort of monitor behaviour throughout the year, and that's taken into account in behaviour ratings, which sort of feed into reviews. Do you see a difference in impact in terms of that general feedback about behaviour versus a specific hit on someone's compensation for a particular incident? So you say, right, these things have happened, we'll take that into account when we decide your bonus figure, versus these things have happened in the year, as a result of that you're getting X pounds or X percent knocked off your compensation. So do you take a different approach between different types of incidents, or do you fit in one box or the other? And how do you think that impacts then on the individual and how they may change their behaviour going forward as a result of that?
Thank you. Let's go with that one. Thank you. So I think we probably see a blend, if we're honest, and it depends on the incident itself and how it was identified. If it's something the line manager's seen or something that's come up in feedback, then we would expect that to be recorded and evidenced in the performance commentary and the conversation as well. If it's something that's come to light through another means, then that's usually has to be fitted in slightly retrospectively at the year end. But more often than not, we do see it taken into account, and we do see it acted on in year as far as possible. It's not always straightforward, though.
Yeah, I mean, I think it depends on the severity as well. So, again, a relatively minor control issue may be a lower severity than a, final written warning type territory. Where you have a disciplinary sanction, we would always, when issuing the sanction, regardless of the time of year, say that that sanction will be taken into consideration at year end when making compensation decisions. And when the communication to the employee happens about the compensation outcomes, it's made very clear to them that, this is reflecting the severity and the sanction that they've received during the year. So, yeah.
Thank you. And is there anything you wanted to comment on the social media question?
No, I mean, I would just add that it's a minefield. Yeah. I mean, I think, I mean, we do a huge amount of training, but I think to some of the later discussion on intergenerational approaches, I mean, we have to be very mindful that, the younger generations use a lot more social media in different ways than the older generations that are maybe still writing the policies. And so having that intergenerational approach when thinking of these things is essential. But yeah, it's a big topic.
Very difficult. I think there's two sets of issues there. There's the kind of use of non-approved communications for firm business, where I think the boundaries are more clearly understood. I think it's more about the consequence management of that, where I think in the wake of the US fines, I think more firms have moved to a much stricter kind of potentially, 3 strikes and you're out, or very severe consequences, even for relatively benign, I'm running late for this meeting, please, start without me type stuff is kind of like, that is now potentially a breach of those policies. But I think the broader issue is the kind of, your digital footprint in terms of the stuff that has a reputational impact on the firm. You get into a spat in the comments section on a LinkedIn post or on a Twitter thing where you're not necessarily posting as a representative of the firm, but it has a reputational impact because people can connect you to the organisation. And to your point around intergenerational, the kind of 25 years of, the millennials or Gen Z coming into to the office who've got far more in that digital footprint than certainly I had, is just a real challenge. And I think guidance and training and education and awareness is about all that you can do. There's real challenges about how much of that you can even monitor and surveil, frankly, at the moment. So a lot of it ends up necessarily being slightly reactive.
Brilliant. Well, thank you all so much. I think we'll have to draw the line now. I feel like I could carry on talking about it for a long time, but I know everyone would love a coffee break, I'm sure. So Lucy, Alex, Nick, thank you so much, and thanks to everyone else for your contribution. We'll have a half-hour break and then be back here at 11:30, and for those online, dial in at 11:30. Thanks very much.
Okay, welcome back everyone. And to those online, hopefully you can hear me. We've just returned from our coffee break here. So I'm pleased to welcome Matthew Hunter from Tapestry to the panel. I'll let him introduce his fellow speakers, but they're going to cover corporate governance and investor expectations as driver of remuneration policy. So lots to cover there. Thanks very much. And you will have seen just before it flashed up, please do fill in that feedback form. You can get a free bottle of champagne, so I know I meant to remind you of that. So, thanks very much.
Thank you, Alex. Good morning, everyone. So Alex has introduced myself, but I'll let my panel then introduce themselves, and I'll start at the end with Becky.
Okay, thanks, Matthew. Hi, everyone. I'm Becky Moore. I'm a senior associate at Tapestry. I have just over 12 years' experience doing incentives and remuneration, starting at Clifford Chance and now at Tapestry. Although I had a little brief foray in-house, so I was senior legal counsel and company secretary at a FTSE 250 company.
Thank you. I'm Joel Davis. Good morning, everyone. I'm the Group Reward and Performance Director at Aviva.
That was short. Wasn't expecting that. Good morning, everyone. My name is Patricia Bradley. I'm Group Head of Reward at TP ICAP. And I'm going to be short too.
Okay. I'll be even shorter because mine's been done. Okay, so before we start our discussion today, I'm going to spend a few minutes recapping on what has happened in this space over the last few months to give a bit of context for the topics that we're going to talk about. Remuneration and the corporate governance surrounding executive remuneration within UK-listed companies is a particularly hot topic at the moment. And that's not just for us remuneration geeks, but the broader discourse as well. And by us, I meant me and Becky. I don't want to presume.
Like that.
So the Financial Reporting Council published its policy update on its updated on the revised UK Corporate Governance Code in early November last year. And it announced that it wouldn't go ahead with many of the changes that it had previously consulted on, and that included a scaling back of some of its original remuneration-related proposals, and then the amended code was published in January. Now, later in November, the Capital Markets Industry Task Force, chaired by Julia Hoggett, the CEO of the London Stock Exchange, then published an open letter setting out its thoughts on resetting the UK's approach to corporate governance. And CMIT, in that letter, argued that the governance and stewardship regimes in the UK must adapt to ensure the relevance to the competitiveness of the markets they apply to, and highlighted that the attraction, retention, and reward of talent is a key component of competitiveness. The perception being that the UK remuneration governance structures impact negatively the competitiveness of the UK's main capital markets, particularly in comparison against the US markets. And the letter contains specific proposals impacting remuneration, and that included, for example, a proposal to scrap or raise the investment association's dilution limits that apply to shares that are issued under a share plan. Now, against that backdrop, companies and incentive lawyers alike were waiting in anticipation of the IA publishing its updated principles of remuneration, which usually comes out in November, but never came, and not even as a late Christmas present, which we were really hoping for. But then, in late February, the IA published a letter to Remuneration Committee chairs giving an update. The IA stated in their letter that they recognise the ongoing debate on the need for competitive pay and, amongst other things, reiterated that the principles are designed to be flexible and adaptable to meet a company's specific circumstances, so pointing to that flexibility. Now, the IA intends to update its principles this year to simplify them, ensure they support a competitive market, and deliver the right outcomes for shareholders and their underlying clients. And I think Andrew Ninian's here later today to talk about the, so hopefully he can add some colour on that. So today, our panel is going to discuss some of the specific areas of focus and specific challenges for UK-listed companies, and we're going to do so around three topics. The The first being the competitiveness of the UK from a remuneration perspective, the second being the changing investor attitudes on remuneration, and the third being the impact on remuneration structure. All of these developments apply broader than just to financial services companies, but hopefully our panel will be able to pick out some of the specific considerations applicable to financial services companies that are impacted or competing with companies impacted by these developments. And we'll also leave some time for Q&A at the end. And so let's jump in with our first topic, so the competitiveness of the UK market from a remuneration perspective. Becky, I'll start with you. So a very nice, easy one. Do UK companies need to pay their executives more?
Thanks,
no nuance on that one, I think.
I was going to say that's not necessarily an easy one, but thanks. So I think what we've heard a lot today already is on the yes side, so the reasons why we should be paying, or at least companies should be given flexibility to choose whether to pay their CEOs more. And that's the arguments around making sure that the UK is able to attract and retain talent. It's a competitive place that can bring people in from overseas into the UK or keep people in the UK. You know, and we're hearing about major departures from the UK going to the US. We're hearing about businesses choosing not to list here and citing restrictions around executive pay as sort of maybe one of the reasons. And we've also heard today and just generally about how much less UK CEOs are paid compared to their US counterparts. And not only just their US counterparts, but within the same business, a UK CEO might actually be paid less than as someone senior in the same business as them, but based in the US. And then obviously from the panel discussion, the first panel discussion, we've heard a lot about the bonus cap being scrapped and how we've had more potential, more flexibility and more sort of autonomy for companies to look at that and determine what remuneration structures are appropriate for them. So the argument being, well, we should widen that and have that available more generally. I think the flip side, sort of the opposing arguments, which, you know, there are still some quite strong voices out there, like the High Pay Centre and the TUC, looking at the cost of living crisis and, you know, the huge pay inequality that we're seeing between CEO level and sort of average UK worker level. And, you know, around the discussion, there's also the question of, is there really a problem? You know, are we really losing that many high-profile CEOs to the US, or is it just a few isolated incidents over a sort of 4 or 5 year period? Should we comparing ourselves to the US, where EU pay, we compare favourably to EU levels of pay, and you know UK companies are performing well compared to EU companies. So maybe the other argument is this isn't such a big problem in practice. But those are two competing arguments. It's very well for me to say that sort of sitting on the outside, but I know that Joel and Patricia, you were going to talk about it from your perspective.
Yeah, I think before I say anything controversial, by the way, I should say I'm going to speak in a personal capacity, not that of Aviva investors in particular, who've got their own views about raising the companies we invest in. But I think we can all agree that we want to be competitive, and the ability to attract and retain the right talent is key in this. I think one of the things that we're in danger of shortcutting the debate here to UK against US, because I think that's the natural comparison that tends to play out in the press. The fact is, I think we just want to be competitive amongst the talent pools, the firms with whom we compete for talent. And I think Patricia and I will have slightly different, not different perspectives on this, but probably a different outcome of that fact. In that, as Aviva is a predominantly UK firm, yes, a Canadian business, but predominantly a UK organisation, FTSE 50 listed. Our predominant market is going to be the UK. However, there will be times where the right person for the role, the right person to fulfil, the role that we have, won't necessarily come from that UK environment. So I think, so rather than shortcut the debate into a UK-US and all about quantum, I know we'll talk about structure, because I think actually structure of pay and complexity of pay and perceived value of pay is probably at least as important as overall multiples and quantum. But I think that realization of finding the right person is probably at the core for us, and just that potentially that flexibility to be able to react to the circumstances that's in front of us.
Thank you. And Patricia?
Yes, thank you. I think I agree with all the points made. I think, so, and again, I'm going to speak from personally rather than to represent my company, but I will draw on my own company experience. So we have an incredibly international senior leadership team. Our CEO is French. The leaders of our two main divisions are Americans. And we have a huge global footprint, 5,500 employees, but significant representation in the US, in EMEA, particularly post-Brexit, and a really strong operation in APAC. So we have a very international business, but we're very much anchored as a listed firm in the FTSE 250. And from a pay quantum perspective, that has to be our primary frame of reference. That when we look across to our direct competitors in the interdealer broking space, we have BGC that's listed on the New York Stock Exchange. They pay the CEO lots of money. We have Tradition, which is a Swiss-listed firm. Again, not so many squillions, but certainly significantly more than our CEO is paid. And clearly, and Marek's another firm which is currently PE owned, so they do have that flexibility that somebody talked about earlier, are looking to IPO in New York. And I think in the context of the sort of US, Europe, UK debate, I think we're sort of probably quite an apposite example. Whilst we are UK listed, and we benchmark primarily against FTSE 250 firms and the NFS listed firms in the UK, we are very much aware that from a talent perspective, our competitors sitting elsewhere being more highly paid.
Yes, and we'll come on talking about investor expectations when we come to our second topic, but I think it's two really good examples of organisations that are leaning into the debate of, yes, the US is a really key market and we need to look at where they're based, and if that's the US, we need to be able to compete with them, and that could be on quantum, but also organisations where that's not the comparator, and investors need to deal with both, or allow for a structure that will enable companies to effectively compete with both sets of comparators. Is the debate too focused on executive directors? Or, yeah, so go ahead, John.
Yeah, I think partially. I think one of the challenges lots of firms have faced is that step between when, you want to potentially take someone from an exco position or senior leadership position into a UK PLC executive director position. And then for most firms, I think you're suddenly changing pay structure quite materially. So you suddenly potentially go from a structure which applies across the organisation, is pretty consistent and works, into one where you're then having to try and squash it, or you feel as if you're trying to have to squash it into a structure which is the established way in which a FTSE-listed executive director will. Lots of us here will have had conversations where you bring someone into the environment for the first time in that ED role, and you have to sit them down and explain the pay. And it's not easy, right? Because there's a lot of structure, there's a lot of limitation, there's a lot of, we'll go through the requirements later, but all of the bells and whistles that seem to have got attached as the norm is suddenly different. So I think that does cause some differences. You get, and then you have to think about alignment, and are people aligned properly, between what are essentially people sitting on the same exco. And you have to think about that step change potentially, and potentially that role does lose some attractiveness because of the restrictions, the perceived restrictions that are in place. So I think there probably is a little bit. It's not just at that ED level. It does play through a little bit at the levels below as well.
Yeah. And Patricia?
So we are a regulated investment firm, so we are already subject to quite strict requirements on deferral. So I would say, whilst yes, there are the additional bells and whistles, that our senior population, who may be the natural successors to that executive director level, are already quite tightly regulated, and we are in some respects constrained in the way that we can pay that population. But I do think it is so I do think it is broader than the ED level.
Yes, because you could have a situation where you have individuals, and as Becky was saying earlier, where organisations with significant US businesses might already be paying those people who are the natural successors, who might be leading the US businesses the same or more than the executive directors. And then in terms of building that succession pipeline and making that role attractive to individuals, those organisations are definitely going to have challenges there. Joel, a few minutes ago you talked about structure being important. Now there's a lot of focus on quantum when we're talking about competitiveness of pay. Is quantum, in your experience, is quantum the key issue, or is it the structure of the pay, particularly within financial services, that is creating the biggest challenges?
As ever, right? It depends on the circumstances, a little bit of both, but I think the structure piece is not to be underestimated, because I think we're in a position now where the perceived value is at times meaningfully less than the value that everyone sees. We've got the single figure of remuneration, which is, an established process, and that's the figure everyone looks at. If you talk, I think, to most CEOs and say, look, the report says whatever the number is, 5 million quid, they'll say, what? That doesn't feel like what's come through. By the time you've gone through a bonus deferral of 40, 50, 67%, an LTIP, which has got another 2-year holding period on, that never feels to quite marry up. So I think a lot of times that perceived value is just lower than the quoted value. And we all spend, outside of that population, we all spend a lot of time as reward people trying to make sure that the perceived value is higher than the cost of delivery, right? That's the principle we follow in reward practices and benefits design and everything else. But we seem to have got into that kind of, almost that reverse scenario where the recognized value is a lot less for individuals. So I think it's a little bit of both, but certainly the bells and whistles around the structure certainly do that. And I think, a lot of those, I'm sure we'll talk about the extent to which those are requirements against guidelines, but nevertheless, they've kind of become established practice, which is now quite difficult to unwind.
Yes, definitely. Patricia, do you want to talk on that?
Yes, I think, so we had a policy review a couple of years ago, and we had some, so this was prior to my joining TPI CAP. My colleague Medina probably got more tales to tell around the implementation of that policy review, but we got support to put in place a restricted stock plan. And I would say that structure has been incredibly helpful in allowing the EDs the space to fulfill that. We had a 5-year corporate strategy, and I think just having that type of structure, so they weren't always constantly looking to metrics in an LTIP, a performance-based LTIP, has allowed them the freedom to follow through on their strategy. And they would make the right decisions in any case, but from a pace perspective, it allowed them the breathing space in order to make those decisions unfettered by REM considerations.
Thank you. And before we move on to our second topic, and we'll come back to talking about the restricted stock plans when we reach our third topic, Becky, what is the role of corporate governance in all of this? Going to our title of the session, should corporate governance be a driver for remuneration policy?
So I think that is an easy one, and I think the answer to that is no. It should not be a driver. And I think that was raised in the first session as well. You know, what was it, a beautifully drafted deferral plan, although would give me a lot of pleasure, should not drive remuneration policy. And I think especially with what Joel and Patricia have been saying, that an over-regulation and too much kind of structure within corporate governance can really undermine the benefits of any incentives that you're trying to offer people. And that's definitely not the position that we want to be in at all. Having said that, I still do think there is a role for corporate governance here. And I think that whilst we're having a lot of discussions and we're hearing a lot of debate in the market about maybe stepping back from overly prescriptive corporate governance and corporate governance rules, I think moving to a more sort of principles-based and flexible approach will be probably where we do end up. And I think that's important, and I think there is a role here in maintaining a relatively high standard, because that's what gives investors confidence in the UK market, that there is parameters out there within which companies should sit, that there's a role for investors if they disagree with the approach that a company has taken. And you know, we've had, obviously Matthew mentioned the letter from the IA, where it talked about revisiting its principles and sort of having a look at this debate and reflecting the debate in its principles. But interestingly for me, it still talked about policing and that there was a role for shareholders to police pay. And I think it was the ISS said, you know, this isn't the, they didn't say the Wild West, opening pay floodgates, sorry, that's what they said. So that's definitely not where we're going to go. And I think that with the role of corporate governance, it will be interesting to see where we end up. It will definitely not be a driver of pay, and nor should it be, but I think there is still a role for corporate governance.
Thank you very much. So we'll move on to the second topic then, which was changing investor attitudes on remuneration. And Joel, I think I'll start with you. I think it's correct that Aviva's taken a policy back to the AGM in May, or new policy. As part of that process, have investors or investor bodies changed how they're engaging on executive pay?
I feel like I'm going to jinx it now before the vote.
To touch wood.
So yeah, I'm touching wood constantly. So yeah, we've got a new policy going to AGM in May. It's out there. Obviously, it's part of the DRR this year. It's hard to know because we've got relatively limited changes. What I would say is, you know, investors were receptive, responsive. You know, we had good dialogue around them. Ultimately, the changes that we've put forward, we felt it was working quite well. So the changes are limited. In any case, so it's probably not a test case in terms of, you know, what the response would be like. I think through this kind of reporting season so far, we've seen a number of firms signal that they'll be coming forward with something. I think a number of banks have softly signaled that, so that would be very, very interesting to watch. And I think there's an interesting Glencore plan that's come through recently around career shares, which looks like, you know, there may be some, of course, some debate. I think one of the things which will be a challenge is just where the capacity comes from for shareholders and proxies. If there is a lot more, you know, if there is more flexibility and firms try to put forward different cases, I think those of us who've been through different cycles, either advising or in-house on policies, will say that, you know, if you're on the 3-year, you know, last year was a year for probably half the FTSE put a policy forward. If you're on that standard cycle, there needs to be an awful lot of capacity in the system if we're suddenly going to get a lot of new and different policies going forward. So it'll be interesting to see how that plays out, and whether actually we're probably a good example in this, in that you feel at the moment there's a need to, if not formally consult on a policy, but any changes you're making, maybe some measures that within the policy framework, but there's some change, you've kind of felt the need to talk to shareholders in advance. And maybe that's where some of the capacity comes from, because I think sometimes you're doing it to check in, you know, on relatively small things, and maybe that's where some of the capacity comes from. If there's a little bit more flexibility at that end, it creates some space for what are more meaningful consultations.
Yes, and I think part of the challenge is obviously if you're engaging with your investors, that you can have those meaningful conversations. But I understand part of the challenge is that there's a disconnect internally within those organisations between the people who are maybe handling the investments and those who are doing the kind of tick box exercise of going down what their proxy guidelines or their voting recommendations say? Is that a challenge that you've come across?
I think so. I mean, when you talk to our, if you talk to investor relations team and, chairs and NEDs, etc., they will often report back on what are slightly different conversations, because ultimately they're talking to different people than we talk through when we go through the process. Whether we come to a point where there's almost a two-tier process, if you like, around meaningful change against less meaningful change, I think that is a challenge. The conversations with ultimately the fund manager and the person making the investment decision can feel very different to those who are running through the governance process. So it'll be interesting to see whether organisations are built for a more flexible approach and whether there's that capacity in the system.
Yes, definitely. Patricia, do you want to add anything on that?
I would say yes. We will be going with a new policy in the 2025 AGM, and we'll be looking very closely to see how investors react to policies taken in the next few months. And I do hear that there are some racy proposals out there. But I do think that the proxies and investors are probably in a sort of feeling their way mode at the moment. And I think if we're going to move towards a more principles-based approach, it does rely on having the time to have those meaningful discussions, to bring the corporate strategy into play for setting the context of remuneration. And I think we're lucky that we're counter-cyclical against most of the market, although that is tending to, as companies go out of cycle, that sort of big concentration every 3 years seems to be diminishing. But I think we had some very good discussions with our shareholders last time, and hopefully have the same this time next year.
Yeah, I think I would agree with all of that. I think what I'm hearing in the market is there is definitely being a shift. I think it's slow process, but there is a shift in the market, just in terms of, rather than investors dismissing these more sort of racy, I think hopefully they'll become less racy, but dismissing those sort of suggestions and policies out of hand, what we're hearing actually is that most investors are prepared to sit down with companies and understand why the company thinks it's appropriate for them. I think what I am hearing is it depends on the institutional investor. So some investors are prepared to do that, and others are still saying, no, we are literally voting based on the sort of the checkbox process that you mentioned, Matthew. So it will be a case of sort of testing the water this year with those that are prepared to engage. How do they manage their resource? For those that aren't prepared to engage, why not? And are they prepared to shift? And I think going back to the CMIT letter that you mentioned, Matthew, one of the points that they raised on all of this and that they wanted to see a change on was investor engagement and having a more formal process around that. So it may be actually that if we really do want to move to a much more principles-based approach to corporate governance, with companies having more autonomy and flexibility, then absolutely hand in hand with that, there needs to be better investor engagement and maybe more formality around investor engagement.
And turning to some of the recent publications from the investor bodies, Becky, what are you seeing as the key areas of concerns that are still coming through in the most recent round of updates from ISS and Glass Lewis and those kinds of organisations?
I think it's quite an interesting question, because before this year we would have really focused on that. We would have really looked at the detail of what all the different institutional investors were putting out there, and then sort of sitting down with people's DRRs and DRPs to make sure that they were complying with that. And we did that. Legal & General and Glass Lewis issued updated guidance at the end of 2023. And we had a look at those, and it was sort of no material changes, but as you would expect, a real focus on pay for performance and sort of looking at the details around that. But that was before the IA published their letter where they didn't update the principles. And it's felt like even since Legal & General and Glass Lewis published their updates, the market has shifted again. So what will be really interesting to see is for the likes of Legal & General and Glass Lewis, they publish their updates and then the market has shifted. So how much will they stick by what they've put in their updated guidance, and how much will they be prepared to kind of shift a bit on the edges? There are points that we can draw out. I don't know if you want to cover them now or in the structure section.
Go ahead. Yeah,
okay.
while you're on it.
I don't want to jump to the wrong bit, but so Legal & General, their updates were a lot more prescriptive. They added a whole new section on their expectations around bonus. But I think what was really interesting from all of the updates we were seeing is a real focus on performance conditions. And so nothing major, nothing material at all, but just a slight shift in language to looking at things like making sure that they can't be easily manipulated or open to external influence, which felt sort of quite negative. But I found it quite interesting just to tie it back to the debate, which is if you are giving companies more flexibility to increase quantum, and let's say that might be increasing your maximum LTIP opportunity, then if investors are prepared to accept that, then maybe actually what they're going to be more focused on is the performance conditions for that LTIP, and do the performance conditions meet the expectations that they've put in their guidance? So I think, to answer your original question, sorry, Matthew, which is, what are institutional investors saying? I think nothing material, focus on performance conditions, and pay for performance.
Brilliant. And going towards the start of what you were saying there, you talked about the pointing to the flexibility that might be available and how we've had the recent publications from Glass Lewis and other organisations where they've gone down the route or down the pathway of potentially more rigid, but then since then the debate has potentially changed. I think what we've seen in terms of the IA letter where they talk about flexibility and how the principles are not rules, they're guidance. And the FRC was very clear when they updated the policy this time, or updated the corporate governance code this time, that it's comply or explain, not comply or else. And we went to an event where the FRC was speaking, and they were very clear on that point and recognised the challenges that organisations have dealing with their comply or explain approach, where the investor bodies, the Glass Lewis's of the world, are not then allowing that flexibility, either because they haven't engaged or because there is a disconnect that we talked about earlier between the people who are managing that checklist and the people who are actually then engaging with the organisations.
Yeah, I think if the level of flexibility and pragmatism that comes through is real, that's great. And a change in that, I think everyone would welcome. I think one of the issues firms have faced is that at times it's felt as if you could have the same outcome for what could be a relatively minor infringement of what's perceived as best practice, right? Whether it's around the detail of a shareholding requirement or the detail of a retirement allowance not being fully in line with the rest of the UK population, you kind of get potentially the same outcome as trying to double your LTIP. Yeah. And I think because of the way, we could talk about, the register, if you fall below the 80% or the 20%, depending which way you look at it in terms of the vote, has led firms to feel maybe a little bit paralysed in terms of what debate they're willing to have. Because particularly if I think you have a profile as an organisation, and depending on the organisation's level of risk appetite for what they want to play out in public, that can change your view. So I think it's felt a little bit paralysing at times because those things, that lack of flexibility hasn't been there, or the lack of the ability to explain. And I think if you look at the proportion of shareholders that are actually voting, and we've seen that fall, I think for most organisations from, I think from kind of 70-80% of shares being voted down to even 60% in a lot of cases, you can quickly trip over that 20% against Mark with 1 or 2 shareholders. So I think a combination of those things, that lack of flexibility perhaps, they're not treating all issues equally, and then the potential for the vote to turn quite quickly.
And so on that point, in the CMIT letter, it was proposed that 20% naughty list, that be removed for significant votes against the 20%. And of course, that would have an impact for remuneration. And do you think companies would feel more comfortable then if they didn't have to disclose, or if there wasn't this list, this register, setting out the companies with significant votes against? Patricia?
Well, I remember a time when pre that naughty list, when there was a debate around, well, what is an acceptable vote, and about 80% was about the mark, wasn't it? It was considered, in those remuneration committee conversations. Well, if we get 80, that will be good, and I think that's right. You're in the sense that you want to bring the majority of your shareholders along with you on the journey. You have that alignment, and at TPI Cap we're very much in favour of shareholder alignment, both in the way we pay not only our executive population but also among our all employees, and Tapestry have been helping us along that journey to bolster shareholding among our wider employee population. Because I think that is actually the right thing to do, that you are supported by shareholders, and you should have one eye on that, at least one eye on that.
So turning now to our third and final topic, so the impact on remuneration structures, and noting what we've just discussed, and Patricia, coming back to you again first, do you expect remuneration structures to change maybe over the next 3 years, and if so, how? And recognising that you've got the restricted share plan in place as well, what are your thoughts?
Well, as I said, we successfully put in a restricted stock plan a couple of years ago, and it is working extremely well for us, and gives our executives the ability to set the strategy without fear or favour. But I would say, again, we have within that construct a 2-year holding period at the end of that, once awards have vested. We have actually quite rigorous underpins so we haven't actually, the first award will vest next spring. So it will be a very interesting debate as to how we test those underpins. And I think whilst it's given us flexibility, there is a piece around moving towards restricted stock plans for other companies where there's that toss-up between, do we want to go for that, having an apparent greater flexibility, but we're still being held to account on the underpins that may look and feel a bit more like performance metrics that we've just forfeited. So I do think for us it will be around understanding whether that restricted stock plan is still working. It is so far. We're not looking to do anything racy, I don't think, but it very much focuses, because we've got flexibility on the restricted stock plan. Everything is very much focused on the bonus scorecard, which is very flexed to our profitability. So we're being held to account on that annually. We'll see how we're going into debates now around whether we want to make any significant changes. I doubt it. It seems to be working well in the same way, Joel, that you're going through your review now.
And I think on the RSU one's interesting, because I think if 3 years ago we probably expected, or the industry expected, more of a march towards RSUs than has potentially actually happened. It'll be interesting to see if the split model takes impacts. I know that's been mentioned, and that's one that causes a lot of interest. So whatever it is, half in RSUs, half in performance shares. I think the RSU piece, I think the experience of some firms in terms of the discount rate that was applied, which I know is in the CMIT letter, and also the underpins starting to look very close to performance conditions, so you almost got the worst of both worlds rather than the best of both worlds, I think has maybe restricted the use of those, but it would be really interesting to see if any other models start to emerge.
Yeah, and Becky, what are you seeing?
Yeah, I think that in terms of where we think we might go on structure, the obvious sort of shift, if we are comparing ourselves to the US, is to the hybrid and using more time-based awards rather than just performance-based awards, and or even just increasing quantum in terms of LTIP opportunity. Those are probably the two sort of easy shifts that we might see. In terms of what investors are saying about it, well, as I said, Legal & General published their updated guidance before the IA, and they were very much still of the school of thought that if you are going to do a restricted share plan, it has to have all of the discounts and the restrictions and the underpin that investors were saying they expect to see. And that they said, this is Legal & General, they said that they still have a strong preference that you have an LTIP rather than a restricted share plan. Again, what will be really interesting to see is do they shift on that in this kind of remuneration round, or do they just sort of stick to that for now and see where we go as more and more companies put different policies to shareholders?
Yeah. And that was one of the points that was picked up in the CMIT letter as well as one of the specific proposals, that the 50% discount that is expected where you transition from an LTIP to restricted shares, that be removed, so you could give that larger LTIP opportunity. So yeah, it'd be interesting to see what happens on that. We've talked about, in terms of the structures so far, we've talked about variable remuneration structures. Do you think that's where the focus is going to be, or are we going to look at some of the other elements in terms of the fixed, the pension, other elements as well?
I think maybe some simplification in some of the other elements, or at least the kind of halting of ever more kind of specific, detailed requirements around some elements. And again, I think that drives us back to looking at what we're trying to achieve through the plans and variable pay plans in particular. So I don't hear as much noise talking to people generally around things like salary levels specifically. I think there's some elements of that. It's quite difficult to move a salary once it's in place.
Yeah.
Which puts a lot of pressure on the initial salary, because in any other role in an organization, if you found out somebody was meaningfully underpaid against their peers and there was a retention risk, you'd probably change the salary, right? That is very difficult to do for an executive director, or you're certainly taking some risk in doing that. So while there may be some changes on flexibility on that, I think variable pay and the delivery of pay in particular are probably the areas that will probably get most attention.
Yeah, and Patricia, do you agree with that?
Yeah, I think that's right, and I think in the context of the sort of cost of living piece that we've been living through, and I think that remuneration committees are absolutely aware of the broader context and ensuring that their employees are being appropriately rewarded in an inflationary environment. And I think it's only right that the fixed pay debate is around that more broadly than necessarily the ED level, where, as we know, it's the multiplication through the package that brings the debate into focus. So I think it probably will be around that variable piece, performance related, because that's where the alignment comes.
Great, thank you. Oh, go ahead, Becky.
Well, yeah, I think the only other element to add to that is going back to what we're talking about in terms of investor engagement and bringing the investor along with you. What I've been hearing is that people who do want to increase quantum are getting a lot more traction if they suggest an increase in LTIP opportunity rather than, please may I increase fixed salary. That seems to be getting a no, whereas increasing LTIP opportunity or looking to bring in like a hybrid plan is getting a little bit more traction.
Mm-hmm. Great, well, thank you. We have time now for Q&A, so any questions, please let us know. There's a microphone going around.
Does
Questions?
this mean we just covered it all?
Yeah,
Actually?
we've solved it.
Solved corporate governance.
That's the only possible conclusion, I think.
Yeah. Okay, it doesn't look like... Oh, go ahead, Charles. There's a microphone coming.
Thank you. Charles Goodway, Standard Chartered. I think one thing, and we sort of touched on this a bit earlier, but it'd be interesting to get your thoughts around particularly proxy bodies and the impact that they have, because we talked a lot about the corporate governance code itself, but in some ways it's often the requirements that are set by proxy agencies. You know, obviously the investors themselves, they probably have a bit more legitimacy, if you like, but proxy bodies, they're representing a broad range of investors, and yet they can have a big impact on the vote. You know, that might be 20 or 30% of your vote, and it'd be just interesting to see what the panel's thoughts are on the role that those agencies play when they almost put their thoughts forward like regulation in its own right, if you like. So I just wanted to ask you that question.
Personally, I think it comes down to knowing your share register really well. And obviously we used some third parties to monitor voting intentions, but I think when you need to know your share register very well and understand which of them you're going to have direct dialogue with. And I think with the rise of certain asset managers, particularly index, if you're in the FTSE 100, you can have a fairly significant shareholding with a small number of investors. So for them, I think it becomes more important to have individual dialogue, and it is probably less likely that they're relying on the proxies. But again, if you are an organisation with a large number of 0.5 to 1.5% investors, I think that's when it becomes a little bit more difficult to predict, and you're probably at the whim a little bit more of those proxies. Have you got a similar shareholding or different?
We have quite a concentrated shareholder register, so I think the top 6 shareholders make up nearly 45% of the register. So, but it's not. Nevertheless, we don't want to ignore the remainder. So I think it's being mindful, isn't it, about what the particular preferences are of proxy agencies. You can't meet everybody's expectations all of the time, but I think overall, if you're able to, on disclosure, for example, do the best that you can on understanding what general principles ought to apply, pay for performance at the end of the day, I think you can't go too badly wrong.
I think there's probably 2 elements on the proxies. One is the voting intention itself, and second is the larger proxies coming out against you is a story in itself. So even if it's not dragging that much of the vote, it's a story which then generates a narrative that you're probably trying to avoid. So I think there's a couple of reasons for trying to manage the proxies, even if you don't feel they're going to have a huge impact on the vote itself.
Okay. Great. Any other questions? No. Well, thank you very much to my fabulous panel, and to Becky, Joel, and Patricia, and thank you all for your time today.
Very well. I'm particularly interested in just focusing on when you're competing with all these different companies in completely different markets and jurisdictions, and it just sort of emphasizes how much we need flexibility in all these frameworks in which we're operating. Otherwise, you can't make it work. But thank you very much. So we're now going to have a talk on pay transparency just before lunch, and then we'll break at 12:45. So I'd like to welcome up Philippe Salins from Loyens & Loeff, who's going to talk from an EU perspective, obviously, about this important directive. But obviously, it should be of interest to everyone in the room because you've got EU operations, but you will also be talking to employees in other places that will be very interested in this directive. So I'll hand over to you, Philippe. Thank you.
Thank you, Alex. Here we are. We have 20 minutes between now and lunch to tackle the EU pay directive on pay transparency. And I'm happy to navigate you through to this piece of Brussels, so to say. I prepared some slides. They are also in the documentation deck afterwards, so you have these slides. I think it was helpful to have some pedagogic approach here. I'm going to talk about the why. Why is there a EU pay transparency directive which has been issued? I'm going to talk about the key elements, what is in the EU pay transparency directive. I'm going to talk about the timeline. I will come to the timeline in detail. It's a directive, which means that the 27 member states have 3 years now to implement it into national legislation. So it's the broad principles which are in the directive, which has been published last year, and there will be implementation by each member state of the directive. We'll come to that on the timeline and on the possible deviations from the directive in itself and the impact it may have. Do you have to wait as a company for these 3 years? No, I think it's better safe than sorry. So you could already think on preparing some of the substantial work to advance what will come. And then I will have some observations on context, because this directive is not working in isolation. It will interfere with other pieces of European new legislation and old legislation. So, first of all, why is there a EU pay transparency directive? In a way, this directive is not really, you don't have to blame the bloc for that too much. It's not in a vacuum. This thing is not coming in a vacuum. We heard this morning, pay transparency is rising as a concern in South America. I have here in front of me the invitation of the Annual Conference on Labor and Employment of NYU, School of Law, in May, and they have a session on pay equity and pay transparency, because also in the US you have a lot of initiatives on on pay transparency. So it's not so abnormal that the theme is on the table of, has come again on the table of Europe, and more in particularly the why question in a European context is logic, because we have of course since decades this principle of equal pay for equal work. We have the directive of 2006 who's saying, okay, the same work or work for equal value needs to be remunerated in such a way that there is no discrimination. So that's already, in a way, stoned into European laws and into national legislation. But this thing had to be evaluated, and it was evaluated in 2020, and there are a lot of deficiencies which are identified and which are not proper to the EU, which are the same deficiencies that are identified, I would say, more or less globally. There is a lack of transparency about remuneration in companies. Some have more transparency than others, but in general, this is a concern. There's also some hurdles for employees or workers to ask questions or even to initiate action to say, well, is this right? Am I fairly paid or not? So there are some procedural obstacles which were identified, and also the lack of information in a way. If you want to make a claim to say, well, I'm unfairly paid because I'm doing work of equal value as my colleague, but do you have the data? Okay, can you really materialize that claim? So it's a bit of having the data to materialize the claim. And then, of course, we have the persisting factors which we all know and which I think are publicly known, the stereotypes about gender, the glass ceiling, which is still there, the overrepresentation of women in low-paid sort of jobs and so on. So there's a bit the classic, I would say, arguments why there is still a concern about a pay gap. And just to give some data, and it's not about shaming or blaming countries, not at all. It's just to give you statistically there is still a concern. If you look at the column at the left, really at the left, it's the EU. There you see that there is a more or less 12% of what we call a pay gap, which is the difference between the average gross hourly earnings, male and female, as a percentage of the male. So there is on average a 14–30% problem. Some countries are doing better and others not. Is this okay? Is this right or not? It's statistics. You can prove anything with statistics. So it's just to prove you that there is still some room for improvement. And also I took liberty to give a reliable UK source annual survey of the Office of National Statistics. And there also you see on 2023 that basically all in, you arrive at 14% of a pay gap. So there is for the union a concern. The concern, in the opinion of the bloc, should be addressed by, or could be addressed by some measures, by some measures, 4 measures basically, that they would like to implement, to have seen implemented, and which they think, if they are implemented in each member state, will improve basically, or will reduce the pay gap. And the 4 measures are, first of all, the pay transparency prior to employment. There are some measures which will be imposed. We'll come to the details in a moment. Pre-employment, before the job. Then there are basically 2 measures that will be imposed when you are in the job about transparency on your pay level and your career progression. You will have an individual right as a worker to get some information about the pay and about the place of your pay in the entire pay structure of the employer. And then there is an employer obligation for some companies, we'll come to the details in a moment, to do some reporting on the pay gap, on this famous percentage within your company. If things goes wrong, then the directive says, well, if things goes wrong, you will have to do some joint pay assessment, employer with your union representatives. You will have to do your homework together. And if things goes really wrong, then there are remedies and enforcement that will be implemented. So that's basically these are the building blocks of how the directive is structured. So coming to the first 2 elements, the pay transparency prior to the employment, it's pre-job. So it's really for candidates to apply for a job. A bit of the concept here, we are talking in the directive about employment contract. So it's really the broad concept of employment contracts which is targeted. But that can be very broad. It's employment contract, it can be trainees, it can be any notion that in the legislation of the member state will be qualified as an employment contract. So it could also be a platform worker if that platform worker under national legislation would be seen as having an employment contract. The obligations are for employers. So it's really targeting the relation employer-employee. And the two key things here are that any candidate coming to a job for a vacancy should be given prior information about initial pay level or the pay range and the relevant collective agreement. So you basically should know beforehand how much you're going to be paid, which will in some companies be already the case, but in many, many not. And another very important rule is that the employer will not be allowed anymore to ask about your pay history of the work. And one of the specific reasons why that is implemented is that anecdotal and other evidence shows that too much cases are that you are coming to a job, the employer is asking, well, how much are you paid now? Then you give a figure, and then the employer is saying, well, that's nice, I'm just going to match that, that's fine. Or I'm going to do a little add up, and that's fine. But it's less than what basically in the banding of that job should be given. And by having the obligation by abolishing this information question, the directive hopes that there will be a much fairer way of entering into the job in terms of pay range. So that's about entering the job. These are the key elements of candidates, so to say. Once you're in the job, there is an obligation through the directive to say, well, the employer needs to give the individual workers transparency about pay level and career progression. So at one way or another, the employer will be organized in such a way that he will develop to the workers the criteria that will define pay levels, and pay progression. Pay, again, we are in the relation employer-employee, and pay is a broad sense, a broad notion of remuneration. Everything which, as per your national legislation, will qualify as remuneration falls under the notion pay. So it's fixed pay, it's variable pay, it's bonuses, bonus schemes, how are they organized, how are they set up, it's benefits. So everything is the broad notion, so to say, of pay and benefits, which is captured here. And pay levels is defined as the annual global remuneration, it's the annual remuneration. So it's a very broad sense. It's not just a matter of giving the base salary or something. It's having the entire scale of remuneration and benefits which will be at stake here. And also employers will have to organize themselves in such a way that they will explain to the employees how the pay progression over time will be possible. So this has to be, again, defined, refined, specified by national legislation. How it will be done by each country, there is room for flexibility and room for deviation, but the basic rules are that you will, as an employer, be obliged to give this information. Employers with less than 50 workers may be exempted by the member states. These were the two general, I would say, pre-job and general obligation for the employer vis-à-vis the pay level transparency. And then the third element is a specific individual right to information. Each individual worker will have a right, has to be ensured a right, that he or she will be informed about their individual pay level, where are they in the scale of the entire pay structure of the employer, but also about average pay levels, broken down by, on basis of sex, categories of same work and categories of work of equal value. And this is, of course, a bit of a hot potato notion, this equal value work. What is work of equal value? The definition that the directive gives is to say, well, it is work clearly that can not be discrimination or must be objective, so not discriminatory and not based on sex, but based on criteria like, and they are given as an example in the directive, skills, effort, responsibility, working conditions, any other factor that is relevant for the specific job or position. And there is in the directive one example given, for example, that soft skills, it's just like that, quote unquote, in the directive, soft skills should not be undervalued in this evaluation of work of equal pay. So there is a bit of work to do there by the employers, by consultants, by benefit consultants, by lawyers to say, how can we organize a comparison on the basis of these objective criteria and maybe other criteria that will enable to judge that people who are comparing, that we are going to compare apples with apples and not apples with oranges. That's, synthetically speaking, I think the exercise that will have to be done. And the thing is that each individual employee will have the right here to ask their employer, okay, explain to me my individual position, what's the pole star here, where are we going towards, working towards in terms of remuneration, where I am, and where are the average pay levels of all the people around me who are doing the same work, identical work, or work of the same value. That's quite a lot of things to be brought to the table, but clearly these are the things that will be a right to be requested by the worker or their representatives. Anytime in the directive when they talk about workers, of course they work or the representatives, and then it depends again on the local implementation of the member states, whether that will go through works council, unions, cascading to the typical employee representative organs that we know in each member state. The thing is that if the question is raised in writing, the employer has the obligation to answer. He cannot simply say, nice question. He has to answer. Maximum 2 months' time to give a written answer. And also, that's kind of, the directive wanted to put a kind of reminder into the mind, because you can, of course, start your employment and you can be silent on this right? So, but the directive says, well, there needs to be a mechanics that every year, everyone will be reminded that they have the right to ask about this option. The question, of course, is, are people going to ask it? We're not going to elaborate on all this. Are people going to ask it? We have the relation employer-employee. We know it's a relation of authority. How stimulated will you be to ask this question? Will it be a safe question? This all deals with social safety and more informal relations, but that's another debate. I don't think that debate needs to be discussed here, but of course it will be part of the yeah, the proof of the pudding will be in the eating, and the whole eating will be, is your HR environment inclusive and diverse and safe, in such a way safe, socially safe, that people are free to speak and will be okay to ask this question? Or will it be a bit question of what are you asking now? So all this will be to be worked out. But the essence is that the individual right is clearly explicitly into the directive and should be honored by each member state. So then we go to the more general obligation for employers as of a certain level of workers to report on the pay gap. And the pay gap, remind, is indeed a difference in percentage between the average pay for female and male workers as a percentage of the male workers. So the pay gap, if there is any pay gap in your company, needs to be reported. This reporting is a bit a subtle reporting obligation. The general idea is to give the average pay gap, so you don't have to individually spell out each one's pay gap. It's a general approach. It's an average pay gap between men and women in percentage. But it's not only the pay gap in total, it's also in blocks. Complementary and variable components needs to be in a block. You need to really build up different blocks of these comparisons, and also the median. And the median is, as we know in statistics, the median is you take all the male employees, and then you will have the median, the 50 plus and the 50 min. You take the median for the female, and if there is a difference in median, is also one of the elements which needs to go into the reporting. So it's a bit of an elaborated thing, but it is a requirement to report on this, not only to the workers' representatives, but also to some monitoring body that each member state will have to set up. So that's a bit the same thing as they did with the whistleblowing and with the GDPR. It's you have a monitoring authority, and that authority will need to receive these reports. Now, what's the frequency? What's the obligation? Workers with in the book, in the handbook of the block, what is a big company? It's 250 or more employees, so they have to report annually, and then between 100 and 250 every 3 years. So it's a less frequent reporting, and less than 100 employees, it's a voluntary reporting as per the directive. I'll come to that in a second, because gold plating could be the case by member states. Now, if things goes wrong, I said, then you need to go through some corrective action together with your unions or with your works council. What is going wrong as per the directive when the average pay gap would be more than 5%? Then the directive said, well, that's an alarm bell. If your difference is more than 5%, you will have, and you don't have objective, justifiable criteria why it's more, then, and it's not remedied, then you have to sit together with your unions and you need to go through an assessment. Why? You have to answer, why is this the case? You have to flag the differences per category, per level, and you have to discuss measures to address it. That's the corrective action as a kind of internal assessment together with your HR team, together with your unions, if you report on a persistent basis that your pay gap is more than 5%. It's quite a hefty percentage. Maybe you will find objective reasons why it is the case, and that's a matter of working you through. And the joint assessment analyzes everything, the percentage, the differences, measures to address, and the remedies to act in a reasonable time. And if things goes really wrong, for example, you have a pay gap of 10% and you say, well, you know what, pay assessment, I'm not going to do that. We have other things to do. It's not important. Not on the top of our list. Or if individual workers ask the whole time about their position, you don't give answers. So if the entire 4 obligations are not complied with, then the directive is saying, well, we want you, member states, to go through enforcement and remedies. Damages needs to be paid uncapped. So if someone can demonstrate that for years he or she would have been detrimentally paid not enough, then the entire recovery should be paid. So it's not a kind of per diem damage or a lump sum damage, it's real damage, if damage of course can be proven, but that's the last point, on the burden of proof it's a reversal. So it's the employer who needs to give the proof that there was no discrimination or that there was no problem with compliance. So it's a reversal of the burden of proof. It's a full recovery. There is a classic recipe in the directive's protection against victimization and less favorable treatment. So if someone rings the bell and complains, you cannot fire him for that. So it's, you cannot retaliate for that. So it's a protection against someone who basically address the issue. A member state must ensure compliance through introduction of effective, proportionate and dissuasive penalties. That's reading fines, financial fines. Court orders could stop infringement of the obligation. So that's, I would say, more or less the classic recipe that the directive of that Brussels uses to implement this type of obligations. Now, coming to the timeline, last year, that's the middle red bullet, was the entering into force last year, 6th of June. So there is 3 years implementation time. So no rush. This thing is not yet in effect, but it will become in effect through each member state's their legislation at the latest in June 26. That means that at that time, at least everything except the reporting will be effective. You will be prepared. You will need to be. Businesses will need to be prepared to comply with that. In terms of reporting, the year after, so in 27, the plus 2050 employers start to report about a pay gap, and then every year again. And the companies with 150 and 249, they also start to report, but then from that moment, from 27, every 3 years. And the, let's call it smaller companies, as per the reading of the directive, they have time, so between 100 and 149 employees, they have time until 31. So there's a bit of a long way to go. But on the other hand, I would say, or we would recommend, yeah, better safe than sorry. It's, you have 26, then, yeah, legislation will be in every member state more or less implemented. You have budgets to run. Salaries are part of budgets. A budget of 26 will be decided in 25. We are now, yeah, let's say the middle of 24. So all these things needs to be worked through, and it is good practice, I would say. We would recommend, I think all the professionals in the room, internal, in-house and ex-house, will recommend it's maybe a good idea to run internally and with some consults a pay audit to see where are we with these rules, if we would apply them, to do some reviews of your policies, about your transparency, about your recruitment process. How happy are you if you would really bluntly apply all these things, and how can that fit into your HR policies, and try to think already on how these policies would work. It's of course a bit difficult to think on them knowing that, and that is the context I would like to touch on, knowing that first of all there can be gold plating, and there's an explicit article in the directive is saying this is directive, but every member state can do better. So there is a possibility of gold plating, and there is a possibility, and that's an unfortunate effect of the directive, which you all know, of course, that, yeah, we have seen that with the whistleblowing directive also. It can be different in 5-6 member states, and then you have a group where you have to comply. You have one, from London, for example, you have one HR, one salary policy, and you want to roll it out, or you roll it out from the US and you roll it out through whole EMA, and then you have these obligations which may differ from country to country, and the individual rights of workers may differ from country to country, but that's the thing we'll have to navigate. It would not be the first thing that member states would, not completely, but would have really different angles and obligations. So the gold plating could be a case. What I would recommend also in this particular exercise is to look to the left and to the right, because this is the Pay Transparency Directive. But for example, the IE Act, it's a regulation that is for all the member states the same, which has been enacted also this month, is very explicit about the unacceptable tools, i.e. tools, and the high-risk tools. If you read through all the applications, HR is in all these. So HR processes, whether it's in recruiting, whether it's in rewards, in promotion, and if you will be approached by experts saying we have a fantastic tool to calculate your pay difference and to make sure that your jobs will be valued equally. If the underlying use of these tools is artificial intelligence driven, they will be at that moment, they will be, I'm pretty sure they will be into the notion of high-risk artificial tools of the AI Act. You will have to make absolutely sure that if you use these for your tools and methodologies, that they are waterproof under the IE Act. That's one. And this is, for me, an intrinsic risk, because IE and HR, that's a match made in heaven, but it's an absolute minefield if you will look at it from the IE and maybe from national legislation that will follow on this theme. So that's one, and that is a particular concern also for non-EU-driven exercises, because if you're doing this from London or from New York, and you do the exercise on your entire pay structure with the tool, with the IE tool from here, but you use it to implement it in the EU, it's caught by the AI Act. So it's not because you are using it outside the Union that you're free to act and that you can use it. If it's applied for application of HR mechanisms in your group in the EU, it's caught by the EU Act. And the second, that's the left, so to say, and to the right, you have GDPR. Because every company will also have to be very mindful not to breach GDPR. If you have an investment manager group team with 5 male and 1 female, you are going to make averages. Everyone knows how much the female, if she's the only one, will earn. And if you do that, you risk to breach GDPR. So privacy and GDPR and the EE Act are, for me, the left and the right window to keep an eye on when you are going through the preparation or in 2 years to really the implementation of this legislation coming up. So this was more or less the summary. I hope, I think we're ready for some questions. If there are questions, otherwise you ask them during lunch, and if not, Alex, yes.
Is there a market rate defence to any of this? And I know that's the million-dollar question whenever there's a gender equal pay. It's sort of, well, we have to pay what the market commands. I'll give you an illustration. Chelsea Football Club has a men's team and a women's team. They wear the same kit, they kick the ball into the same goal. But as we know, the Chelsea men's players get paid a lot more than Chelsea women's players.
Yeah, but
so
it's true that the last transfers, I follow that also, the last transfers of female top football stars have been increasing substantially. I think last month there were 2 high-profile transfers, and so I think these will have to be narrowed. The whole thing is, if you would launch the exercise on the compare whether that is work of equal value, so to say, and you would not find sufficient criteria why to say it's different, that you may run into a problem. But I see where you're coming from. Yeah. I don't think that the market as such is not a criteria as such to be part of the objective criteria to compare. I don't think that the market, because the market can be a very strange animal and is not necessarily non-discriminatory. So I don't think the market would. But in the compare of the work, there clearly you could the skills, etc., etc. It's a matter of going through the exercise, yeah, but not the market. Yeah.
Lots to think about there, and I think if you haven't already, you must let your remuneration committees know about this directive, because, well, not just to secure budget, but to get them focused on all the work there is to do. So we're going to break for lunch now. We've got just under an hour. We'll meet back here at 1:45. For those dialing in remotely, you can join again at 1:45. And I'm doing a tag team with my colleague Bradley Richardson. He'll be taking over the chairing in the afternoon. So thanks very much, everyone.
Now. Thanks, everyone. If we can make a start, that would be, I think, make sure we get to afternoon coffee on time as well. Brilliant. So, welcome back for the afternoon sessions. For those online, welcome back as well. For those of you who don't know me, I'm Bradley Richardson. I'm a partner in the Linklaters Employment and Incentives practice, one of Alex's colleagues. And it's great to be here to try and guide us through and keep us on time for the afternoon. I think just a quick sort of reflection on the first few sessions this morning, which I think from coffee and discussion at lunch was everyone has found really engaging. I think there's a great range of topics on the agenda there, so hopefully something for everybody. The first session obviously touched on the changes in the bonus cap, one of the hot topics at the moment for discussion. But I thought the panellists brought out the different perspectives on that really well. Whether it's going to be a big bang change or not. And I thought Stuart's reminder at the end there that we're not removing the bonus cap, we're in fact setting our own risk-based ratios going forward, I thought was a really good sort of takeaway from that session and sort of one to frame that discussion. Hopefully you all found the panel on non-financial misconduct interesting as well. I think that undoubtedly is an area of regulatory focus to come, so it's absolutely going to be on this agenda, no doubt, next year and the year after as expectations around that space gather speed. Another thing that's going to clearly be on our agendas for a long time, the EU Pay Transparency Directive, and we had a great introduction to that. That's no doubt a project which you all have on your agenda, and we certainly are seeing clients needing to get up to speed with a lot sooner than the deadlines in 2026 might otherwise suggest. And in between there, Matt chaired a great session on executive compensation and the role of investor guidelines in sort of shaping pay policy, which is, I think, a great introduction, will be a great introduction in one moment to our keynote afternoon session, which I'm going to be very happy to introduce. Before I do that, please do fill in your feedback sheets, or start filling them out now. Why don't you make a start on them now so you remember the feedback from this morning. And if you get all the way to the end and put it in, I think there's a prize for completed sheets. So don't forget to do that. But without any more delay, I'm very pleased to welcome Andrew Ninian to come up to the stage. Andrew, as I'm sure many of you know, is the Director of Stewardship, Risk and Tax from the Investment Association. Andrew is always a very insightful speaker on these matters, and none more so, I'm sure, at the current time. As we've heard on a number of sessions this morning, the investor landscape and the role of competitiveness as a driver of remuneration policy in the UK is an incredibly hot topic, certainly one where all eyes are on it. And the Investment Association will be one of the leading voices in that debate. So we're very much looking forward to your introduction, Andrew, and then Andrew will be happy to take questions after his session, so please put your thinking caps on while you listen to Andrew.
Excellent, thank you. Thank you for having me, and it's a pleasure to be here. The intention that I'm going to go through over the next 15 or so minutes really is to give a perspective on where the IA and our members are, what we're expecting on executive remuneration going forward, and particularly what we've heard from companies around the competitiveness debate, but also trying to enlighten you with some of the actual pressures that asset managers are experiencing as part of this debate, and just give a sense of how we are likely to take things forward. So just to make sure you're all aware, the IA is the trade body for UK-based asset managers. We have over 250 members who manage about 8.8 trillion worth of assets for clients both here in the UK but overseas. And most importantly, that means our members own about a third of the typical UK listed companies. We have had a number of guidelines which are the aggregate view of our members, the aggregate expectation of our members on UK PLC, and they range from everything from executive remuneration through to how companies issue shares, what we expect around diversity, or what we expect on climate change. But I think one of the most, I suppose, anticipated guidelines are always our remuneration, principles of remuneration, which we usually update annually, and we usually accompany them with a letter to Remco chairs setting out the key themes for the next 12 months, and particularly the next AGM season. We did something a bit different this year. We didn't update our principles, and instead in February we wrote a letter setting out members' perspectives on the competitiveness debate, and clearly setting out that we will be looking to review our principles more fundamentally during 2024. And I'll just try and bring that letter to life in the next 10 to 15 minutes. I suppose we always start, though, with what happened during the last AGM season. That is the barometer and the starting place of where we think about how we're reviewing our principles. And I think it feels like a long time ago, because it probably was, but the 2023 AGM season was relatively quiet. And actually, you have to remind yourself that it could have been quite different. It could have been quite confrontational, because we were going through a cost of living crisis. Inflation was at 10, 12%, and there could have been quite bad headlines around executive pay relative to the workforce. But actually, investors, when we were setting out expectations September, October 2022, found that Remcos were on the same page as them. They were both thinking about cost of living crisis. Remcos were thinking about all employees, and particularly the lowest paid employees, and were already thinking about actually how they could focus any salary increases on the lower paid. And shareholders were asking committees to show some restraint, and particularly to give executive directors salary increases lower than the workforce. And in reality, that happened because of where Remcos were and companies were more generally. So it led to a quieter AGM season because investors and companies were on the same page and after the same outcome. We also had a particular focus on windfall gains. So this was an issue which arose out of the pandemic, where executives were granted long-term incentive awards at the start of the pandemic, when the share prices of those companies had fallen significantly due to the market-wide decrease in share prices as a result of the onset of the pandemic. In 2020, we highlighted the risk that actually if the market rebounded as we came out of the pandemic, then there was a potential for windfall gains, and we wanted Remcos to be mindful of that risk. In reality, we saw most companies explain around the issues of windfall gains. They produced a good analysis of whether or not there was windfall gains, and in a small number of cases, the committees took some action, used discretion to pare back vesting to ensure that it was appropriate in the company's circumstances. But more broadly, we found that due to a number of issues like the share price falling and actually the onset of the cost of living crisis, actually windfall gains was less of an issue for companies than we maybe expected. I suppose since the last AGM season, there has been a lot of debate around competitiveness of UK remuneration. I believe you've already had a conversation around this morning. And I suppose the starting point that I think we always want to make clear is IA members creating a competitive London listing environment as important. We want the UK, we want London to be a good place for companies to list and operate. And the benefits that brings, both to savers, to ensure that they have the right opportunity to invest in a diverse range of companies, but also in terms of companies having access to the markets and the capital that they need. I think, though, it's worth bringing to life actually some of the issues. At the moment, a lot of the debate is around companies and their shareholders. But there is a wider perspective that we need to bring into this debate. And we set out in our letter some of those themes. And the first one is just the government and political expectations on shareholders to police executive pay. Since 2012, the government has given shareholders both more votes, so the policy vote, and more disclosures, with a clear understanding that shareholders will get a stronger link between pay and performance, and that they expect shareholders to do a role in ensuring that there's a good link between executive pay and performance, with the underlying threat that if shareholders don't do this, then something more punitive will come down the line. The second stakeholder in this mix is the client, the asset managers' clients, the pension funds, whose managed money asset managers are ultimately managing on their behalf. And one of the interesting things over the last year is that asset owner voice has been slightly different to the competitiveness debate. The asset owner voice has been increasingly questioning asset managers around where executive pay is, why it is appropriate, and is it too high, bringing up issues like fair reward. And we've seen the fair reward framework from a group of asset owners. So asset managers get quite a lot of challenge, questions, comments from their clients as to why they are supporting various remuneration resolutions at company AGMs. So it is a perspective that asset managers always need to be careful of thinking about actually what their clients, whose money we are actually managing, want on executive remuneration. And then the final stakeholder we also need to consider is employees, the general public and media. Obviously, employees have, and remuneration committees have a growing role to take account of the view of their employees. But there is a general economy-wide issue that needs to be considered around how is executive pay perceived in the wider market. To get a perspective of actually where companies are and what they thought about our principles and how they felt our principles should evolve. We did a series of roundtables last September, and we met almost 100 companies over the course of September. There was no single consensus on what the problem with competitiveness of UK remuneration. I think probably the vast majority of companies would say there was some problem with the competitiveness of pay structures in the UK. Not all, but the vast majority. But there was no consensus around what the underlying issues were. But it did boil down to three main issues. One, and particularly the largest companies in the UK, those that compete globally for talent, felt that there needed to be more LTIP opportunity. So more long-term incentive opportunity and a bit more leverage in the remuneration structure. Another group of companies, and again, particularly global companies, those that are competing for talent with the US, wanted to use hybrid schemes. So hybrid is where you have both performance and restricted shares in the same award. And because the US system uses them, they're known and accepted in the US, and even companies use them in the US, they feel that they should be able to give them to their UK executive directors. And the third theme was around the Corporate Governance Code and the perception that a number of issues have been put into the code to increase alignment between executives and shareholders, like holding periods, post-employment shareholding guidance, malice and clawback. And I think individually everyone could say they are a good thing and they create long-term alignment. But actually in aggregate they probably have a disproportionate effect on the perceived value of remuneration. On our principles, the main feedback was actually it was helpful to have the perceptions of shareholders and have the aggregate view. They welcomed the continuity of our principles, which have remained relatively stable over the years. but they felt that at times our guidance in particular was too prescriptive and one size fits all. So what does that mean, what we're doing? So I think the first thing that we've tried to reiterate in our letter is our principles, they are not rules. They are there to set the aggregate view of our members in terms of what those expectations are. But that doesn't mean that companies need to follow every single perspective. It's about choosing the right remuneration structure for the company and engaging with your shareholders and saying, we believe this is the right structure. Do you agree? Do you support us to do something different? And it requires time and effort from both the company and the Remuneration Committee and shareholders to be able to accept that slightly different structure. One of the sort of guiding stars that we think will be really important in our principles going forward are two main things. One is that actually remuneration structures should be about implementation of the strategy and being rewarded for delivering that strategy. The second is there should be a clear and demonstrable link between pay and performance. Those are already in our principles, but we see that those will be the guiding light going forward. And what we will be doing is, during the course of this AGM season, we expect companies be taking slightly different approaches to look at the quantum issue, to look at the hybrid issues. And we expect one or two, particularly global or companies that gain significant revenues from the US, will be bringing forward remuneration structures which are slightly different. And we will wait to see how the market and shareholders react to those and what kind of votes they get at the AGM. And we will be responding and reflecting those views into our principles. We'll also be updating our principles to streamline them, to make them a bit more positive and outcome focused, and try and condense down some of the guidance so it focuses on the outcomes we're trying to achieve rather than be too prescriptive in a set way. We hope that we will manage to do that by the summer. I'm using summer quite loosely to give myself a bit of flexibility, but we hope to have those guidance out earlier than we normally would, and I'm guiding towards the summer at the moment, but we'll see how that goes. I suppose final reflection for what we signalled we thought would be key issues for this AGM season. Obviously, the future of remuneration and the competitiveness debate will be a key focus for this AGM season, and there'll be some key bellwether votes at the AGM season. A number of them are already being reported in the press, from AstraZeneca, the London Stock Exchange, Smith & Nephew, to name a few. But I think other issues which will be important will be the inflationary environment. Yes, inflation has halved. It's still, it is a lot lower than a year ago, but it's still relatively high compared to the target level and normal levels. So just understanding the approach that remuneration committees are taking on salary inflation, particularly for executives relative to the workforce, will be of key interest. And the other point is, given the challenging economic environment that we see ourselves now, getting the balance between pay outcomes and setting performance targets for the next financial year will be key. And again, it comes back to Remco's setting out a clear vision as to what was achieved, why it was achieved, and why the pay outcomes are right, and why the performance conditions going forward are appropriate and stretching for 2024. So that covers the main points I wanted to make. I'm happy to take some questions in the last 5 minutes.
Brilliant. Thank you very much, Andrew. Does anyone have any questions from the floor? Not at the moment. Okay, so while you all think of some questions, perhaps I'll ask you one, Andrew, if that's all right. I think a number of the people in the room here are from sort of US institutions, and that US perspective obviously is a big part of this debate, the difference between US and UK compensation structures, but also perhaps just the different, almost philosophical outlook you get between US investors and UK investors. I don't know if you have a perception on how much of an influence that is in this ongoing debate at the moment. And I suppose the other angle to that is that sometimes there's the point that the same investors, or the same investment groups, might be voting on one way on a pay outcome in the US and voting rather differently on sort of similar issues in the UK.
Yeah. So I think on that point, one thing that's come across very clearly from our members is they are trying to use their voice in the US market and actually get a greater alignment with shareholder returns in the US market. But obviously they are relatively small and their influence is harder given the structures in place. But it is something that they repeatedly have conversations with investee companies about. I suppose I think there needs to be a recognition that this is around how do we ensure that UK companies can compete globally and reflect the performance they achieve and actually where they're trying to get talent and get talent from. And I don't think for many reasons that we will be able to pay like the US. And actually, people are comparing different systems and they are structured very differently, both in terms of the legal structures, risk structures that an individual director takes in the US relative to the UK, the lever provisions. So comparing like for like isn't that helpful, and it's not a fair comparison, particularly the size of US businesses versus UK is very different. But I think what we are trying to do and what the market is trying to do is recognise the competitive pressures, take a step towards it, while still balancing those competitive, the other pressures that asset managers are feeling from their clients and from the politicians. So it's a bit of trying to acknowledge the step towards whilst taking our stakeholders with us.
Very helpful, thank you. There's probably time for one more question if anyone had anything else from the floor for Andrew.
Hi, Matthew from Tapestry. So, Andrew, you'd mentioned that the revised principles, you expect them to become more outcomes focused. At the moment, when we're working with clients looking at the principles, there are very specific expectations on a whole range of issues impacting remuneration structures. I was wondering if you were able to give it any colour to what you just said as to becoming more outcomes focused. What does that mean? What might that mean in practice?
And this is the trade-off that we are, the balance we are trying to get at the moment. So one bits of feedback that we had from companies was actually there's duplication with the UK Corporate Governance Code, having post-employment sharing guidelines. So companies will say there's duplication. For us, actually, there is no duplication because the code says you have to have a post-employment shareholding policy, and we specify that actually shareholders would like to see that for 2 years at 100% of salary. The question being, where I talk about outcomes focused is actually where is the balance that you can demonstrate that you are getting the same outcome in terms of long-term alignment between executives and shareholders that shareholders can rely on without being prescriptive that you must have a holding period, you must have deferral in the bonus, and you must have a post-employment shareholding guideline. So is there a way that between those different mechanisms, REMCOs can demonstrate the outcome they've got and how that creates long-term alignment, rather than saying you must have all three? You have a mix of them to create the same outcome. But how that works in reality is still to be worked through.
Brilliant. Thank you very much, Andrew. If we could all express our appreciation for Andrew. And now I'm very pleased to then move on to our next panel, which I am chairing, so you're stuck with me for a little bit longer. But while the panelists make their way down. So I'll let each of our panelists introduce themselves in a moment, but we have Stuart Woodward, Head of Product and International Regulatory Compensation, as we heard earlier, from Citi. Will Brown from Standard Chartered, Global Head of Reward, and Martin Fisher, Global Head of Reward at Fidelity International. So we're going to be talking for about the next 40 minutes or so on non-financial incentives. That's a pretty broad and flexible topic, as I suspect our discussion will illustrate. We're very keen for questions and views and disagreement or agreement on anything we cover, or indeed anything we don't cover and miss out. So after a bit of an initial discussion, we will come to the audience for questions or sort of challenge or views, and it'd be really great to get some views. So again, please get those thinking caps on. But to start us off, I'm going to ask each of the panelists to sort of explain what this topic means for them and perhaps their institution, and how they approach this, given it's quite a broad topic. There's lots of different perspectives. So perhaps, Martin, I can come to you first.
Sure. Good afternoon, everybody. Nice to be with you again. So this is such a broad topic. It's, how do you get your handle around something that is so individual and means individually different things to different people. How we as an organisation grapple that, we'll talk about some policies in a few minutes, but I think it's quite hard to qualify and quantify something which is so broad. So intergenerational, meaning, well, what that means depends on how old you are. I'm sitting here in a tie, I have very focal lenses, I'm probably not the youngest in the room. So to understand from that perspective, I think is quite hard. But of course, as an employer, you have to be things to all people at all times. So we're particularly cognizant of the generation we're trying to come through, competing with other institutions in this room, let alone outside the room. And so what's going to appeal to them and show that we are the right kind of organisation for them from a cultural perspective as well as a financial perspective is a really fine balance. But we'll talk about some of the policies as we go on.
Brilliant, thank you. Going down the line to Will.
Thank you. Good afternoon, everyone. So I'm Will Brown, Standard Chartered, Global Head of Reward. It's an interesting one, I think, as we reflect on intergenerational reward, to sit on a panel with probably not a very diverse set of colleagues. But you'll hopefully forgive us to just share some perspectives, and I think that's where it would be very welcome to hear views from the room. But this is a really evolving space. I think someone who, I've been a reward practitioner for over 20 years, and if I think back to what that meant earlier on in my career and what we used to spend our time focusing on, to be sitting here today talking about non-financial incentives, flexible working, well-being, I never thought I'd probably be at this point. So things have evolved hugely, and I think just recognising that from the outset is really, really important. And as an employer, we're in 50+ markets globally. A lot of those emerging markets, we have an incredibly diverse footprint, and therefore being, and Martin, you said it, I think just being cognizant of the fact that, you cannot put people into boxes. And, I think this piece around being able to identify for yourself what things mean to you and what's important is incredibly powerful. And I think, as we'll hear, we'll talk more about the power of employee listening and the importance of employee listening. But I think that's the big shift as we kind of have moved forward over the last few years.
Brilliant.
Hello, everyone. I'm back. Look, I think this is one of these topics where I could probably offend everybody whilst we talk about this. So let's put that out there first. Please don't be offended if we say something that doesn't resonate with you. We're just trying to put forward perspectives. This is a great topic, actually, and it's one that kind of pushes us to think outside of our day-to-day jobs. You know, often comp structures are so rigid, you sort of do this and do that. When people always ask me, particularly family members, what I do, I often say culture, because it's the easier thing to explain. You know, I work in banking and I do something that's to do with culture. It's sort of tangible. People kind of get that a little bit more than I pay bankers. It also has a slightly nicer OBE type worthy spin. And I think this is kind of to the cultural heart of what we do, right? We don't really do comp any longer. Reward is such a broad spectrum of things that come to the heart of the beating heart of the organization. How do we motivate people to do stuff, whatever that stuff is, through a mix of things, through paying people? You know, people have to pay the bills at the end of the day, but so much more of this is about the non-financial. So I think hopefully this is a really great topic.
Brilliant.
I'm so impressed you think culture is an easy thing to understand. I have to...
It's ethereal, I'll give you that, but at least people understand the word culture, whereas you say compensation to people and they think you work in damages or something.
Well, I used to, when I started out as a tax consultant and used to get asked what you do, and I'd say I'm a tax advisor, and I'd get, you're a taxi driver. And it used to be easy to say, yes, that's right. So,
yeah, we can make our judgments which people prefer between taxi drivers and tax advisors. Okay, so perhaps then we could dive a little bit into, what do we actually mean by non-financial benefits, non-financial incentives? Obviously, we can't cover everything, but maybe we could just touch on a few of the sort of strategies that we see being implemented or being asked for, just to sort of kick us off. So maybe, Will, if we could start with your view.
Yeah, no, happy to. I think one of the things, we've spent a lot of time thinking about is probably the evolution of the benefit space. And, again, being in a global organization where there are very, very different offerings across all our markets, trying to think very progressively about what things we would like to take a stand for as an employer. So again, thinking about this through the EVP lens, what are those things that we think are going to make a material difference both to our colleagues, but also for a broader societal impact. And so we spent quite a lot of time over the last couple of years thinking about, what are those things that we could go after at a global level, as opposed to obviously just focusing, as you typically do, on benefits at a local level. And two of the things that we identified, largely through talking and listening to employees, and we spent a lot of time dialing up, as I said, the employee listening piece was kind of almost at two ends of the spectrum. One for parental leave. And so focusing on how can we do something with our parental leave policies to really make that far more gender neutral. So last year we introduced equalised parental leave, so irrespective of gender, relationship status, how a child came to be into family, all of that totally taken out of the equation to give 20 weeks of paid leave globally to anybody who's bringing a child into their family. Now, from a UK or Western market perspective, that may not sound overly progressive, but certainly looking into and speaking with a lot of our colleagues in some of our Asian markets, that was a really, really big change. And actually working through what that means and actually the impact of that sort of change and what it says internally and both externally was a really, really important part of that change. The other one we did, and this is why I sort of talked at the two ends of the spectrum, was to really focus then on something which has been a long time very taboo, but menopause coverage within our medical plans globally. I think we had probably about a third of our plans globally had provisions specifically catered for around menopause support, and we've now got that up to 100% across all of our medical plans, where we have now allocated specific provisions around menopause. So I think just thinking differently about what your benefits offerings are giving your employees and actually what they say for you as an employer is a really important shift and something, as I say, we've spent a lot of time focused on.
And I don't know if you agree with that, if that resonates?
Yeah, it very much resonates with the Fidelity story. So we've also thought about what are we doing on a policy perspective from the benefits piece, and what that sends signals to our employees and potential employees and their families as well. So actually quite similar, just about 3 years ago we introduced what we call enhanced paternity leave, very similar story to yours, Will. We equalised the paid leave for males and females wherever you are in the world. So we didn't have a standard minimum 20 as you did, as you described, Will, but what we did is whatever the practice was in your particular country, we would mirror that. So in the UK it was 26 weeks, and then we upped it to level to some standards elsewhere in our globe. But by equalising the male and female leave, that was seen as a very positive thing. And of course, you know, the comms went out and tried to distinguish ourselves from other asset managers. The other leave we've introduced, which I think is also almost more far-reaching actually, is family care leave. So this is around recognising that people have requirements both as parents or as children or as siblings to their wider family, and rather than you having to take half a day off to take little Billy to the doctor, or your mother's not feeling well, she's got a health appointment or whatever it might be, we gave an extra 5 days leave per year, and that has become incredibly important to a lot of our colleagues. When we look at the stats as to how many people take these up, that is a very widely recognised and acknowledged additional leave that otherwise, of course, would come out of your vacation, which I think has been really good. One area where we're not so good, as a confession time, is recognition, actually. So we don't have a global recognition program. I think we would benefit one. I lost that battle so far, so we'll see where that goes. But that's something that I think that a lot of organisations are pushing quite hard. We have recognition programs in parts of our business, but we don't have a global overarching Fidelity International recognition plan, which, you know, we've survived on so far. And because we've been able to do these other policy areas, I don't think we necessarily need to go there just for the moment. But that's one eventually on the menu list.
That's very interesting. Maybe we'll come back to that. But Stuart, I don't know if you had some reflections on your organisation's journey so far.
Yeah, I mean, I suppose we've come at things slightly differently. I think there's a standard level of expectation now from employees, generally speaking, and it's sort of the well-being, the health, as you say, pushing into benefits, which perhaps we haven't explored historically. One of our challenges in a truly global organisation, 100 or so countries, is thinking through the perceived value in country. So what we've done is we've really focused on a kind of core set of things we know we really want to offer. And then there's a peripheral side to that where you just have to make a call, and whether you want to support it, even though it might be something in the US or the UK that would be great to do, for the rest of the world, is it going to be relevant? So it's sort of the perceived value of the benefit. So just to give an example of that, you know, when you're operating in sub-Saharan Africa, generator allowances are massive, right? The ability to have electricity to do work is more important than your medical offering. But if you as an employer feel your medical offering is a core part of who you are as an organisation, you have to prioritise that. So there's always this sort of quid pro quo element of thinking through the structure to suit. And of course, then you end up in the territory of, well, do you offer those additional things and therefore break your model? And I would say City's done very well at keeping kind of a standard and a core without necessarily feeling it has to go into all those spaces. But it always pushes us, and it pushes us, ironically, back into the financial component, which we're not supposed to be talking about, which is, do you then provide some kind of allowance to offset the fact you can't give the benefits which necessarily meet the local market?
Very good. So, I mean, to focus on the leave piece or the bit where we're not working or working differently, and I guess this sits alongside the discussion around flexible working, agile working, all the different phrases, which has obviously been very much a strong part of the conversation for the past few years. Is that old news? Is that still relevant? Is that complementary to financial incentives? I don't know if we could touch on that briefly. Sorry, yeah, go for it. Apologies, I should have.
That's right. So, I mean, time off is the critical value for those coming through, I think. So when we think about what people value, of course people value money. How valuable is money? Less valuable than it used to be, quite frankly. And I think a lot of that has actually come from COVID. So from my perspective, COVID was a workplace revolution. And we don't normally have revolutions in the workplace. We have sort of evolution as technology comes along and we sort of start different practices, etc. And this was a light switch going off around the world, and the consequences of that are not yet embedded. We haven't quite figured it out. We're all sort of slowly figuring out, which is why organisations are starting to say you need to come in a bit more or a bit less or whatever you need to do. So the new working pattern will evolve and emerge. And in that process, time has become the key commodity. whether that's commuting that you don't have to do anymore, whether it's actually being able to have more flexibility so you can take kids to school or you can go to a dentist appointment, wherever it might be. Those issues of time and you managing your own time and the trust relationship between employer and employee is absolutely critical. So, our employees coming in, and those that I'm meaning in their 20s and into 30s, of course, are very young, are thinking about, well, actually, can they cope in the workplace without having some release valve? So we joked a little bit earlier on the pre-discussions around, in my view, pension is awful because old people have that, and we need, instead, if you incentivize people to save for some sort of career break, some sort of escape that they can have a release valve, that would be so much more successful, and people would willingly save money for that, as opposed to something that's 30 or 40 years away, which seems unattainable. So I think time is the critical value denominator for those coming through, and indeed most of us in the room who would like to be doing other things sometimes other than work.
Yeah, perhaps I'll pick up on it. So do I think flexible working is going away? No, I don't. I think flexible working is here to stay. I mean, that's evident. I think, the thing where we've spent quite a lot of time focusing internally is, look, we all went through COVID pandemic and we all had to change our ways of working. And we were somewhat fortunate in that we'd already sort of spent a lot of time thinking about how we could move to a hybrid working structure. And so we already had kind of plans in place for that, which put us in good stead through the pandemic. I think the shift now, though, is, and there's been a real, over the last years, I mean, we're very much in a world now where the employee voice is king. And I think you can see that now, and that the power has shifted significantly from employers to employees. And I think if you don't wake up to that, you'll find yourself, in a really difficult position where you're losing talent. The subtle shift that we focused on, though, is I think where we were 2 years ago when we were talking to employees around flexible working, it was very much around me. Like, what does flexible working mean for me as an individual, how I go about my work, what that means for me. Where we've really tried to shift the narrative internally now is from me to we. And that's been quite a big shift in that this is now about you, your team, those around you, and actually how do you come up with, whether that's a team charter, whether that's ways of working amongst yourselves, but actually focusing on how you can do things in a better way that serves the collective as opposed to just you as an individual. And that's quite a shift, because I think everybody's kind of got used to their own, whether it's they've now picked up a dog and they need to do their walking, and that's all great. But actually, I think there's a commitment to all of us, and that when you work in an organisation, that's probably the powerful thing. And we spent, depending on who you speak to, you'll get very, very different views on this topic. And if you speak to, and we did some surveys internally, and I think if you look at the results, there's a real noticeable difference between what you saw from your exco, from your MDs, from your more down to your junior colleagues. There's a really different view on what actually people think is reality. And so one of the big reflections for me is to not let yourself fall into that trap of just being in the echo chamber, of only listening to those senior voices around your table that think they know the answer around this stuff. You have to really listen to all of your employees to understand what is the lived experience and what works best for them, but then equally what works for the business in the business context. And we've spent quite a lot of time trying to disprove or prove this whole piece around whether there really is an impact to productivity. Now, I think when you do most of the surveys, self-declared on flexible working it hasn't. In fact, my productivity is better. And I think that's probably right in most cases, or it's certainly when every study I've looked at, productivity generally doesn't go down. It's then what you're doing with the increased productivity that counts. That might be back into the organisation, that might be into broader society. And that's where I think this gets really quite exciting, because then you can start to see how actually the way that we change our working preferences can have a much bigger impact, not just on you, your organisation, but actually on wider society.
Yeah, that's a really interesting perspective. Maybe I'll pick up on one of the points that you sort of started to touch on there as well, about actually just how you go about deciding on an approach in this space, because you started to mention there about not just listening to the people in the room. Martin, I don't know if you had some perspectives on that as well, how you've gone about developing that internally.
Well, a lot of it is, as Will mentions, you've got to start listening to people and feedback and hearing from colleagues around the world. We're in 26 countries, not as many as some of you guys. But we're in enough so that, you know, we can't be UK-centric. It can't just be about Western world. We're predominantly out in Asia as well, and in other parts of in Canada and parts of the Caribbean. So we need to understand what else resonates with them for sure. And cultural things like promotion. So non-financial incentives will be promotion's a good example, where in some parts of our world it's really important. So in India, for example, in our particular group, you know, promotions, being able to say you've been promoted in the operational level, particularly the junior grades, is a really important cachet. It's really important to them. So we have to understand how that can be seen as an advantage and grow and develop yourself, rather than just think about the broader piece of benefits as a whole. It's more job architectural piece, which is a little more nerdy, I suppose. But as Will said, it's about listening to others and making sure that it's not all the male, pale, stale voices that are being heard.
And Stuart, obviously, with your particular global perspective from City, does that resonate?
Absolutely, and as you said, there's got to be many, many different inputs into these discussions. I was thinking earlier, kind of, what do we mean by generational as well here, in the sense of generational actually, and I've said it could be controversial, some of these comments, but if you think about actually the all-comment world, the people who are often the ones saying productivity is dipped are the people who have lived through many generational spans, typically speaking, right? It's more senior people sitting in longer tenured roles who are saying we're not getting the exposure to the water cooler chats and therefore we're not learning. I think there's something founded in that. I think it's right, actually. So the pivot towards flexibility is fantastic, and we've got to live by that mantra and got to keep understanding what, as you say, we can do beyond the world of work. But I do think there's something as well that is perhaps missing in terms of where we are now. So where I would say we've thought through very carefully some of the aspects of flexibility from a package perspective, and thinking non-financially, is how much personal risk do individuals want to take within their own package? So flexibility, you know, you choose whether you want to have private medical, or don't come to us then when something goes wrong and you end up in hospital and have to pay the bills. And that bargain that you strike, that value proposition, is where I think you can really move the dial a bit in terms of how you manage the package that an employee wants. The ultimate nirvana is that the employee can go in and select, you know, I want to be paid 10% of my salary and 90% goes into a pension because I'm saving for the long run. Not realistic, right? We know totally unrealistic, because none of our systems would support it. You couldn't operate individual compensation arrangements. But if you could get to something closer to that, where it's the employee who's making the decisions as opposed to the employer who's doing it to them, I think that could be a really great solution. But nobody so far has come up with a new version of Workday or whatever it would be that manages it. So when we do, we'll go with it.
Yeah, perhaps I'll just add a slightly different perspective. I think flexibility, as I said up front, can mean a whole raft of different things. I think one of the key messages, and we haven't yet said Gen Z, Gen Y, Gen X, baby boomer, but one of the things we will constantly hear is when we speak to them, we serve our employees, is what do you want, right? What is it that you want when you come to work? And when I say come to work, I mean in the broadest sense, but what do you want? And the most consistent response we get back is, we want to do exciting, value-add, meaningful work, right? With good people and with good leadership. It's quite simple when you break it down, but actually being able to deliver that proposition meaningfully is not so easy. I think Martin, you mentioned promotions and career progression, which I totally agree with, but I think this pivot now, and we're in an HR forum, you can't avoid talking about now skills-based organisation, but I think it's so relevant now, and you're actually seeing this shift. We spent a lot of time focusing on what can we do to really equip our colleagues for the future. And the world of work is changing at a pace that we've never seen before. So actually being very clear as an organisation about what skills you're going to need in the next 5, 10, 15 years, and actually being really thoughtful about how you plan your workforce transformation and your workforce strategy to equip your colleagues with the right skills to be able to keep pace with that transformation is absolutely, I think, got to be one of the most important things that we as HR practitioners focus on over the next 5-10 years. Because if we don't get that right, we're not going to be offering, we're doing a disservice to I think, our people.
I'm glad you did the Gen Z, tick, we've got to get that out there, which I think was important. I personally don't subscribe to much of that because I think what most of us want is exactly what you've described, Will. So most of us would like to have meaningful work with a nice boss and good leadership and, all the rest of it. So I think the difference is that Gen Z are the generation that have actually articulated it properly and done something about it, which is actually they've chosen who they're going to go and work for based on those outcomes. Whereas I suppose those in an older generation, i.e. mine, would have just, sucked it up maybe for a bit longer and then sort of put up with it. And then eventually when your manager's a complete arse, you then move or something. So I think from a compensation perspective, our question is, well, what do we offer that sends the signal that we're the kind of company you'd want to work for? So you're not going to work here for the next 30 or 40 years of your life. That's very unlikely. But you're probably going to work here hopefully for maybe 5+ years. And so what is it that makes us be the company that you want to put on your CV next in your long line of companies you're going to work for? And that's around sending the signals to the policies we've discussed earlier today about enhanced paternity leave, in our case family care leave, other things, as well as remuneration. Remuneration does still play a key part in our sector, as we know. Let's not forget that. Those send the signal about how we operate as a company. And the culture point that you mentioned right at the beginning, Stuart, that's a broader picture that we're trying to paint for people, and then they can make an informed discussion and a decision.
I think what's so interesting about this is we're probably all data-led people. We work in reward, so data is something we use day to day, and yet none of this stuff has any data really to support it. You might have your employee experience survey type thing once a year, and I bet most people in the room, it's the lowest score on the survey. For remuneration, generally speaking, is the lowest or lower of the scoring categories. And we all every year think, well, why is that? Why? Well, somebody must have a higher score than us because the median is way above us. But then you talk to most people and actually it's still the lower of the scores, generally speaking. And I think that's a really interesting factor, that people are happy with something they say they're uncomfortable with from a remuneration perspective, and yet they're very highly scoring on other factors like the world of work, as you say, and the skills and experience they're getting given. So are they willing to live with that as a concern, or is it actually just noise? And do people always feel they're unhappy about their compensation and therefore they will always go lower? And so we don't have that data necessarily to drive a lot of these decisions. Well-being, it's great. You can see how many people are going and visiting your clinics. You can see how many people have has early stage cancer recognition and therefore they're back in the world of work quicker. But should they be? Is that the right decision for them? Have we just fixed a problem that didn't exist? So I think there's all these sort of different conflicting interests in this topic.
We actually deliberately don't include remuneration questions on our all-employee survey because they're always going to say we want more money. I mean, what is the point, right? However, on Glassdoor, when one of the categories is how does your compensation benefits compare to other, that actually is a more meaningful score, I think, and the feedback we get on that from employees and ex-employees.
That's very interesting. We touched on it briefly there about promotion, and it came up on our earlier session about the role of recognition, and that comes through in promotions, and that came up in the context of, I suppose, in a way, negative recognition, making sure less good conducts are reflected in promotion or career discussions. How, and you said it's something that needs work, so I don't know if perhaps we could just dive into a little bit more around the importance of promotion, recognition, and are there any strategies that you think do work? I mean, it probably is something that all organisations have something to learn on, I suspect, but I don't know who wanted to start. I'm starting to go slightly off script here, so... I'm
happy to share some experience. I mean, this is a topic we've really focused on heavily over the last few years, and we've been on I'm going to call it a journey because it is a journey, but around how to try and shift the culture in the organisation to one of. It's going to sound, but a genuine high performance culture, and defining that is obviously very difficult, but to create a high-performance culture, you have to have, it's not rocket science, but very clear objectives. You have to really know what you're trying to achieve, but you have to be aspirational. You have to have a psychologically safe environment. You have to have then clear incentives. But the other really powerful, as you talk, we'll have this debate about intrinsic or extrinsic motivation, but when every time you look into the behavioral research, recognition comes out top. Constantly, the power of recognition. And as we talk about non-financial incentives, I think that's we're seeing far more and more of that. Now, I know, Martin, you said you don't yet have a global recognition platform. We have just put one in. I mean, literally within the last couple of months, and we spent the last 18 months sort of, getting ready to sort of roll out. And it's been absolutely fascinating. Within just 1 month of going live globally across nearly all our markets, the just sheer volume and momentum that we've seen in people just having somewhere they can go and do peer-to-peer, upwards, downwards recognition with points and experiences. And I think I saw some research from I don't know whether we should use my supplier's name, but I won't. But the research they gave us, and actually around the value of using non-cash recognition versus cash. Now, I think if you ask most people, would you like cash or some vouchers, they'll say, well, give me the cash. But actually, the multiple, and I think it's something like 40% more impact of giving non-cash recognition is significant, because if you then translate that to an experience, and an experience that if I gave you cash, you probably wouldn't typically go and spend it on that experience. But if I give you the experience and you gain that impact and power is quite significantly greater. So, just the behavioral muscle of building recognition into the organization is really, really important. What it then does as well, because the other thing I think we've experienced is within performance management, you've seen this trend of people using performance feedback to just give recognition, rather than real developmental constructive feedback, which is intended to improve performance. So trying to have two things which are, of course there's overlap, but distinct, to say this is about recognition, link that to the valued behaviors and what we're trying to do as an organization, and then over here, this is about performance development and culture, but bringing that all together under sort of one quite holistic narrative is quite a powerful journey. It's not, people don't get it straight away, so you have to keep talking about this stuff a lot, but now having a global platform to do that is really helping.
That's brilliant, thank you for that.
Just on that recognition piece and the power of something rather than just cash, just amongst ourselves, I've been with Fidelity, by the way, for 5.5 years, and we used to, and we still do, give long service awards. Every 5, 10, 15 years you get, something. And it used to be very generous, and when you got 20 years, you got a Rolex watch. It wasn't the most expensive Rolex watch, but it was a Rolex watch. And they changed this policy about a month before I rock up. So my bloody inbox was like, where the hell's my watch? I've been here for 20 years. I mean, it was a riot. It really was. So people definitely felt the value of a product over the cash value, for example. And now we've reviewed our incentive award for that long service award. But undoubtedly, the most important recognition strategy still remains the words thank you. That is, you can have all the systems you like, but if you feel recognition from your peers, from your boss particularly, you just walk an inch taller. It's not rocket science, and managers still don't get it, despite what HR says. It's frustrating.
I think you've raised a really interesting point there, because I think that bit cuts through the generations, right? We all acknowledge the thank you, whether it's the highest level or the lowest level of an organisation. Where I think the taking something away point is really interesting, because we're probably all grappling with performance management and the label that you associate with performance management, the good performer, exceeds performer, that sort of stuff. And how, from a behavioural science perspective, none of us like to be labelled, but we all want to label in the context of performance management because we want something tangible to hold on to. And that's where I think, we're in this really interesting tipping point where I do think there's probably a generational difference here, that if you've lived the experience of your Rolex watch over 20 years, your performance management tag over 20 years, you're probably also at the end of it thinking, I'd quite like to know what I am because it gives me some stability. Whereas if you're just starting out in your career, you know no different. So there's a real difference, and I think we're dealing with both ends of the spectrum. And likewise, that links in directly to compensation. So if you don't have your tag, but you do have your paycheck at the end of the month, could you live with that? Well, we've seen some experiments in that space, and not always is simply the answer. So I think all of these things are driven by a desire to do something more harmonized and more consistent, but we're all finding in each of these discussions that there isn't harmony and there isn't consistency, and maybe it makes us feel a bit uncomfortable as people who like to put structures in place and like to have simplicity.
I said we'd come to the floor, so I'm going to do it now before we run out of time, and then we'll perhaps come back to the panel. So it'd be really great. So, brilliant! We've got a hand up already. Excellent. Let's dive in. Here we go. Just here. Thanks.
Thanks. Alison Wade from PwC. I was just wondering what the panel thought of the following. So I recall one of you, I think, in your introductory words, used the phrase, trying to be all things to everyone at all times. I was wondering how you kind of manage the different wants, the different expectations of the younger members of the workforce, the older members of the workforce, the people in between, when it comes to actually designing your benefits. Clearly, if you're a parent, then you're going to really value a certain type of, thing like you were saying about the maternity and the paternity leave. If you're not a parent, then that's pretty irrelevant to you. How do you kind of square this circle? Is it by sort of coming to a common denominator that's important to everyone? Is it by picking something important to this group, important to that group, and important to that group? How do you deal with that?
Shall I kick off? All right. It's a great question, Alison. Thank you. So the answer is it's quite hard. There are some universal benefits that you can create, so time off is being a good example that everybody can benefit from. When we introduced the enhanced paternity leave that I mentioned, we had a load of moans from people in their 40s and 50s going, oh, bloody hell, I didn't have that. Where's my benefit? Where's my little bit of gold? And we said, well, all right, calm down. We'll look out for something for you. So to think what benefits different populations is helpful. The family leave we introduced was partly in relation to that, actually, because we said, well, actually, if you're in your 40s and 50s, you might have elder parent care needs as well. And so, of course, something like family care leave can be both generational up and down or across, wherever you want. So just trying to think about how it's perceived by different parts of the population is important. But if there's one group that are moaning because others have been over-generous, we've been over-generous to the younger people, as it were, what do we need to do to satisfy everybody else? And that's a much harder conversation. But we try to be mindful of that where we can.
Yeah, I mean, maybe I just built, totally agree with that. I think Alison, we if I reflect back on the conversations we had internally when we were talking about equal parental leave, and it was partly that, Martin, but it was also, and I mentioned this, it was also in some of our markets, for example, where it was like, well, hang on a minute, why are we wanting to give men the same amount of time off as women when they're not going through the physical aspects of labour was coming out in the conversation. Why are we doing this when actually in some cultures the man isn't even there through the first 10 weeks of childbirth? So there was this level of fairness in the debate, and I think we had to keep talking through actually we're trying to shift, and it's not about it's about creating equal opportunity and actually trying to move in a direction where we can have that. As to why you pick one over another, that's a really difficult debate. Because everybody, and the minute you go out with one policy, and again we sat there and said, well, okay, that takes care of X% of the workforce, but what about whether it's elderly care leave or take your pick. Everybody will have something that's important to them. So I think you've got to pick the things that, as an organisation, are going to make the biggest impact and resonate, and say the most about what you want to be as an employer. But it's not an easy conversation because you can't do everything.
I guess affordability as well. Sad to be the sort of doomsayer. I feel like I'm sat on the end being the counterpoint to everything. But ultimately, these are expensive programs in many cases, and I think you've got to be able to use the common denominator. I would say, personally, common denominator is probably where you have to land in most cases, because that's the bit you can afford, and whether you can go beyond that is a different matter.
Brilliant, thank you. There's another question over here.
Hi, it's Chris Gamble at Macquarie. Thank you all for your time this afternoon. My question is on quantifying and putting a financial value on non-financial incentives and communicating that to employees. In my experience, employees tend to get a letter at the end of the year with their salary, their bonus, maybe their promotion on it. And what's missing is pension, benefits, medical, never mind the less tangible things, and that sometimes the value of those things is not appreciated by the employees in the way that the cash portion are. So I wonder if any of you have looked at trying to quantify and pull from different systems some of those non-financial benefits and communicate them.
Good question. Who wants to
Okay,
start?
I'll crack off again if that's all right. So that's a great question. I mean, a number of organisations have done total reward statements for forever. We have not done that forever, but we've introduced a new benefits platform globally, which we're rolling out. We've now got it covered under 96% of our population. And one of the things that that does is pull together a total reward statement. But what it also does is it brings together, not in a financial value perspective, so it might fall slightly short of your answer, is it brings and reminds people all the other policies we have. It reminds you of the leave policies, reminds you of the training and development we have, all the things you come to, in our case, Fidelity, and you rock up for. What do you get as a result? What's the trade-off for you giving up your time to come into work for us? Here it all is on one page, as it were. So it's as a reminder as best we can of the total articulation of the employment offering, the EVP that you mentioned earlier, Will, and that's, I think, as good as we're going to get. The total reward statement has been helpful to remind people. We don't then cover cost of employment, which is something else, of course, which is another factor, because I think that's a bit too far, but at least we have them itemised or issued on the same page, so it's in one place.
Can I just, because we went on a bit of a journey around this, and I think everyone's looked at different total reward statements and things, but we tried to move hard on doing cash benefit allowances that would just give full flexibility on being able to select whatever you might want for your own individual preferences. And we spent a ton of money, spent a ton of time, invested a lot of resources in trying to roll that out across a lot of markets. And then what you end up seeing is, so I'll give one great example. So annual leave, buy or sell, right? So we give flexibility within your cash allowance to say you can either sell up to 5 days leave for cash, or you can buy up to another 5 days leave to take. In the UK, pretty much everyone was buying leave. In Singapore, everyone was just selling for the cash. So we kind of were looking at that and saying, well, look at the data. We spent all this money on running a platform and all this flexibility, and everyone was just basically saying, I'm just going to take the cash in a lot of our markets. Now, obviously, some places you've got tax effectiveness and other ways of, things you can do through flexible. So I'm not suggesting that FlexBen's platforms aren't, in the right context, aren't very helpful. But that was an attempt, to your point, to try and quantify a value of benefits by saying, okay, we'll give you X% of your salary as a cash allowance, and here's a whole suite of benefits that you can choose from to fit your personal circumstances. But when you look at the data, and I think this is where, as we have this conversation, data's king, because I think you've got to look at the data to see what it's telling you and whether you stick with a path or don't.
Out of curiosity, why are you trying to value them?
I guess it comes into focus most in years when bonuses may be not so good and are down, and trying to make people understand that, yes, this might be down, and maybe your salary increase may not be as much, but do you appreciate that you've got 10% pension or whatever it might be, and the actual value of that, or the extra days leave? So I think people tend to take it for granted. Or you bring in something new, everyone appreciates it for the first year or two, and then they forget that it's new, and it's just baked in. Whereas if it was kind of repeated on a year-end statement, it might be something that they do appreciate. There is a financial cost to providing those kind of benefits.
Yeah, no, I totally agree. I apologise to anyone who works in benefits, but sometimes benefits may be perceived as a hygiene factor. And I think that's one of the challenges that we've got to get beyond, as you say, is that actually there's a real tangible value. Now, most people probably in the UK certainly will see that value on their payslip because it's taxed. So you sort of see that value as a tangible number for pension or for medical or other things. But the real value is the value when you need the benefit. It's when death in service pays out to a family member, or where you need cancer treatment and it costs £50,000 to have a treatment and it's cost £1,000 to the employer. So it's a totally different value, and I think total reward statements are great for once a year reminding somebody, or even if you can dial them up day to day, but they probably don't go to the heart of it. To me, it's back to the earlier conversation when we were talking about conduct. It's the narrative you put around it. So I've seen some great examples where people have done videos of people who've benefited from some of the things available to them. So, you know, keep the same story going. The cancer treatment, you know, somebody who's been able to access the services, or not been able to go see their GP, but been able to go and see their private healthcare provider, and being diagnosed with something, and because it's been acted on quickly, it's been hugely beneficial. That's the real value, because of telling the narrative and putting out the communication, as opposed to the hard number of, it costs us £455 a month to administer this benefit, and everyone goes, so what?
Yeah. Some just to that point, actually, so sometimes it goes beyond benefits. So my previous organisation, so nothing to do with Fidelity, a colleague of ours had passed away, and we immediately gave a £10,000 payment to the spouse, just to manage just crap, frankly. And, you know, the thanks that you get from something as, you know, frankly, in all our worlds, small as £10,000 payment, and the way people appreciate that is just incredible. And that isn't written in a policy statement, that's just because you're doing because it's the right thing to do, and you're helping people in dire need. And at that point, it's, you know, you're there for them, right?
So almost a form of thank you, like you said earlier. Yeah. Well, we were going to come to the panel for conclusions, but great question, so we're out of time, so we won't be doing that. But thank you very much. I think that was really interesting, lots of different perspectives. So thank you to Will, Martin, and Stuart. Right, checking I'm in the right place in the agenda. Yep, and now very pleased to introduce Dominic, Elias, and from EWM Global, along with Simon Shipgood, who are going to come and talk to us about managing the year-end process. As I'm sure they will tell us more, EWM, a global fintech supporting wealth managers, banks, asset managers and others on the implementation and administration of incentive plans. So I'm going to get out of your way and leave you to it.
Thank you, Bradley. I think you leaving has made it more feel like a fireside chat now. You can feel the embers just glowing behind us as opposed to a panel. But I just wanted to say thank you to the guys. That was an absolutely fantastic panel. And Will, sorry, I have to say it, but you went on so many journeys, it's no surprise they called you a taxi driver. That's what but yeah, Dominic and I were just sitting listening to that and thinking there's just so much to consider when you think about the year-end process. But we kind of, I guess, want to play maybe devil's advocate a little, and bring it back to the purely remuneration piece, and what that looks like as a year-end process. I've been lucky enough to speak to a fair few of you already today. You're either at the start of it, in the middle of it, or lucky enough to be at the end of it. But every single year we come to this event, at some point from January to March, and I'm amazed to see so many of you here, because I know that it's such a hectic process that you go through at the end of the year. So we just thought it would resonate a little to talk about what that purely remuneration end of year process looks like. Maybe just extract a couple of pearls of wisdom from Dominic, from a number of hats that he's worn. I'll let him introduce himself in a second. And hopefully just garner some conversation as to a couple of key pieces as to why is it so difficult, what should you be considering when you're going into this process. Technology's a biggie. I think the question from Chris at Macquarie at the end was a really good one. Putting a value onto something like benefits that isn't truly just a piece of cash, almost played into what we're talking about here now. So we'll feather out that when we get to the technology piece, and then some tips at the end. But Dominic, can I just get you to introduce yourself before we kind of get into the meat of this?
Certainly. I'm Dominic Elias. I'm the head of the advisory business at EWM. I've also in the past been working in corporate compensation at Morgan Stanley in New York, supporting investment banking and institutional securities, and then more recently the head of compensation at Investcorp for 10 years. So I have a bit of both sides of this experience of understanding what it is that clients are going through with respect to year-end, as well as having experienced the pain of it myself.
So that's probably a good place to start, Dominic, is just talking about what the process looks like. So when we talk about year-end remuneration process, what is it that we want to kind of talk about here?
Yeah, so really it's the process by which we gather compensation decisions at the end of the year. There's obviously a finance input where there's a certain amount that firms can afford to pay. But then how do you take that amount and allocate it fairly across very diverse businesses working in different geographies with different objectives and obviously different performance?
Yeah.
And so how do you wrap all of that up into a process and make it effective? That's I think, the year-end process itself.
So let's start then with the difficulties. What is it that makes it such a onerous process?
Well, I think, in many of these organizations, particularly the organizations that you all represent, there's often a great number of stakeholders involved in these processes. You have regional heads, you have business heads, you have firm management. All of these people want to provide input into the compensation decisions. And in the end, you need somebody to make a decision. So how you roll all of that up and how you design a process around that so that everyone's input is incorporated into decisions is absolutely key, but also very difficult to achieve. Another thing that's become a lot more prevalent more recently, I would say, is the number of vehicles that you're allocating. In some cases, if you're lucky, it's just a matter of base salaries, perhaps a cash bonus and a deferral. But due to regulatory changes more recently, there have been additional things that we've had to give to, say, MRTs in order to meet the deferral requirements. Many of your organizations will also have new businesses in private capital, which may involve carry and co-investment opportunities, phantom plans, or phantom share plans, or phantom plans related to the performance of the business. So when you have all these different groups and all these different vehicles to allocate, clearly that's going to become a lot more complicated when thinking about who's getting what and how you're accounting for that within the firm. I think the other things is really two practical things. One is the time frame. This is not a project that can drag on. Oh, we didn't get it right, we give ourselves another week. It's due by a particular date, and everything tends to get crunched up towards that date. And the second thing is there are multiple changes. You'll typically have a process where there's multiple iterations, but within those and after those, there will be changes that will be necessary. And so keeping track of those changes and managing those changes and making sure that all of the inputs from the various managers are incorporated into this process is going to be key and is also very difficult to manage and audit. If those changes are coming through on WhatsApp messages, on emails, telephone calls, a bit of paper that somebody gave you in the restaurant, keeping track of that is key.
Yeah. And in terms of those vehicles that you talk to, I guess another consideration there is just the purely global nature of the different divisions that you're working with. It's not just, as most of the panels have talked about, not just UK-centric, but I guess there's a global implication of feathering all those vehicles into the overall total remuneration.
Yeah, some vehicles will work well in certain tax jurisdictions, and so you want to apply those in those countries, for instance. Obviously, regulations in different countries have a big impact on what you can do, what you can't do, and what's effective for that workforce. And, quite honestly, there are performance plans that you want to put in place in order to drive performance of particular teams. And in some cases, you don't really have a choice. If you want to be competitive in that particular business, you need to have a performance-based plan that goes beyond just a discretionary cash bonus.
Right.
So all of these things you have to try and marry up together to make sure that you're being competitive, but you're also being fair on a firm-wide basis.
And with your InvestCorp hat on, when you're setting, when you're looking at all of these vehicles, you make an interesting point about the regulations sometimes driving the structure of the plans. But did you try and kind of get ahead of that curve in terms of what you were trying to do to be creative with the plans that weren't necessarily regulatory driven? Because I guess as a human being, when you're told that there's an element of deferred compensation, it's. But But then, well, actually, if it's a fund deferral for some of the asset managers that I have here and you're investing into a fund, I'm getting a selection back to be able to say, well, that makes that a little bit more palatable. Were you trying to be a bit more creative in terms of not just reacting to the regulations?
Yeah, I mean, you know, Investcorp is a private equity firm, and so they have a very particular view, as many private equity people, those of you who work with them will know, that they have all the insights into how compensation should be done, and they want to apply every single sort of quirky feature that they possibly can. That means that many of the businesses have management share plans, management equity plans. There's obviously a huge carry component and co-investment components. You know, for instance, co-investment is typically something that you are required to offer or on a mandatory basis to your investment professionals. And that's mandated by the institutional investors. But also, you can offer it to the rest of the firm. If you've set up an investment vehicle already, you know, you can potentially extend that on to a broader population. And that can be very, very attractive. There are many people who are not part of the investment team who would be really interested in investing in those products on a preferential basis. And so that is something that is offered quite a lot, and particularly in the alternative space, that's viewed as a real benefit, particularly if you can get leverage onto those investments for those employees.
Yeah, that makes sense. And the other one that always strikes me with the condensed time frame is it's such an important process, but it always seems to be squeezed into such a short time frame. Is there a reason that I mean, I guess you do extrapolate it out over the year, but there's a lot of firms have a debt 31 year end, I guess, so it's always in or around that period.
Yeah, and I think, you know, many firms have identified this and sort of thought, well, let's start earlier. Let's make the process, you know, instead of starting, if we've got a year end of December, let's start the process in September or even August. Or I would say there's typically, the back end of the process is typically fixed dates where it's fairly repetitive each year, but the start of the process can vary quite significantly, and it can vary among divisions as well within that firm. And I'm sure many of the people here are aware of this time frame, but it almost seems like no matter how early you start, you always end up in a crunch at the end because there's just so much going on. I think the benefit of starting early is that to the extent that you do have new plans to implement, that you want to start planning for the type of year that you're having, whether that's a year that's really good for the firm or really bad for the firm. You know, you need to get a bit ahead of that and figure out what does it look like, you know, and start thinking about on an individual basis, what does this compensation pool look like? Yep. And that allows you to do a bit more planning. It allows you to think more about how the end result is going to be, but also it helps you to test systems to the extent that you've had to make changes because of new plans or new ways of allocating compensation, you know, different deferral percentages, that type of thing.
And I guess that leads into the next piece about what to consider when actually allocating compensation. And a number of the other panels have talked about the power of data and the importance of data. And I think that's to what you're saying. If you are going to start early, where are you getting that data, that benchmarking data from to make these decisions? I'm guessing there's a mix of internal and external data that you lean on.
Yeah. Well, there's two sets of data that you're going to need to put this together. The one part is your population, who's actually getting paid this year. And while you don't know who's getting paid on the 30th of December, you can still run a model today to get that set up. So any new hires that you've had between last time you did it and now, you can put those in and you can think about how you want to pay those and how they're fitting into the overall picture. But also, you can test your ability to update your system with the new population on every iteration. So you're not doing it for the first time when you're really under the gun. You've already done it a few times before you actually get there. Right. And the other thing, as you pointed out, was, you know, external data, which you're going to use to benchmark people, to understand, you know, what the market is doing and how you need to pay people. There's a variety of sources for that. I think anyone in financial services, I don't need to mention the name, for who's going to provide compensation data. But also, you know, there are less sort of traditional options, such as using search firms. Right. Or you might get anecdotal data from your business that you can compile and build a picture around, you know, what might be relevant.
Yeah.
obviously when you're looking at that market data, all of these things actually need to be viewed with a pinch of salt. So the market data, if it's a really broad market, it might not be the firms that are specific to you. If you get a select cut, is it really the select cut that you want, or just the ones that are available? If you use search firm data, there's a strong possibility that search firm data has been inflated, either by virtue of search firms just compiling it and then giving you a number that they think is something that's representative, or because the people going through the search firm are likely to be in the top quartile of people moving anyway.
Yep.
So the top quartile of the market is moving, that's what's reflected in the search firm data. And then anecdotal, obviously, you need to really ask the question. If you're getting information from other people, it's quite sort of comprehensive information can be gleaned from people who've moved from one firm to another, so they can tell you what they used to do in their last firm, which is quite helpful. When employees come to you and talk to you about the conversation that they have with their friend in the bar, you need to be a bit more concerned.
Yeah, and I suppose other stuff that you're pulling into this decision is financial performance of the firm, line of business, and then individual and team performance on top of that.
Yeah, so there's we see this across our clients. There's a kind of a different perspective on how this comp is allocated. Some people take a top-down approach, by which I mean they're looking at business performance at the firm level and then at the individual business levels and deriving a bonus amount for those groups based on financial metrics usually and other performance metrics. Or there is a bottoms-up approach, which depends much more heavily on market data, so how much we should pay for each of those jobs, and or just how much do people get paid last year.
Right.
So then you're assuming that last year's number was correct relative to the market and everybody else internally, and you're just making an adjustment on that.
Right.
Now clearly, those things have their pros and cons. Obviously, if you've made a mistake in the prior year, it's not going to be helpful to just repeat that mistake again.
And that is an interesting point. A little bit back to the question about putting a cash value on things that maybe aren't just purely remuneration, but when you're looking at a year's earnings, are you taking into account things that maybe are paying out or distributing in that calendar year? Because it amazes me you still talk to firms that understand what last year's salary was, let's add 5% and let's give you an extra 10 grand bonus, thanks very much, goodbye. But are you starting to take into account the equity plans that have vested, the fund deferrals that have vested, and saying, well, this is actually the pot of wealth that you've created, and basing the remuneration discussions around that?
Yeah, I mean, so, with these different approaches, I think the answer is there isn't one approach that's perfect. But if you do all of them, so if you look at what does it look like from a bottoms up and what does that come to in terms of the group pool, in terms of the firm pool, if you do a top down, what does that look like? There may be some businesses that you've invested in, you've got a lot of people there, but they hasn't seen the revenues yet, and that's going to be next year or the year after. Does that mean you should pay them based on their revenues? No, of course not, So you need to blend those two to come to the right place. But in addition, as you point out, there's when you're paying somebody, there's obviously the consideration of how much did the firm make, how much did the group make, what was your performance like, but also what have you received from the firm in addition. And the reason this is important is particularly in times when you've got a really tight budget. If someone someone might come to their manager after they've been paid and say, you paid me 25% less than last year, this is outrageous. What they don't mention is that perhaps they got a really significant carry payment in the same year. Now, the carry would have been awarded from before, but nonetheless, when you think about the value that's being delivered on the whole by the firm, that carry payment is very relevant.
Yeah, right.
And so being able to capture all of the value that you're giving, including the benefits and allowances in certain countries, and capturing all of that so that really the value that you're giving to the employee, that's really helpful from a decision-making perspective, but it's also really helpful from a communication perspective after the fact.
Yeah. And again, with your InvestCorp hat on, that's something that you did at InvestCorp in terms of, I mean, I know Will mentioned you look at numerous different total reward portals or statements, but that's something that you guys used to facilitate that.
So we did one which had, it started off with a sort of typical statement, which would have your base salary, your bonus deferral, etc., your new base salary. But then we'd have different sections. There'd be one section which would say, this is the distributions that you've received this year from awards in prior years. So we're not trying to, double count here, but we just want to remind people that actually the carry that we gave you 5 years ago, that we recorded as 2% at the time, is now X million dollars. And I think making that translation is really important to help people recognize the value of what they're getting.
Yeah.
And they might value more now the 2% that you gave them in this year. And going further down the page, we'd also have a section on benefits. And I think the benefits was particularly important where in places like the US, where the employee pays a small portion of, say, healthcare benefit, but the employer pays a significant amount. That amount, capturing that on a statement, is also really important. In some firms, that amount that the employer pays is much smaller. And so if you want to get credit for it, you have to present it to the employee.
Yeah, that makes sense. And leans into the section that we wanted to cover around technology. That's one way that technology is clearly helping with not just the visibility to your employees, but also how you're using that data to manage the year-end process. But how else is technology, again, I keep referring to your InvestCorp hat here, but maybe in your advisory role, also what we've seen across a wider spectrum of clients, what sort of technology are we seeing now in this space around the year-end REM process?
Yeah, well, the biggest use of technology in year-end, I think, is in modeling. So many of you, I'm sure, are using Excel spreadsheets to manipulate your population and play around with percentages and numbers and allocations and that type of thing. And obviously, I don't think that's going to go away anytime soon. It gives you massive amounts of flexibility, and frankly, is I think the best way and the most common way to do that. When it comes to decision making, then there's a range of options, really. There are out there some tools which will allow you to input numbers against individuals and report on those, and that's quite a helpful addition to the sort of stack of technologies that you're using to manage year-end. But I think, if you want to make really robust decisions, capturing what you've got historically and what you've done historically is key. And that's not just about how much bonus and total comp did you pay last year. It's literally capturing everything that you've paid in the past, and then using that to inform you of what's going on today and what your decisions are today.
Yeah, and again, at InvestCorp, that was something that you're using in terms of the diversity, the gender gap that exists. It's utilising that data, and that's surely the power of using a system to track that and report on it, I guess. Reporting is the next piece.
Yeah. Reporting is important, and I think the data flow is important as well. We've mentioned the fact that you need to go through this on an iterative basis. So if you're going to be doing it multiple times, you don't want to be collecting the data from different sources and then having to manipulate it to get it into your spreadsheet or into your system for year end. So smoothing out those flows from historical data, any financial metrics that you need, and then taking that and putting it into your decision-making tool, which could be Excel as well, or something else, and then taking those decisions and feeding those through into systems which record the awards and record the new elements that you've given in that year. And if that's a manual process, that can be very painful. And it also reduces the impact for the employee when they say, oh, you've got something, and it doesn't show up in the system where they don't get any record of it until months later. So I think that's important.
And I don't want it to sound like technology is the solution to everything, because there must be challenges when you look at projects like this and think, is there a piece of software out there or a technology solution that I can use? What would be the barriers or the worries that you would have? I always think about the sensitivity of the data across HR and Ben's, but the other thing we kind of talked on briefly was AI, and we saw in the presentation earlier about the ramifications of AI. It strikes me that it is a marriage made in heaven, but I see the minefield ahead of not just plugging one into the other. Do you think that that's something that could evolve in this space?
I think AI is something that can be used, definitely, certainly with respect to the market, managing the market data. I'm no expert in that field, but what you read in newspapers about the possibilities of it, there are things that can definitely play into this. But I also think, to your question about the challenges of using technology, I think the biggest one is setting yourself up for flexibility. And I think if you can set yourself up for flexibility, then you're ahead of the game. But it's very difficult when you're having new products being brought in, you're having your population is constantly changing, your decision makers are changing. Being able to factor all of that into your system and into your process is key. And yeah, I think if you can master that, that's a long way to getting it done.
Yeah, cool. And I'm conscious of time as well. I don't want to stop you. Coffee is imminent. So can we welcome the floor in with a couple of questions just before? Just coffee. People want coffee, I think.
Pick your brains. So we're going to have a short break back in here at 22 for our last session, a session on with the Remco perspective, and ultimately talked a lot about remuneration strategy and how we can make sure it's working and doing the right things. So we're looking forward to that, and we'll be back in here at 22. Thank you very much. Brilliant. I think there might be one or two people still coming from the coffee, but why don't we get started? So on to our last, but by no means least panel. So I'm going to hand over to John, a partner from the financial services practice at Deloitte, to introduce his panel. And we're going to hear on the role of the Remuneration Committee and how they can satisfy themselves that you're supporting the strategy. And we're also joined, hopefully it's going to work, with an online speaker as well. So over to you, John.
Perfect. Thanks, Bradley, and thank you very much to all of you for staying for this fantastic session. So I am joined today by three esteemed Remco chairs, who will give you their views on the role and responsibilities of the Remco, but also particularly how can you link remuneration strategy to the right behaviours. Touched a little bit on misconduct earlier today, but this is much broader and hopefully much more positive as well around, we're going to talk about the positives as much as we are around some of the challenges too. So, without further ado, perhaps if I can ask my panel to introduce themselves, and perhaps turning to you, Valerie, first.
Lovely, thank you. I'm always scared when I'm introduced as an esteemed guest. So I'm Valerie. I'm delighted to be here, and thank you for the invitation. It always feels like coming home when you come into a remuneration forum, because I'm hopeful there are a lot of like-minded people here together and we can share our views. My views will be my own. I am a former Group HRD. I've had the privilege of working in the UK, but also in Germany and in the States. By background, I am Irish. I came to the UK straight from university. So as you can see, I'm hiding my grey hairs very well. Since 2009, I have had a portfolio career, and during that time, I've had the great privilege of being a senior advisor to the regulators. So as part of that portfolio, not full-time, but part-time, from about 2009 until about 2015-16, I worked partly with the regulators, coming in to help them think through how they shaped remuneration post that crisis, in terms of believing that remuneration was not necessarily the cause of what had occurred, but it certainly may have been a contributor. And in the room, I can see at least one person whom I worked with during that time who's now also left the regulator. But my period covered working with Andrew Bailey when he was head of the PRA, and also some time at the FCA, and looking at really developing the remuneration codes, but also a little bit around culture as it impacts firms, and the SMCR in the early stages in terms of how and what that meant for firms and how the regulators would introduce it. So from about 2015, my various interests morphed into the formality of sitting on boards. Today, I am very lucky to sit on 2 aviation boards where I am the SID, and I'm coming to, I guess, in a way, the end of those terms at the end of this year, where I will have completed my 2 terms of 3 years. I am also the chair of both nominations and remuneration for both of those firms. In addition, I work with Tokio Marine Kiln, one of the global Lloyd's underwriters, where I sit on risk as well as conflicts, as well as remuneration, in addition to being on the board of the managing agent. And prior to that, I had, again, the privilege of chairing remuneration for DWP Digital, the technology board that runs all of the, I guess you'd call it the machinery behind payment of pensions and social security and everything in between. And there I chaired remuneration, which was just a little bit different because it also involved this sort of that navigation around Whitehall. So in addition to having your own, I guess, ideas on remuneration, there was also the overlay of government, overall government policy, and the management through the Treasury. So today, my views are, I guess, a little bit of an amalgamation of everything. They are my own views. They don't represent any of the firms I work for, but I think you'll find that probably there are quite a few common themes that come through chairing remuneration, irrespective of the sector in which you work.
Thank you very much, Valerie. George.
Valerie, thanks. Yes, my name is George Gendel. I chair the Remuneration Committee at Lion Trust Asset Management PLC. We're a fund management business, so we're one of Andrew Ninian's boys, slightly concerned that I thinks we've got to look after the media, but we won't perhaps dwell on that too much. But of interest, of course, for me is not just the role of setting pay within our own PLC, but as a fund management business, they certainly do have an interest in how our own fund managers manage what I say horizontally across and use their votes and their governance responsibilities across the companies they invest in.
Thank you, George. And then on the line, we have, or on the screen behind us, we have Natalie. Natalie, afternoon.
Yes, good afternoon. Thank you for having me today. I started my city career first in investment banking at Nomura International before moving to the buy side as an equity fund manager for Garmore and later for State Street Global Advisors, where I led a large UK and Irish team of portfolio managers specialized in international equity, so a bit like George, portfolio management. My expertise is mainly around investments, ESG considerations, risk management, and governance, corporate governance. In 2019, I transitioned into non-exec roles. I currently chair the Remuneration Committee for Aspen Insurance UK and its Lloyd's Syndicate, and I also serve both of their boards and their various committees. Additionally, I'm a trustee for State Street UK Pension and Life Assurance and Hyde Charitable Trust, which focuses on housing initiatives. I also provide guidance as an ESG advisor for a Spanish company called Rise in Action, which is a startup committed to sustainability. And in the past, I've also chaired various risk committees and held other advisory roles and trustee roles for the third sector.
Thank you, Natalie. So, tons of experience to draw on from this panel. We will pause a little bit before the end for you to be able to answer your questions of this wonderful panel. So now's the time to get your thinking caps on while we have a chat, to think about if there are any questions, easy or difficult, that you might want to ask our panel this afternoon. But while we give people thinking time, so perhaps turning to you first, Valerie, if that's okay. So just what is the role of the board on remuneration matters, and how does that compare to the Remuneration Committee?
It's a good question. It's one that one asks oneself all the time. I'd say, as a board member, I like to think of the role of the board as having about 5 components. Firstly, it's about setting the strategy. Secondly, and particularly in financial services, it's about managing risk. Thirdly, it's about holding the executive accountable, but also about being constructively supportive. So it's sort of that critical friend. Then it's about the culture, so being the custodian of the culture. And finally, certainly for me, I think it's really important that the board focuses on the future through the succession plan. So that's the strategic succession plan, and it's thinking a bit about talent in the wider sense. So if you use that as your framework, you then say, well, surely that's also partly what the RemCo does. So to me, I think the RemCo probably does some of the heavy lifting for the board. So it's therefore saying, well, if that's the strategy, where do the people come in? And if you think about those 5 things, people come into absolutely every aspect. So if you're thinking about talent, you're thinking about how reward, and in my case, I believe it is the widest sense of reward. So some of our colleagues today talked about some of the subliminal benefits that people have that they maybe don't understand they have. And I'd say one of those is that gift of promotion, the gift of training and development. And so for me, the Remco, it's a little bit wider than saying, you know, you must look at the bonus pot and look at the salary and put the balance and check in. To me, it's a little bit more than that. And I would say where the Remco comes in its terms of reference, it's taking the strategy of the board and saying, how does that apply to people and the life cycle of employment? And within that, how do you actually think about the rewards? Some of that is monetarily important. Some of it is about the messaging and how that plays into the culture. And with that comes, of course, looking at the external benchmarking, the external context, meeting with the executive. But ultimately, it is the board who are responsible for remuneration. And therefore, the role of the Remco is to take that to the board, where it's a given that a lot of the heavy lifting and the work has been done, and hopefully that then enables or frees the board up to actually have that more strategic discussion. And that's where I would say it's sort of the hard work and the heavy lifting to enable the strategic discussion.
Well, of course, we have, you know, formal responsibility now to look at senior management pay.
That's true.
So by definition, you know, we come more bumping up against the role, as Valerie so clearly said it, as you know, the board in terms of how it sets pay. I mean, my view is that you start at the top, and so you know, getting pay right, having the tension between being on the one side, setting the executive director's pay, but also how you link that. And we've been spending certainly a lot of time at Lion Trust in saying, you know, that only works if you ripple that down throughout the organisation. So much clearer alignment of metrics, of performance conditions, and everything that goes on through the organisation.
Yeah. And Natalie, perhaps turning to you, what do you think makes a Remco work well?
I think you need to have, if you align remuneration with the right culture and the right behaviors with the organization, then you're setting yourself for success. So clear communication, having the right performance-based incentives, the right long-term focus, and implementing recognition programs that acknowledge and celebrate employees that demonstrate the desired behaviors, reinforcing the cultural alignment, is going to serve you well in general. And I mean, a bit like Valerie, I'm not representing here any particular organization. I'm just talking in general across multiple experiences here, and also having regular feedback and evaluation of what you are currently doing all the time. So I think, you know, in a nutshell, trying to go across various.
We will return to some of those themes in a little while. Valerie, just turning to you, just what qualities make an effective Remco chair? What characteristics does a good Remco chair need to have?
I think one of the really important things is to be intuitive and actually be in listening mode. So it's not just about what you hear or you hear verbally, but it's when you walk the floor, when you listen to people, when you, I don't know, when you just ask somebody, you know, what's it like working here when you go up in the lift? They don't know who you are. And if they go, well, it's pants, you know, there's something wrong. Or if they say, actually, and I often see this, people do this. They put their hand on their heart. Sometimes when I worked at the Bank of England, they would do that. They would say, I'm very proud to work for this institution. So there's something about being intuitive. There's something about bringing not just the board, but the executive with you. There's something about resilience in saying no. Sometimes when all around you are, you know, but if you don't pay that star trader or that star person, they will leave. And actually, if we were just hostages to fortune, then everyone would leave, and the people who stay would be staying for the wrong reasons. So there's something about resilience, there's something about intuition. Something, for me, that's very important is bringing the outside in. So not just saying we benchmark against ourselves and we are wonderful, but actually we benchmark and we're in the median or we're not in the median or we have star performers here. But actually looking at that whole proposition in terms of what is it you're trying to achieve, and sometimes just being the reality check that says, sorry, but this time it's a no, or the external context is different. So it's a whole bunch of things, but ultimately it's about bringing your fellow Remco together. So it's no use if the chair drives in one direction and the rest of the people say, you know, they're not listening, they don't understand, or the executives say, you know, it's just a nice lunch for the chair to come in and chat to people and go home. And I think that might have been the case maybe 20 years ago. You know, the city was different to the way it is now in terms of how boards are run.
Yeah. And I think I echo that. And I think you've got to learn to be unpopular, team, because if you're not managing in the middle and feeling the tension between management, the shareholders, other stakeholders who we heard from Andrew Ninian today, then you're not doing your job.
Yeah, agreed. And in terms of aligning remuneration with culture, we've already, a number of you have sprinkled the word culture already. What has worked in terms of aligning remuneration with culture, encouraging the right behaviours? Perhaps Natalie, coming to you first.
Yeah, sorry, I keep on having to mute myself.
Can you hear us?
Well, in terms of what has worked and what doesn't work.
Yes, What have you seen worked well in terms of aligning remuneration with culture?
I mean, again, this long-term focus really works very well. And I think where I've seen things not really working very well is particularly when you have a misalignment and a lack of clarity. So having a very clear communication and having a very clear metrics that really works well.
George, building on that, so kind of what have you seen?
Yeah, I think there's a clear tension here between the metrics and things that can be easily measured, and we all love those. Everybody wants that to happen, and the broader improvement and link that's there. So you need to get away from too many short-term measures that can be box ticked, obviously. But for me, the critical thing here has been about this happening over time. Yeah, this is a continuous improvement game. So therefore, if you're going to get this better, I think it's best in the short term rather than the long term incentive arrangements. And the key is to build cumulatively on those some of the things that you can measure, but the broader things where you're exercising more judgment and discretion, and make sure that the bar gets continually raised. And again, I come back to the point that that is only possible then when you're aligning not just what the executive directors are saying, but how that's rippled down through their reports and their reports and their reports.
Yeah. And I'd probably add transparency. I think for employees, I think it's important that there is an element of understanding how things happen. If we go back many, many, many years ago, there was a bonus pool and it was sort of divvied out, and you had your private meeting and you had your letter. But actually nowadays, people will say, well, how did you measure me? And what were you measuring? And what was on my balance scorecard? And can we talk about it? And I think that's good.
I think it's a real positive, and we've seen that shift. We had a session on the EU Pay Transparency Directive earlier, which is just going to, again, raise the bar in that space. But it's not just around the legal, it is also, as you say, around the employee experience and people wanting to believe that they have been treated fairly. Talking of raising of the bar, and perhaps turning a little bit now to risk culture. So there has absolutely, since the financial crisis, been a raising of the bar in this space. To what extent has risk adjustment played a part on that? Maybe Valerie, coming to you first.
I suppose I'm slightly guilty in that I was with the regulators in 2009 when this whole risk adjustment discussion started. I think it's really important. I think by now it's business as usual. I would imagine for most of you, I can see some heads nodding. I think genuinely by now in financial services, if you're not risk adjusting, then there's probably something very strange going on. So to me, it's part of business as usual. On my financial boards, and actually not just on my financial boards, on all my boards, there is that question around, well, okay, that's the headline number, but you know, when you risk adjust for various elements of the business, what does that mean? And I think that once we all got over the fact that we couldn't just pay in cash anymore, and we had to think about deferment, and we had to think about maybe using some sort of a vehicle to do this, and there were some balances and checks. Now, I'm not a purist regulator that would say everything that regulation did was good and everything everyone else was doing was bad. I think because of the time we were in, the pendulum swung or had to swing in a particular direction, and then it came back to a more balanced situation. So for me, I think it's integral to what we do. I think certainly on my financial board, it is absolutely at this time of the year partly our discussion. It's not the be and the end all. It's almost part of the framework. It's, okay, let's see where we are performance-wise. Let's see what we need to do adjustment-wise. And then let's see what that means and what message we want to give. So I think it's generally a force for good.
Positive. George?
You know, I think echo Valerie's words, business as usual. That's where risk is concerned within the financial services industry now, sector. So we don't pay people for business as usual. So the approach we've taken, a bit like personal performance, risk adjustment, is that of course we assess that independently as part of the process every year of doing it. But that becomes an underpin, or I never understand what's an underpin and what's an overlay. But I'm sure someone can tell me which of which. But that is not specifically rewarded as part of the scorecard, where it's obviously published information, but it is there because it's business as usual. It's there as an underpin. We do assess it, but there are other drivers, and of course, one day someone's going to get malice and claw back to work. I had a word with my CFO the other day and said, "When are you ever going to do something really bad and I can claw some money back?"
So risk management is a given for you.
Absolutely.
Yep,
And therefore, just as an underpin, rather than a specific part of any scorecard that says, my word, because otherwise, I think by and large people would pass that 100%, and we're not rewarding people for doing things which should be in their DNA.
And turning perhaps a little bit to ESG. So we've seen a lot of focus on ESG from the regulators, from shareholders as well. So how have you seen pay evolve and align with ESG priorities, and what do you think the future looks like there? Perhaps, George, turning to you first as you have the mic.
Okay, yeah, well, first of all, I think we need to work out what. First of all, I think ESG measures, come back to what I said before, are best in short-term bonus metrics rather than LTIPs. We find these things hard to measure them 5 years out even harder. So cumulative effect that I talked about before. Also, I think the appropriate balance should be struck between financial and non-financial measures, and the ESG measures. Well, within, again, published information, but within Large Trust, that's 70-30, 70 financial metrics, 30% ESG. And we look critically at also that if the financial performance is not there, then should we be rewarding some of those other metrics? So the other thing I'd say within Large Trust, I mentioned at the start, is that we build into, and this is again published information, we build into our scorecard the look at what we as a fund manager do in relation to the impact that we have across the whole ESG range, across the various funds and things we're investing in. Now that's a tough one for the CEO, because sometimes he says, well, I don't manage the fund manager's decisions, investment decisions, but I think that's too much of a cop out. So we do put pressure on him, and to make sure through our own corporate governance team that we are matching and improving our outcomes across the range of funds and the companies we invest in.
Thank you. Natalie, turning to you, does that resonate with your experience?
I think it's a bit more, from a personal point of view, I think it's a bit more varied. I think if you are talking about public companies, I think there was a study by Willis Towers Watson suggesting that most UK public companies are now incorporating ESG measures in their executive compensation programs, up to 89%, and that growth in the UK is very recent. And if you compare that, at least they're incorporating at least one factor of ESG, but it's pretty vague as it stands, which factor they're incorporating. And if you look at Europe, it's a little bit more. Those numbers go even higher, and they're incorporating about two to three factors. So I think it depends. As regulation will increase, that incorporation of ESG factors will become more relevant, and it'll be clearer as to what they are incorporating. I think the problem right now is that it's a bit, it's left to a little bit of discretion as to what you're incorporating. So it could be an E factor, it could be an S factor, it could be a G factor, if that makes sense.
It does, and certainly we've seen shareholders push for more quantitative metrics, and perhaps more output metrics now than input metrics. At the start it was very input focused, but I think now they're expecting boards to have those priorities in place, and dashboards, scorecards, and then be able to measure on outputs. So I think
interestingly, so it's not just financial services. I mentioned I sit on 2 aviation boards. Clearly, huge debate and discussion there, and that whole point about, funnily enough, George, more of that longer term aim and the recognition it is a journey. And also the huge recognition around the dangers of being caught up in greenwashing or being caught up in reputational damage because a statement is made that can't be authenticated. And so that whole journey around it, a feeling that linking some of it to remuneration and transparency has got to be a tool in the toolkit box in a way to help it.
Yeah, agreed. And just thinking about the S, within ESG, and particularly the importance of diversity and inclusion, I think it's now well understood that is so important from a cultural perspective. How have you seen D&I priorities embedded within the firm and then within remuneration? I don't know who would like to take that one first.
I'm happy to talk a little bit about that, if I may, John.
Natalie.
I think, again, it's a bit to the point I was just making early on. I think it's very difficult because even if you take, for instance, ethnicity, there is a lot of variation in terms of the criteria you can use, and it's still very much down to personal disclosures, and that's where a lot of firms are finding difficulty in persuading their employees to disclose, and that's a barrier, for instance. And there are different criteria that you can use. So, for instance, I'll give you an example. I've got a Hispanic origin, and Hispanic is not represented in most of the categories that you can use in the UK, and that's for some of us, it's quite frustrating because it's the ethnicity that is represented. It could be represented, but it's not. So depending on the categories that you can use, you may not feel represented in the groups, in the categories that you could be choosing. So there are difficulties in identifying the right categories, for instance, in ethnicities or even in religions. And I think there are a number of barriers at the moment that are making the representation and the diversity of the data more difficult to be accessible.
Yeah, and employees trusting that you will use the data in the right way as well.
Correctly, and also you also often find that in companies, for instance, that you have an employee set in the UK, but maybe they're reporting to a different location. And then that also is going to create some difficulties because you have reporting lines that are not subject to the same jurisdictions. So all these things are things that can be ironed out, but right now we haven't got a roadmap to do that. So we will get there, but right now we have some difficulties to get there.
Yeah, work in progress. George, what's your
I'm reminded of the old Irish joke about the chap wanting to get to Dublin. He said, well, I wouldn't start from here. So where we start from is a wildly differing places and not where we'd want to be. So the work we're doing in conjunction, obviously strongly with HR here, is looking to have some better analytics of the whole workforce and population, different cohorts. Diversity may, or whether ethnic or otherwise, may not be great at T-1 management level, but actually it's rather good at T-2, much better. Then it's all about making absolutely certain we're investing in the development and training of that cohort. So that's where the effort needs to be, rather than trying to box tick to deal with some of the past problems where we didn't start from there.
Yeah, building the pipeline incredibly important.
And of course linking that again through to to objectives and measurable things.
Yeah, but there's going to be a lot of work to be done, to be fair, to get to where the FCA wants us to get to, because we'll have to create quite a lot of, all firms will have to create quite a lot of data sets.
But it's a bit of a numbers game from the FCA, and this isn't a numbers game.
Yeah, agreed.
I mean, don't get me wrong, I think it's a great initiative and it needs to be done. And I mean, in order to get where we need to get to, everybody's going to have to do quite a lot of work. But there is a significant amount of pipe work that needs to be created in order to deliver what we need to deliver.
Yeah, agreed. So it's time to open up to the audience, to you all, for any questions. So do please put your hand up and feel free to ask your question.
They have to be easy questions.
Easy, okay, sure, very easy. So several organisations issue guidance on remuneration structures, and Andrew spoke about the IA's one earlier today, but there are other institutional shareholders, asset managers, etc. With your remuneration committee hat on, do you find such guidance helpful or a constraint?
Can I just clarify that? Do you mean this guidance, are we providing the guidance or are we receiving it from?
You're receiving it from IA, other institutions.
Or
IAs,
regulators or
regulators.
institutional shareholders.
Correct.
Personally, I find it helpful. If I'm honest, most of the direction of travel is in the same direction. So it's not that, anyone is saying, we want you to do this, and somebody else is saying, we want you to do that. It's nuanced. So if you're an institutional shareholder, you will be nuanced in what you're doing, but you'll also have those external pressures around asking about ESG or asking about malice and clawback, or, why is that bonus of that particular CEO or whatever so high. So it's actually creating a little bit of a framework and rigor. The regulators, as we said, a lot of that is BAU. But what I also noticed, particularly from my time with the regulators, a lot of cross-pollination between regulators sitting on podiums talking to people and institutional shareholders looking at what people are doing. So you find in the round, everyone is probably talking about the same things. Sometimes it's quantum, sometimes it's about education and explaining why the external market is more competitive than one might imagine from one lens that you look through. But I have never found that direction to be egregious or difficult. You know, you might have a little in-joke that's, oh, here we go, we're about to go out to speak to the shareholders, you know, what'll be on the agenda. But you generally know, and if you don't, you're probably doing something wrong.
Yeah, I mean, listen, I think it's broadly helpful, but, you know, I know that if I put all that information into some central repository and got AI to try and give me a remuneration policy that I could get to my shareholders and get 100%, it would explode. So, I mean, there are some tensions. People are coming at these from different directions. So, yeah, there is no substitute for a bold remuneration committee taking sometimes a stance that, I would say, may even get you on the naughty stat if you think it's right for your business and it's linked to the strategy of where you want to go.
I think somebody said it earlier as well, know your shareholder base and get to know them. Next question.
Yes, maybe, thank you very much for all the valuable input, and maybe pushing that question a little bit further. How do you see the mechanisms to control the remuneration committee indeed in itself? Because the agency costs are luring everywhere, and I give a very concrete example, the case we had many years ago, where the remuneration committee was in listening mode, was very open, was very doing the field work, benchmarked, and with the guardian of the treaty. But at the end of the day, the legal department wanted a deep dive in all these results, and it became clear that the best paid people of the entire organization year after year were basically the members of the remuneration committee itself, or just of their departments, HR and so on.
So you mean the REM committee comprised?
They benchmarked, yes, exactly. And of course the answer was yes, but it was all being approved by the board. So what's the problem was all objective. And it poses the problem about, I think, the agency costs within the functioning, well, agency costs in the corporate governance notion of the word, of control in itself. And the easy answer would be, well, it's the board. At the end of the day, it's the board who had to control. But of course, the board, you don't want a board who is micromanaging the remuneration committee. And so how would you deal, maybe from experience or perspective, how would you deal with that, that concern, so to say? I'm not saying, of course, that by definition or by hypothesis, we have to function from bad faith within the function of the remuneration committee, but it's the classic problem of the agency costs. You have the responsibility, you have to be the guardian of the treaty, but of course you can abuse in your own interest. And how do you see the possibilities of control is a big word, but assess that?
Balances and
balances.
Yeah. So look, I sit on different sectors, so I see it through different constituencies. On my aviation boards, we have airline directors sitting in that mix. As a REMCO, on all my boards, we're very clear that the voting members are not executive. So we have independent NEDs. We're chaired both at REM and at board by independent NEDs across everywhere I work. And whilst coming back to earlier when we said, what sort of characteristics do you need in your chair? I would say not just the chair of REM, but the chair of that board. In a way, the ability to stand up sometimes and say, no, I'm sorry. But if I'm honest, I would say certainly on my airline ones, there are balances and checks because there are different airlines sitting on it, and they will say, no, sorry, in our industry, we see this and we see that. And actually, what you're doing some of the time as REMCO chair or as board chair is, I don't use the word disrespectfully saying herding, pulling people together, getting a healthy debate, but then creating, you hope, consensus. I do recognise what you say, and I know if you look at it as maybe an institutional shareholder, you may look at certain firms and you might think, how can they pay that person X million based upon almost a formula that says, the framework, or as George would say, the AI or the computer goes, and we'll just pay. I think that's a journey, and I think that's where you as institutional shareholders come into your own to a certain extent, because you are actually, as part of society, you are part of that balance and check, and you're, as a shareholder, you have a voice. I think there is no actual answer that firms are doing it really well. I think people are conscious of it. And in my career, certainly I have worked in banks and insurance and in energy. I think in my lifetime it has changed a lot. It's been helped by malice, clawback, long-term incentive plans, where there's much more focus now on you can't just say, you're really worth it and we're going to pay X and Y, because somebody is going to press the bell and go, well, actually, why and what and where's the justification? I'd say we're not fully there, but I'd say it's a lot better than it was. And I think we all have a responsibility, including the employee, who, as we know, can choose not to work in an organisation they're not happy with. So it's changing, but it's not there. And, that's an honest answer.
And Andrew Ninian mentioned this morning about the wider stakeholders, and just picked up by Valerie here in terms of the employee group. One of the toughest gigs I have is to sit before the Workforce Advisory Council and be grilled on executive pay. So that is another check and balance that comes into play.
It has improved, but maybe more to do. We are out of time. Thank you very much for your questions. Thank you also to Valerie, George, Natalie for a fantastic debate. Back to Bradley for some closing comments.
Brilliant. Thank you very much. Great, thank you very much, everybody. I hope it's been an enjoyable and useful day. We've certainly covered a lot of ground. There's been a lot of that change to come, bonus cap, non-financial misconduct, and we've heard some more here. There's more on the agenda. Obviously, the ESG and the diversity and inclusion agenda are both sort of absolutely top of mind, so plenty of topics to keep us very busy over the next few years. I think a number of the things we've heard today as well have touched on actually strategy and actually taking that step back and thinking about how fundamentally all of the things we're talking about here are designed to support firms' strategy. And sometimes we do get lost in the detail, or there's a risk of that. But trying to take that step back and trying to sort of keep our head up. And that's come through in a number of the topics. On a macro level, it's come through on the UK competitiveness and fundamentally as an industry, what's the strategic objectives. And then on the firm strategy, it's come through in reward, it's come through in the different ways we can use non-financial incentives, for example, to support that strategy, and ultimately then rolling up to the Remco to sort of as guardians of that strategy, as we've just heard. So hopefully something in all of that for all of us. Before I start talking, I'm very happy for you all to be scribbling on your feedback sheets while I talk, so you get those completed, and then you can get your bottle of champagne if in the drawer. So do fill those in, please. They're incredibly valuable. Otherwise, it's just left for me to say thank you all very much for coming. Thank you very much to all our speakers, both present and those who've left earlier, and indeed online. And thank you to all of the firms who've sponsored the event. I hope I've covered everything I'm supposed to, but I'm going to stop there. And thank you to everybody. So thanks for a great day.